And welcome to today's RedChip Investor Conference. Thanks to everyone joining us from the United States and around the world. We're pleased to lead off today with Barrett Boone, who is RedChip's Vice President of Global Markets. Barrett, please go ahead.
Hello, everyone. I'm Barrett Boone, Vice President Global Markets at RedChip Companies. For more than 3 decades, RedChip is focused on one core objective: identifying tomorrow's category leaders before they become widely recognized. RedChip was founded in 1992 as an independent research firm. We were one of the first to put coverage on Starbucks, Winnebago, Daktronics, and Apple. Many other companies as well that became household names. Today, we are an investor relations, media, and research firm focused on companies' market caps $5 billion and under. Through our platform, including our national television program, Small Stocks, Big Money, which reaches more than 70 million homes each week on Bloomberg, we've built a simple but powerful model. Connect investors directly with companies operating at the intersection of innovation, capital formation, and scalable growth. That mission brings us here today. This conference is centered on artificial intelligence, not as a headline, not as a concept, but as a structural shift in how the global economy operates. From data centers to real-world applications, we are witnessing a transformation that is unfolding simultaneously across infrastructure, enterprise software, and industry-specific workflows. What makes this different is it's not just the technology itself, it's the speed, the scale, and the breadth of adoption. Artificial intelligence is no longer experimental, it's being operationalized. While the specifics of AI are new, the underlying pattern is not. Throughout history, major economic shifts have been driven by technologies that fundamentally changed how work gets done and how value is created. The Industrial Revolution mechanized production. Electrification enabled scalable manufacturing and urban growth. The Internet digitized information and communication. Each of these transitions created new industries, displaced others, and generated significant wealth for those who recognize the shift early and position themselves accordingly. What matters is not the comparison of technologies, it is the recognition of the pattern. A new capability emerges, infrastructure is built at scale, applications unlock economic value, early participants capture outsized returns. We are now in that pattern again. When evaluating any major technological shift, we start with a simple question: where is capital being deployed and at what scale? Today, the answer is unambiguous. The largest companies in the world are committing unprecedented levels of capital to AI infrastructure. Recent reports indicate that Alphabet, Amazon, Meta, and Microsoft are collectively on track to invest nearly $650 billion this year alone into AI-related infrastructure, a dramatic increase from prior years. This is not incremental spending. This is a systemic reallocation of capital. And it's happening because these companies are competing not just for market share, but for control of the future. When NVIDIA's Jensen Huang recently stated that, quote, "We are still at the beginning of a multi-trillion-dollar build-out," he wasn't describing a cycle. He was describing a platform transition. Historically, platform transitions, whether it was mainframes, personal computing, mobile, or cloud, have followed a consistent pattern as well. First, massive upfront infrastructure investment, followed by rapid expansion of developer ecosystems, which ultimately lead to a proliferation of applications that monetize these ecosystems. We are currently in the first and early second phases of that cycle for AI. And importantly, while the headlines are dominated by trillion-dollar companies, the economic value created during these transitions is rarely captured by the incumbents alone. It is often the smaller, more focused companies solving specific, high-friction problems that deliver the highest relative returns. Every major infrastructure build-out is not defined only by opportunity, but by constraint. In AI, 3 constraints are emerging as critical: compute, connectivity, and energy. First, compute. The demand for advanced chips, particularly GPUs and specialized accelerators, continues to outpace supply. This has created a bottleneck that's reshaping semiconductor roadmaps, driving vertical integration, and opening opportunities for companies that can optimize performance, reduce costs, or improve efficiency at each layer of the stack. Second, connectivity. As AI models scale, so does the need for high-speed data movement, both within the data centers and across distributed systems. Networking architecture is becoming a competitive differentiator, and innovations in bandwidth, latency reduction, and data orchestration are increasingly valuable. Now, third, and perhaps most underappreciated, is energy. According to the International Energy Agency, data centers consumed approximately 415 terawatt hours of electricity in 2024. That figure is projected to more than double by 2030. This is not a marginal increase. It is a complete and total structural demand shift. In regions like Texas and other U.S. growth markets, energy demand is already rising sharply, driven in large part by data center expansion. What this means for investors is straightforward. AI is not just a software story, it is an industrial story. It touches power generation, grid infrastructure, cooling systems, real estate, and supply chains. And wherever there are constraints, there are opportunities for companies that can alleviate them. But capital deployment and infrastructure expansion are only part of the equation. The next question is, how does this translate into real economic value? And we're starting to see the answer emerge. Across industries, AI is moving directly into operational workflows, not as a replacement for human decision-making, but as an augmentation layer that improves speed, accuracy, and cost efficiency. Recent data from McKinsey indicates that a significant majority of enterprises are now actively deploying AI into their production ecosystems. At the same time, surveys across thousands of organizations show that AI adoption is increasingly tied to measurable financial outcomes, including revenue growth and cost reduction. This is the critical inflection point, because once a technology begins to demonstrate a consistent ROI, adoption accelerates. We're seeing this now in areas such as customer support, where AI is reducing resolution times and operating costs, software development, where productivity gains are compressing development cycles, healthcare, where AI-assisted systems are improving diagnostic accuracy and reducing errors, retail and logistics, where forecasting and automation are optimizing inventory and supply chains. In each case, the pattern is the same. AI is not just enabling new capabilities, it's totally reshaping the cost curves. And when cost curves change, industries change. So where does this leave us as investors? If we step back, we can think about the AI ecosystem in three broad layers. Infrastructure, compute, data centers, networking, energy. Then there are the platforms and the models, foundational AI systems and development frameworks. Lastly, we have the applications, industry-specific solutions that drive measurable outcomes. The largest companies in the world are heavily concentrated in the first two layers, but historically it is the third layer, applications, where we see the most dynamic growth and differentiation, because that is where technology meets real-world problems. That is where companies can move quickly, iterate rapidly, and build defensible positions around domain expertise. And that is where many of the companies you will hear from today are focused. They are not trying to build general-purpose models. They are solving specific problems, reducing costs, improving efficiency, improving outcomes. That focus is what transforms technology into revenue. And that brings us to today. We've assembled a group of small and micro-cap companies that are operating across multiple layers of the AI ecosystem. There are companies focused on execution, building products, acquiring customers, and scaling their businesses in real time. As you listen to their presentations, I would encourage you to evaluate each opportunity through one simple but powerful lens. What is the problem being solved? How significant is that problem? And how effectively is this company using AI to change the economics of that problem? Because ultimately, that's what drives value. Not the technology itself, but its impact it has on costs, productivity, and outcomes. We're at a moment where innovation, capital, and necessity are converging, the infrastructure is being built, the constraints are becoming clear, and the applications are beginning to deliver measurable results. For investors, that combination creates a landscape rich with opportunity, but also one that requires discipline, insight, and access to high-quality information. That is what RedChip is here to provide. On behalf of our entire team, I want to thank all of the companies presenting today and all of you for joining us. The RedChip AI Investor Conference, from data centers to breakthrough use cases, will begin shortly. Thank you very much.
And thank you, Barrett. Our next presenter is Michael Donovan of Compass Point. Michael, please go ahead.
Good morning, everyone. Thank you for the intro. And let me share this screen right here. So by way of introduction, I work at Compass Point as a senior analyst covering the AI HPC infrastructure landscape. So for many of our companies, they're either ones that used to be Bitcoin miners and now transitioning into HPC data center operators, and then also neo-cloud companies such as CoreWeave and Nebius. We are obviously expanding too as this entire space continues to grow. Now, let's rewind to summer of 25. At that stage, we had really the initial large contracts coming online for the HPC data centers, and the question at that time was how much actual demand is there, and how much spending would be done from the hyperscalers and then also enterprises. Now, as we're wrapping up with March, we see the demand still relentless among the hyperscalers as they're committing about $700 billion of CapEx to data centers just this year. And from a thesis perspective, it's pretty straightforward. We need much more compute when it comes to running workloads for both training and inference. Now, the training side, we expect that to remain robust, but the real lever that we're seeing this year starting to tick up and next year would be from inference demand. And that's going to come from hyperscalers, but also enterprises as they enter the space in a more meaningful manner. For the operators, one of the pushbacks is, well, what happens if we bring online a lot more power, and power is no longer a scarce component? But from our perspective is that's going to take a long time to bring on the power that's actually needed for running compute demand, to meet compute demand. So we see three limiting factors for the build out of HPC data centers. One, obviously, being the power. And in that regard, the guys who have the contracts right now, who have the interconnect agreements in place, working with utility companies, these players somewhat have a jump start versus peers just entering the space. So by happenstance, a lot of the Bitcoin miners had large power contracts, so that gave them the ability to be able to convert over to HPC in manners that others just entering now have to go through the process of interconnect approvals and also supply chain. So building out these data centers requires you need generation, you need substations, you need chillers, and that's from a supply chain aspect. We do not see that really. We see it continuing to tighten. So for the players who are executing right now and already have relationships with supply chain providers, they're in a spot that allows them to execute. And then for labor shortages, that's also one of the factors that's limiting how much we can actually build out from the data center side. Going forward, this year we've seen software companies underperforming, and from our perspective is that AI is not going to be replacing or taking away software companies that are incumbents in terms of having 10 years worth of data that they're able to build on, to be able to utilize and train internal AI. However, it has been kind of spook to the market with AI increasing in capabilities. So that increase in capability has had investors questioning which are the areas of software that are going to be most impacted. So from our view is that the software companies that purely relied on UI, those companies no longer really have that as strong of a moat as they used to. However, for enterprise platforms that can leverage AI, we expect them to be able to rebound and continue to grow. From a compute hedge, though, every single software company requires compute. So that's pretty obvious. Now, we believe that investors who have a significant software portfolio would be better positioned by also owning AI HPC infrastructure names or data infrastructure names, so that that's kind of a sector that you don't have to go through the math of, okay, which sector of software is going to be impacted the most. It's one that it's the base layer of all this AI spending that should be able to continue moving and improving and growing as we move forward with the AI trade. Now, looking at some companies within our space particularly, there are two major buckets, one being the HPC operators as a whole, and 26 is really the year of execution. So towards the end of 25, it was kind of more of a pipeline conversation. What can you theoretically bring online? And there's quite a bit of enthusiasm in terms of price appreciation. It's come back a bit, and we like where we're sitting at right now with a number of our names, and the valuations are getting more grounded, right? Who are the companies that have contracts? Who are the ones who have shown the ability to have multi-site build out, and who are the ones that are able to bring these online in the near to midterm? Look at the scarcity of power. We believe that essentially any power that's brought online through 2028 should be filled by either hyperscalers or enterprises. And then in that vein, the neoclouds as a second bucket, if you will, of companies we cover, we don't view them as just a bridge. We believe that they have come to be a fundamental structural component of providing AI compute for both hyperscalers and enterprises. And from that aspect, looking at CoreWeave and Nebius, there are a few other companies that are interesting that are getting started, Sharon AI being one of them. And then we have Gorilla talking a little bit later so this ability to be able to provide that compute and then also be able to have a distributed footprint is going to be crucial as we see more of a mix. So we think that compute remains undervalued, remains a scarce component, and this increased demand from AI continues to propel the HPC trade. And we believe that names that are able to truly execute should be able to capture this CapEx build out. So from our perspective, we're looking at still early stages of the HPC play, and we are very optimistic about where the space is going. And as inference truly ticks up, we're seeing a greater mix on the application side that should be able to benefit the data center operators as they build out on their sites. So I'll leave it there, and thank you for the time.
Michael, thank you very much for that excellent presentation. Again, that is Senior Research Analyst at Compass Point, Michael Donovan. Thank you very much. All right. Up next, we're pleased to welcome Benchmark's equity research analyst, David Williams. David, are you there?
I am. Craig, thanks, and good morning. I appreciate you having me.
Please start whenever you're ready. Thank you very much.
Fantastic. Well, I didn't prepare a presentation this morning. I wanted to keep things a little higher level, so you'll have to forgive me for that. And unfortunately, I have to look at my funny looking face for the next 10 minutes. But what I wanted to talk to you today is really where we see the opportunities within the AI data center. I think there's a couple of areas within the data center stack that are yet to be fully appreciated. And while we've seen the logic and the memory side, the value there has been fully recognized by the market. We think things like connectivity and special areas of the connectivity stack, as well as some of the power management and that transition to 800 volt architecture, is where there's a lot of opportunity today that has not been priced into the market. And so there's a few early winners here that we think will benefit. And excuse me. One of the bigger constraints around the data center today, obviously, is the logic, but you move beyond that and you get into the optical side or the connectivity side rather. And for short reach applications, a lot of that is done in copper today, and that's fine. It will continue to work. We're transitioning the speeds, new technologies are coming out, and that works for shorter reach applications. But as you start looking at longer reach and we reconfigure the data center and move switches to the end of the rack as opposed to the top of the rack, this creates a real issue for the data, and it creates a bottleneck. And so we're consistently pressing the speeds faster and faster, moving from 50 to 100 to 200 G per lane, all the way up to 1.6 and 3.2 terabits. And so as we transition there are certain constraints that we have to deal with, and that is where our first name really comes in on the connectivity side is Illuma. We think they have a very interesting portfolio of products that do something that's different than what you see across the rest of the market. It is proprietary and has a very large and growing market opportunity there. And so with that, we'll kind of start in that with Illuma. And as we kind of think about that story, they developed a compound semiconductor platform based on an InGaAs on silicon that we believe is a fundamentally different technology and changes the economics of the photonics device manufacturing. And rather than building lasers and detectors on small, expensive IMP substrates where they are today, primarily at 3 and 4 inch, Illuma grows their 3.5 material directly onto standard 200 and 300 millimeter CMOS silicon wafers. And so with that, you get about 16 times the usable area of a traditional IMP substrate. But the bigger benefit here is if you free up an entire critically constrained part of the supply chain, which is the IMP substrate. And so in doing that, now you've unlocked not only performance advantages, but also a significant amount of supply that can then be scaled up. And that is kind of core to Illuma's technology, is this process kind of platform that spans across multiple markets, not just connectivity, but also in the handsets, in automotive, in industrial. So applications across all areas of the economy. So we think that's an incredibly powerful part of their story. The technology today has been validated through programs with DARPA and NASA, the US Navy, Department of Energy, and the company has demonstrated that their wafer scale integration passes the reliability screening consistent with all the standards out there today. So what we find most compelling about the story today is the commercial traction. They're gaining engagements on the transceiver and module side with ODMs and OEMs. And these conversations are centered on the production scale supply for the high-speed photodetectors operating at that 100 and 200 G per lane today, and then of course going to 400 G in time. Where the industry is really headed. So NVIDIA's recent commitment to about $4 billion to secure photonic supply chains, including capacity with optical suppliers Coherent, Lumentum, think that really underscores how strategically important this layer has become, and especially for players that have a differentiated technology that can provide performance and scalability to the market. What we think makes Illuma most attractive, really outside of just that photodiodes kind of demand opportunity today, it's really optionality for the market across the board. This same platform addresses things like the world-facing sensor on the backside of your handset, your iPhone. And we know that the market is moving, transitioning to SWIR technology today. And so that is an opportunity, I think, for Illuma specifically in the intermediate term, but also have plenty of opportunity on the defense side. And we think that that's a very attractive area across the board as we move into this rearmament cycle and replenishment cycle that we're about to enter. I think from a valuation perspective, the market's really mispricing Illuma today, not fully recognizing this opportunity across these multiple platforms. And so it's certainly a name that we would put on our radar, and it's a name we would have an interest in following. And then secondly, here will be a little shorter, but MaxLinear is another name that we think has a lot of opportunity where the market just isn't fully appreciating the successes they've had and the progress they've had. But this is really about the 800G transition. They have a really nice product on the DSP side that fits in with Vago and Marvell, its competitor there. So they're taking share and entering that market. But what we really like about the story, very similar to Illuma, is that it's not just about the data center. You're not leveraged to that single trend, but everything beyond the four walls in the data center is also an opportunity as we get the infrastructure build out and push closer to the edge. And for MaxLinear, they participate anywhere between the data center and the home, and even including your CPE equipment that sits in your closet at your residence. And so there's a lot of opportunity. We've just seen AT&T add about $250 billion in CapEx over the next 5 years to expand their network. And this is going to be a kind of a central theme we believe is going to continue over the next several years amongst all service providers, cable cos, and telcos as well. And so that's MaxLinear, I think, is really attractive in this space. New product portfolio that they're continuing to gain market share and doing very well across that market, but yet the market, at least the street, is not fully appreciating that. And then kind of moving on to that power architecture, the real theme or thesis here is this transition between to the data center where we're taking 800-volt architectures directly to the rack instead of multiple different conversion steps between the wall of the data center and then to the rack. Now you're taking the very high voltage DC directly and then to your point of load. And that is creating a rework of the entire power architecture across the board anywhere in the data center. And so we think there needs to be new technologies, new, more efficient capabilities. And our first name there is Power Integrations. We really like their gallium nitride position. They were first in the market, have a very nice, elegant solution in that market. And again, I don't think the market is fully pricing in what that opportunity is and the differentiation of that of their GaN technology, especially as we come into this next cycle and we begin to see some of these data center deployments begin to happen and transition. And then lastly, Alpha and Omega Semiconductor is a name we like for the power out the GPU, but also throughout the data center. We think there's a lot of opportunity for them. Nice new product portfolio, continuing to gain share, and margin is the primary pushback on this name. But we think those margins will continue to migrate upwards as we transition further into the data center design cycles and moving through this transition. So thanks for your time today. I appreciate your attention and happy to connect and follow up with anyone that has questions.
David, thanks a lot for that great presentation. You're finishing up just in time. In about 15 seconds, we're going to start with Guerrilla Technology. David, great to have you today, and thank you very much. We'll see you again soon.
Yes, thanks for the opportunity.
All right, our next company, our first company on today's RedChip AI Investor Conference is Guerrilla Technology, ticker GRRR on the NASDAQ. Today we're going to have two members of the C-suite with us. We've got Bruce Bauer, who is the CFO, and Rajesh Natarajan, who is the Chief Technology Officer. We're going to begin in a moment as soon as these guys get on. And yes, they are on. So we're going to read the safe harbor. Hi, Bruce. Good to see you.
Hello.
Good to see you, Bruce.
Great.
And Rajesh will be joining shortly, or is he already on?
He's on.
Okay. All right, great. Let me read the safe harbor, get that out of the way. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Bruce and Rajesh, we're looking forward to hearing what you have to say.
Thank you, Craig. And welcome, everybody. So today we're going to tell you about Gorilla Technology. So this is on the NASDAQ, GRRR is the ticker. Everyone can see my screen, I hope. Good. So we'll just get going. So Gorilla is an AI-powered provider of technology solutions in video analytics, cybersecurity, and the IoT and AI infrastructure space. We have been around for 25 years. We were founded originally in Taiwan, and we've been doing AI for over 15 years. We've grown to 200 employees and another 200 contractors across 9 countries. We have 28 patents and 3 pending. That is a quick kind of 10-second overview of us. I think the most important thing is that we are a global company. From our humble origins in Taipei, we've grown to have a presence in Bangkok, Singapore. We have a large office in Chennai, a large office in Cairo, a presence in the United States, and a headquarters in London. The reason for this is we are really targeting emerging markets and then corporates and governments in those markets. And this is where the demand and where the clients have taken us. And we'll talk more about that in a second. I'll just say one thing about Gorilla is, so we went public in 2022 via de-SPAC. The company before that was really focused on the Asia Pacific region. It had world-beating technology, but we wanted to commercialize it and to turn it into a more robust product offering. And with that, I'll turn it over to Raj, who's the CTO, to tell you more about how we did that, our offering, and then the kind of commercial wins as a result of that.
Thank you, Bruce. Hello, everyone. So as Bruce identified, we're more than 25 years old. Our origins is based in Taiwan, and since then we've actually grown globally. The essential growth pattern for Gorilla has been structured around building the right technology at the right time. And our growth over the years, as you can see from 2018 onwards, it started off with a journey of trying to figure out how to help commoditize the infrastructure behind computer vision. And that involved our partnership with Intel, and we were the first implementation of OpenVINO in that particular industry. And since then, we have been further hardening and strengthening our story around edge compute and edge AI. And that's actually saw us, once we completed our de-SPAC and became public, we landed up winning our first largest deal in the history of the company for north of $270 million. And this is about building a governmental air gap network, which is a case study that we'll talk about a little later today. 2024 and 2025 for us has been primarily focused on how do we establish a solid base from a revenue growth and margin realization perspective. And that has been very important for us from the very get-go. It also saw us strengthen our entire partnership portfolio so that we have select manageable partnerships with folks like Red Hat, Synchronous, MCS, ACOM, so on and so forth. And leading up to 2025, you saw our revenue grow 90% year over year to 39.3 million in the first half of 2025. And this was all an accumulation of certain major contracts that we actually won in Asia. And similarly, at the same time, we also managed to raise $105 million in equity. You also saw us in 2025 announce a $1.4 billion the data center deal with Freyr. And we also strengthened our partnerships further in that region with Wacom, Quanta Computers, and NVIDIA in general. Next slide, please, Bruce. So if you think about Gorilla and what we do, there are three broad categories in which we function. And I'll start from right to left just because it helps me tell the story a little better. Cybersecurity has always been a strong foothold for us. We specialize in providing cybersecurity solutions to governments, heavily deployed in Taiwan, heavily deployed in Egypt as part of our air gap infrastructure. And there's a lot of stories for us to kind of go ahead and build on. You saw us announce earlier this year our new SD-WAN solution, which is post-quantum ready, that falls into that particular bucket, by virtue of which we are helping disjoint branches connect securely instead of just trusting traditional VPN solutions. Video analytics, which is in the center, has been our bread and butter. That is something that we've been doing for a better part of 19 years now. That ranges from a slew of programs that we support, which is from a policing perspective, people tracking, suspect identification. From a smart city perspective, we talk about smart parking lots, smart signals, traffic violation detection, so on and so forth. Smart factories for inspection utilization, also trying to see how we can actually safeguard the security constraints of physical security constraints of factory floors. People are wearing PPEs, or people gathering or congregating in areas they shouldn't be congregating. These are all the fundamental use cases that we actually support. Now, in order for us to be able to do this and be able to stitch a whole slew of data together, big data infrastructure is extremely critical for us. This particular solution for us has actually seen a tremendous amount of growth for us. Like last year, we also announced that we are building Taiwan's first 5G lawful interception capabilities, which is a huge big data infrastructure problem domain for the governments and the mobile operators as such. And Internet of Technologies is fundamental baseline because a majority of our AI programs run on collecting data from various different sources so that we can actually consolidate, correlate, find patterns in them as such. Now, all of these things really don't come together if there is no compute environment in order for it to function. When we started off back in the day, we were a pure play software company. Pretty soon we realized that marrying software and hardware was not an easy problem for our customers to solve. And you've seen the evolution of Gorilla take place over the last 4 years, going from a pure play software company to an appliance company. And basically, as we started creating these appliances, we also realized that many of our customers, they do not have the expertise to actually go out and build a data center for themselves. And so most of our solutions involve us actually building special purpose-built data rooms, data centers for our customers in order for them to make sure that they're getting the maximum mileage out of the software and the technology groups that we actually provide. Next slide, please. So the way you should think about our solutions is we go end to end. And the main idea behind this is twofold. One is customers are not coming to us and talking to us about one problem. When you really spend time trying to understand their particular problem domain, what really sticks out to us is that their problem domain is not just identifying if a person is wearing a hat or not. The problem domain is much more broader than that. It has got a security constraint or a physical security constraint bound to it. And that means that from the time that individual walks into the company to the time that the individual walks out of the company, there's a whole storyline that needs to get stitched together. This basically means that when we look at these solutions as a whole, we have to look at these solutions from a stack from bottom to top. Now, whether that is a AI compute using GPUs, whether that is securing communication boundaries using SD-WANs, securing the actual network using our cybersecurity framework, and more importantly, how do we help the customer manage the solution once we have deployed it? And that's typically where most of our customers in the past tend to trip over themselves on. Right? It's great that you have this great AI infrastructure. Many governments that we work with, the individuals over there do not have the sophistication to understand how these systems work. We train them, but then again, maintaining, managing, if something goes wrong, how do we kind of circumvent any short circuits that could exist in that particular system, basically continues to require our expertise. And we tend to support that customer and all of our customers through that entirety of the life cycle. Next slide, please. So talking about life cycles, I think it's very important that our life cycle has to be integrated into the overall story as such. And that means that from early design and planning phases to deployment and integration, and then how do we optimize the overall solution from an operations perspective? And each of these phases basically take us through how do we actually get to ROI with our customers quickly. It's great that they have a 12-month schedule. It's a real bad idea for our customers and us if we wait for 12 months to figure out the system was not configured or set up the way the customer expected it to be. And sometimes those expectations change, as the projects actually progress. So faster deployments, the sooner we can actually demonstrate ROI, sooner we can collect feedback from the customer, sooner we can actually understand if the customer's needs, as they had identified earlier on, are still consistent after they've seen the first round of ROI returns that they're actually seeing that, right? So it's very important for us to get that fast deployment going. A majority of the solutions that we deploy, they involve collecting large volumes of data. They involve us collecting large volumes of video footage that's captured from different CCTV cameras that they've actually installed in. And that means that the networking bandwidth also has to be properly and effectively managed for us. And of course, the more we can automate this particular infrastructure for them, we can actually make that infrastructure a lot more cost effective for them and as an end game from an overall OpEx perspective. Next slide, please. So a lot of my customers come and ask me, right, well, like, what's the big difference in between you and a traditional cloud provider? And I think there are a couple of factors that are very important. One is we deploy sovereign infrastructure. So if we went to the use case that I typically like to use is the one in Egypt, where we're building this air-gapped network for the government over there. It's a sovereign infrastructure. That data does not leave that data center. Anybody who wants to connect into that particular system has to connect through our network, through our security foundations that we've actually provided. So there is no notion of multi-tenancy that people have to worry about, that if one tenant gets breached, can the other tenants get breached as well? The second thing is that most of our data centers are not general purpose data centers. They're actually purpose built, which means that if governments want to go ahead and do model trading, they want to do large data processing, and the data center is actually purpose built. We have the right compute modules for them, the right GPU acceleration that they need. So it is tailored to the solution that they need. And that's where the customization capabilities that we actually expose for our customers actually come in pretty handy. And because it's custom built, the CapEx, the OpEx model is very, very, very well understood. It's not like, I'm signing up for a new large language model with a cloud provider, and I'm trying to sit there and count tokens and trying to figure out if I'm still within my token capacity or not. Just, bracing for the fact that, the next cost overrun that comes through, my CFO doesn't come banging on my door with an axe. So essentially, how do we actually make that operational cost well understood, well defined? And the only way that we're able to do that is to make sure that the purpose-built facility is actually scaled to the needs identified by the particular customer, and that's a key thing. And of course, deployment speed. We have over the years created a number of patents and practices, which actually makes us or allows us to deploy really rapidly, so that we can actually ensure that that time to market aspect for our customers is actually being met. What that really means is that we have standardized templates, and we can map those templates to specific hardware configurations. So whenever we go identify and size a particular customer, we pick a template from our system, deploy that particular template, and we're off to the races. Off to you, Bruce.
If I may add one thing,
Yes.
Raj, on that is also this model has two key differentiators with a neo cloud or a cloud. The first is that we don't build massive scale and sort of build it and they will come. We're not hoping that the customers come. We're only deploying CapEx when we have signed up a customer and it's purpose built for them. The second advantage to it is obviously this is much stickier than a sort of undifferentiated cloud offering, because it's purpose built, it's dedicated to their needs, it's their infrastructure. There is the option for them to renew at the end of a fixed term contract, and the switching costs become extraordinarily high when it's purpose built and custom designed for your needs. So maybe it's not as it won't get to gigawatts and gigawatts like some other players, but it is a much more secure kind of de-risked business as far as we're concerned. In terms of the data centers where we front the CapEx, this is a stylized version of the cash flow profile. So there's a high initial CapEx, but then it recoups in the first 3 years. We fund these additionally through project finance, not through sort of general debt. So it's non-recourse to the parent company. There is an equity contribution from Gorilla, which is a fraction of the overall project cost. And then after year 3, basically we own the infrastructure free and clear. So we're collecting year 4, year 5, and onwards cash flows, and also we have the asset value. So this is a business model that we think is quite scalable, and then it also is it's suited very much to the purpose-built nature of the infrastructure, right? If a client signed a 5-year contract, it's a binding contract, take or pay. They're not going to switch, and they can't switch. And if they do, they have to prepay our loan. Raj, would you like to take this case study?
Sure. So this is a very interesting and challenging case study for us, right? This is part of the deal that I mentioned earlier on. That was the single largest deal in the history of the company when we won this deal in 2023. Over here, the core requirements for the customer were actually to create a safeguard, safe haven network through which all governmental communications, their emails, their video conferences, their chats, their document storage, etc., everything was going to be centralized in this particular system. Now, the interesting aspect over here to add on to our worries was that the president of the country was actually going to be using this particular system. So which means that the president's not going to sit in his office all day long, and neither is his cabinet or the rest of his governmental entities. To make matters worse, these governmental entities were actually distributed across 32,000 sites. So outside of creating this particular network, we had to deploy our cybersecurity capabilities through which we could actually enforce secure communications, lockdown communications in between mobile phones and that particular network, laptops and that particular network, and control the surface area of risk over there. So that was one side of the challenge. The second side of the challenge was essentially we have 32,000 branches of this particular government that we needed to connect back into this particular network. A huge challenge. And interestingly, we solved this particular challenge. It was the single largest, single shot SD-WAN deployment in the history of the world until that particular time, right? We were the first company to actually build and deploy an SD-WAN solution to 32,000 sites in one shot, turned it on, and the system worked flawlessly. So I'm particularly, like from a Gorilla and the tribe perspective, I'm really proud about what we actually achieved in this particular project, because it was certainly us flying above our weight level from perspective of where we were at that given point of time. And it's certainly on the heels of this particular project that you're seeing the growth, both from an innovation cycle perspective, opportunity perspective, and the kind of deals that we're chasing as well. Many of that comfort zones that we are existing in today is actually based on the foundations that we actually established through this particular project. So we're really proud of this. Bruce?
I wanted to highlight quickly the management team. So Jay Chen and CEO and Raj CTO. So Jay has 30 years of experience in the tech business. Raj 20 plus years at Microsoft leading product development. And also wanted to highlight Thomas Sennhauser, Jackie Wang, Satish Venkatesan. All of them have 2 decades plus in the technology business. So that does 2 things. The first is, this is a very experienced management team who's really turned around the business. So Raj and Jay joined in 2022, and they've really turned around the business. We can see the quantified impact of that in a second. But all 5 of them are experienced, and basically they can sit with potential customers, talk about what the customers are trying to solve for, work towards a solution quickly, and then basically 98% of the way there in terms of the economics and how the solution works. We don't have committees and countless kind of people who are mobilized in the background to make a proposal happen. We can quickly go work with the customer to get to a solution, and this is the team that does it. So what is our sales strategy? Is we put potential clients in front of these 5 people and let the magic happen. In terms of the track record, so I think the team has already distinguished itself in terms of the track record so far in Gorilla. So when they took over in 2022, revenue was a bit over 20 million. Last year, the final number was 101.4 million. So nearly 5 times growth in that period. The guidance for this year, I'll touch on in a second, is 170 million is the midpoint. So that growth rate is already, accelerating into this year, and then the numbers are getting bigger. There's also been a substantial turnaround from an operating loss to adjusted EBITDA net income positive. So, hats off to the team already, and I think that we're building on this track record as we go forward. A couple of things. So the guidance for this year is 137 to 200 million. I know that sounds like a wide range. That's really due to the timing of several of the contracts that we have signed, when they get delivered and turned on, but we're confident that it'll be within that range. We also have a backlog of 85 million for this year. 85 million means where we have a contract that's signed. We know the amount that is coming in and the date that it's coming in. So this is mostly work that we signed before and we're implementing on already. So we have a high degree of confidence in this guidance. We've highlighted this figure before of $7 billion in qualified leads. That is our pipeline. This is substantially in the data center space where we are talking to many clients, potential clients, where it's a multi-$100 million revenue opportunity for Gorilla. That doesn't happen over 1 year. That would be sort of 3 to 5 year contracts. Nonetheless, I think you should have confidence in this pipeline. We announced on Monday a deal with Yota, which is a large data center player in India, for $500 million over 5 years. The timeline for that to be deployed is as soon as possible. So I think that should quell some of the skeptics out there about is this pipeline converting? Well, yes, it's converting, and then hopefully we'll have many more announcements to make this year. Last thing is I wanted to point towards 3 kind of contracts that we've run recently. So the first is a $1.4 billion contract with Freyr to deploy data centers for end clients across Southeast Asia. So this is it's made up of several sub deployments as part of that overall umbrella contract, and all 3 of those were at work busily. But Yota will actually be the first one that gets delivered because there is some urgency from the client. And then also NVIDIA, if you saw the news recently, they were in India a few weeks ago, and they want to make it a priority as well. So we figure it's good to work hand in hand with NVIDIA. And then also, last but not least, we have a couple of wins last year in Asia Pacific, as Raj mentioned, in law enforcement and in lawful interception space. So the traditional business, the security convergence business is actually growing quite nicely. But the data centers have really taken up, have stepped up to a new level in terms of opportunity, and we're seeing many $100 million plus contracts in that space. With that, I'll wrap up the presentation. We were given a few questions to answer, and we'll just kind of dive in. The first was about YOTA. So Monday's YOTA announcement was a major development. How should investors think about the scale, economics, etc.? Very simply, so I'll go back to this slide about how the data center economics work. So we see the initial capex as $300 million. That goes out day one. And then we have a 5-year contract with the customer. That 5-year contract is for $500 million overall, so $100 million every year. We look to start as soon as possible. And basically, that would be about 80% covered by project finance, 20% covered by a check from Gorilla. So, 20% of 300 million is 60. So we can cover that from the cash on the balance sheet, which is 110 million as of today. And then we look to repay the project finance at the end of 3 years. And after that, the year 4 and year 5. And then any subsequent renewals or the resale of the assets would generate a substantial return for Gorilla. This is the kind of project that we have massive interest from customers to do, where we front the capex and we deliver the solution, we manage the solution over time. Raj, anything to add? I see.
Yeah, absolutely. So I think, purely from a scale perspective, this is a very significant agreement for Gorilla. And what it really means for us is that, the announcement talked about the fact that we are covering roughly 640 NVIDIA HGX B200 servers, which actually represents more than 5,000 GPUs. And Bruce also mentioned the fact that this is going to contribute about $500 million in revenue over 5 years to us, right? So put simply, this is not an experimental deployment. It is meaningful. It's long duration AI infrastructure program with real economic weight. So, in my humble opinion for investors, the right way to think about this is both has a major revenue opportunity and a strong validation of our ability to execute on complex, high-value AI infrastructure programs. It materially expands the scale at which the market should evaluate Gorilla.
Absolutely. And then I think, Raj, is it safe to say this is basically an extension, but with bigger numbers of everything that we've been doing over the last 25 years, right? This
Correct.
is not a new business line for us. This is the same thing that we've always been doing, but maybe expressed in a slightly different customer use case and then with a different financing profile.
Absolutely.
Good. And then in terms of how across AI infrastructure, cybersecurity, video analytics, where do we see the strongest commercial momentum and strongest customer demand?
So, I think it's important for us to kind of take a step back to respond to this question, right? Because historically, many of the investors have known about Gorilla through our work in cybersecurity or video analytics and smart city platforms. And those remain still very important from a core business perspective. But what's really happening right now is that the momentum in the industry is still consistent in traditional fields like building smart cities, building regular AI infrastructures. The reason why some of the equation seems a little lopsided is because these things called GPUs, they're not cheap. And when you deploy them at scale, you're talking about 5,000 GPUs or 10,000 GPUs. The capex cost skyrockets pretty fast, which means that the revenues associated to them also skyrocket pretty fast. So while you look at the numbers that we're talking about, and it looks like, hey, this new data center business it's the hot thing at this given point of time, it's very important for us to realize that the scale of investment in AI is very different from the scale of investment in traditional smart cities or cybersecurity programs. And the way we control that is purely through the experience and the expertise that we've actually amassed over the last 25 years. And it's just a capitalization on that investment.
Bruce, Rajesh, thank you very much for taking those questions and for your excellent presentation. It is now 10:30, so with your permission, we're going to shift to the next client. And if that's all right with you, gentlemen, thank you, Bruce, and thank you, Rajesh.
Thank you all. Bye-bye.
Thank you. Thank you so much.
We'll see you again soon. Gorilla Technology, NASDAQ, GRRR. Chris, is that you?
It is me. Hi, Craig. How are you?
I see you, Chris. Good to see you. We now have on our RedChip AI Investor Conference Comprehensive Healthcare Systems, ticker CMHSF on the OTCQB, and CHS on the Toronto Stock Exchange Venture, TSX Venture. Presenting today is our good friend, Chris Cosgrove, who is the CEO of Comprehensive. We'll begin with Chris's presentation in a moment, and then, of course, we'll open the event to your questions. We're going to keep your lines muted throughout the presentation, as we always do. But if you have a question, you can press the Q&A button around the bottom of your Zoom window and type your question into the text box. We'd love to hear from you. Before we begin, please allow me to briefly read the Safe Harbor Statement. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. With that out of the way, we give the floor now to Chris Cosgrove of Comprehensive.
Craig, thank you very much. Good morning, everyone. Once again, my name is Chris Cosgrove. I'm the president and CEO of Comprehensive Healthcare Systems. What we plan on doing today is what I'd like to do is introduce you to our company, talk through some of the growth drivers that we're seeing today and currently experiencing, how we've transformed the business. I've been the CEO for the past 4 years. I've got a background in healthcare for over 35 years with companies like GE Healthcare Systems, as well as McKesson, helping leading their technology businesses, as well as some small venture capitalist companies that we were able to take to successful exits. So we'll talk a bit about that. We'll then introduce you to CHS. We'll talk about our pain points, what we're doing with AI now within our product to help engage with the members that use our product, who our key clients are, what the competitive market looks like, and the market opportunity around that. And we'll do a little valuation benchmarking with some of the industry peers, talk through some of the financials, and conclude and see if anyone has any questions. So that's our plan for today. So when you take a look at Comprehensive Healthcare Systems, we're a leading software as a service technology-based company. And what we do is we provide a very sophisticated, comprehensive modular software platform that you'll hear me refer to as Novus 360. And we provide that to self-insured employers, unions, and third-party administrators, which manages all of their healthcare and pension benefit programs. Okay, and I'll talk a lot more about that. But we are a leader in this space in the healthcare and retirement benefit administration market. Today, from a revenue size perspective, we have over $25 million worth of revenue under signed contracts that extends. We just added a couple brand new clients, so it's about 23 clients today, with 90% of our revenue being recurring. And we enjoy about a 95% customer retention rate within our current client base. The overall addressable market for CHS is somewhere between 4 and 6 billion US. Our platform currently supports over 1 million members across both health and welfare, as well as retirement plans. When I first started, there was a little bit of work to do with regards to reorganizing our company, both on the growth side, but most importantly on the operational and development side. We've completed that restructuring, and we're currently ready to scale, and we anticipate having an exit revenue run rate of 10 million USD by the end of the year. Even with all that success, we currently have a very low valuation. We trade less than 1 time our 2026 revenue projection. And a couple of our peer group private companies in this space have been acquired by private equity, and we're seeing some of those transactions priced at well over 7 times revenue in the private market. So obviously there's a potential for a significant valuation re-rate, and we just had some really successful news at the end of 2025 where we signed a multi-million-dollar contract with Amalgamated Life Insurance Company out of Westchester County, New York. And this is significant not just because of the size of the deal, but we took our largest competitor's largest client in the space. So we're enjoying a lot of the ripples of that effect in the market today as well. Okay. So what are the growth drivers for the business? So if you take a look at our revenue in 24 and 25, relatively flat, although the growth really, our focus on growth after the operational changes we made started in 25. So we're finishing this year around 4.6, 4.7 million. We expect to be at 10 million by 2026. That growth coming from both organic growth and deals we currently have in our pipeline, some M&A activity that we're focusing on as well, along with branching out into adjacent verticals. And I'll speak to what the other verticals, where we focus today and those other verticals that we can start to play in. And with that growth, you'll also see the ability to drive additional EBITDA. And at 10 million, we expect to be at about $1 million worth of EBITDA annually. So how did we transform comprehensive healthcare systems? So yesterday, the company was founded in 1998 by a vascular surgeon who ironically was also on the board of a commercial payer. So our chief architect of our product really knew the market, and he architected a highly functional, super competitive product. However, from a business perspective, it was operated as a small family-run business, with limited investments, especially when we started to get to migrating from client server-based to cloud-based technology. The company started to experience high cash losses. The revenue was stagnant, and they had limited growth opportunities. So today, I was hired 4 years ago. We've got a professional management team. We offer a fully integrated, what I like to call cutting-edge technology platform called Novus 360. I talked about where our current signed contracts are today. All of our new contracts are 5-year annual recurring agreements. We signed a game changer. We potentially have some others in the pipeline as well. And where our exit revenue is planned to be at 10 million. Where we believe we're going to be by 2028, we expect to have 100 million in revenue under contract. We're incorporating AI today into our technology stack, which includes engagement tools, workflow engines, as well as data analytic tools. We're increasing our penetration today in the United States, scaling up through adjacent verticals. And the idea here is we want over 5% of our customers' total wallet spend through our organization. So that's the goal right there. So how does our product work? So we're managing essentially healthcare benefits or health insurance for organizations that self-fund their healthcare and pension benefits. So there's two models in the United States. So one is a commercial model where you use Aetna, United Healthcare, Blue Cross Blue Shield as an example. The second model is when employers, unions, other organizations that are providing benefits to their employees say, you know what, we don't want to pay premiums, it's getting too expensive, we're going to do it ourselves. So they put a fund together to help fund all the healthcare spend within their organization, and they'll either hire us and use our software to manage those funds and all those transactions, or they'll hire a third-party administrator and who would use our software to manage that employer's fund. Okay, so those are the essentially the two models within the self-insured healthcare benefit space. And that's what we support, whether at the employer level or at the TPA level. So what are the pain points in our market today? So this what I call the benefit administration continuum is highly fragmented. So when we go in and start talking to prospects, they're using multiple systems. They've got some services wrapped around it, and they don't really have, from a data perspective, that single source of truth technology that's driving ultimately their entire business. So that's what we do. We're that single source of truth. So where there's manual and paper-based processes still, and if you can believe it, doctors are still faxing claims and prior authorizations to employers to get approval, we automate that. These compliance requirements. So we work with a lot of unions. All of those unions are federally regulated by the government to use technology to manage their health and welfare funds. However, those compliance requirements change regularly. So how do we help them manage that? The data has been all over the place with really poor integration. And while they're doing this, they're kind of keeping their eye off the ball relative to cybersecurity and privacy. And they've got claim data, so that's HIPAA compliant data that we help them manage. What's important is whether you're a union and or employer, you need to communicate internally, but also with your employees or members. So those gaps are very important to close. And then, through all of that, how do we manage cost? And essentially, those are some of the key areas that our Novus 360 platform is able to handle. So here's our business model. So if you look at the circle on the left, we start with our Novus 360 platform at the top circle, which is our benefit administration software solution. So here, if any of us on the call today have insurance, it starts with enrollment. So we have engagement tools that allow the members to enroll in their benefits online, upload all their corresponding documentation to ensure that they get approved for the benefit coverage that they're looking to really achieve. From there, we manage all the contributions from the employees, the money coming in, all the accounting, all the eligibility. So if I've paid into my plan, what am I eligible for on the plan that I've purchased or am getting from my employer? If they go on COBRA, disability, we're not paying, delinquency, all of those different components our platform manages. When they go to the doctor and the doctor codes a claim, which is the bill, and sends in to the employer, our software adjudicates that claim and can automate up to 70% of that claims adjudication process, so it arguably streamlines the process. We do all the analytics. We do all the digital engagement with the member. And for retirement plans like annuities, 401ks, or pensions, our software automates the administration of that process as well. So that's essentially in a fully integrated system what we do. However, we're also a third-party administrator, so we're licensed to actually do the work to administer the plan, not just provide the technology to do that. And our software runs our TPA. We do price transparency to support the No Surprises Act of 2022 that states that any provider of healthcare insurance or healthcare services needs to show cost to the patient prior to going for service. So our technology brings in all the machine readable files. And if I want to go to NYU Medical Center and have my knee scoped by Dr. Smith, I can go onto this tool and it'll tell me, based on my plan, the cost of my procedure will be $20,000 and my out-of-pocket responsibility will be $1,000. Okay, so it's that to that level of accuracy and detail that we show price. We do utilization management as well. So we have a clinical team that does prior authorization and medical necessity checking. So just because you have healthcare insurance doesn't mean you can go for Botox as part of your plan for a cosmetic reason. And so those requests from the providers, since they're not using commercial insurance, those providers would send in requests for prior authorization or medical necessity to our clinical team. And our software helps automate all those requests and approvals or denials going out. And we're also a managed service provider, so we can manage the technology. But essentially what we're doing is, in a very fragmented market, as I mentioned, we are using software and technologies to automate the benefit administration continuum. And our clients are life insurance companies, they are third-party administrators, they are Taft-Hartley unions predominantly that all self-insure and are governed by the federal government to use technology to manage those funds. And the real beauty of that is that in these markets, this is a need to have technology. So I mentioned I work for GE, I work for McKesson, some Fortune 5 companies. Never did we have a technology that was need to have. So I don't have to tell or try to convince someone why they need to buy this product. It's just why they need to get it from us, which is a very unique position to be in the healthcare technology space. So where does AI fit in all this? So I talked about what we do. So a couple of key areas that we're focusing on leveraging AI for starts with digital engagement of the employee or member, okay? So right now, a lot of phone calls coming in. Healthcare benefits can be complex. What am I covered for? Who can I go see? What is my coverage? How much do I need to actually contribute every month to my plan? What does out of network mean versus in network? Why am I paying more for one versus the other? So a lot of questions. What's my pension going to look like when I'm 65, right? So these currently require a phone call to a benefit administrator or a call center agent. So when you start to put and leverage AI on the front end of our platform, first, you start providing those employees or members with a 24/7 interactive approach to get questions answered and get information provided. Okay, so what it does is essentially starts to simplify this complex process. Okay, and we're using some plain language guidance and conversational support through these chatbots. And then what that allows them to do is quickly, whether it's on a Sunday night or a Saturday afternoon or a Tuesday afternoon, allows them to better understand it quickly without having to make a phone call, and then they can start making decisions on their plan immediately. Okay, so it actually moves the whole enrollment process, which that one time a year in our business, which becomes really complicated and becomes very busy. It actually starts to streamline that whole process and gets people enrolled on time and more complete with all of the different documentation submitted in a timely fashion. Drops off calls and helps align with policy that gets communicated to the member. So a lot of key value at the member and the person level, which is where the market is really headed, to this digital engagement front end as people try to navigate this healthcare benefit environment. Okay. So what it also does is create this digital front door for members. The operational efficiency is key, the better insight with the analytics. So people can start to understand what are the questions that people are asking, and then figure out how do we proactively try to get better information out to the membership. So the insights are really invaluable. And we start to pitch it as, this digital first type of approach to drive member satisfaction. And that's, in our pilots, that's what we're starting to see it do. And that's one of the keys for all of our prospects and clients, is to ensure that their employees or union members are satisfied with the services that they are getting. So we're just not stopping there. So that's our first AI initiative. The second is with what we call our CHS Conductor AI native workflow engine. Okay. And this helps in a lot of ways. So imagine, when you're managing and you have a technology platform that manages, what's a pretty complex environment with healthcare benefits administration. Okay. So here's where we're leveraging AI to allow a much more streamlined approach to configuring the rules within the system. Okay. And not only for us to do it, but it allows our client to interact with the system and change a rule. So here's one example. So we're getting out-of-network provider claims are coming in to our client, medical claims, and those are going to Peter today. Okay, well, Peter is out sick. Uh-oh, we're getting 1,000 claims a day coming in. Who's going to respond to those claims? So if I'm working at the client site, I can go to the workflow engine and very easily I could code it, but instead I'm going to use the LLM and type in, today for fund XYZ, I need those out-of-network provider claims to be rerouted from Peter to Paul. Okay, it's a very high-level, simple example, but when they type it in our natural language, the system automatically from that LLM codes it into Java, which is what we're using, but it could do it in C++, it could do it in HTML, whatever the language might be. It sends that right into our Novus 360 platform. That workflow gets updated in our system, gets reflected in a dashboard. So now Paul is going to see all of those out-of-network claims get routed to his work queue inbox for that day or whatever scheduled period of time we need to route those to him. So it's now using the English language to allow our clients to start changing workflows or changing the processes that they need to modify within their systems today. I will tell you that the response in the market has been overwhelming for us launching this product. Number one, for the large client we just sold, this was part of the contractual agreement because they really wanted it, because we're managing 22 clients for them. So the workflows are really key. They're going to have about 500 people interacting with our system daily. However, I just positioned it to another very large client out in LA, and they stopped, their jaws dropped and said, imagine how this can change how we're, performing daily tasks today. So simplistic in how you can work it, but extremely sophisticated with how it modifies and updates our system. So that's a very high level of how AI is going to affect both this workflow component, as well as the AI chatbot as well for digital engagement. So who are we selling to? Who is our client base? Just to get into a bit more detail, we've been in the market for over 24 years. Our longest client has been with us for about 22 years, 22 of those 24. And we started in the Taft-Hartley union space. That market self-insures. It's federally mandated that they have technology. So what a great place to start. The only challenge within this market is, unlike a regular employer like an Amazon that may have 1 million employees, but it's one employer, it's one set of eligibility rules. When you work with, let's say on this list, Local 804 funds, that's a Teamsters union managing about 250 UPS trucking companies and their employees. Every trucking company has a different set of eligibility rules. Every trucking company has a different set of pension rules, or could. So your software has to have the ability to manage what's called a multi-employer environment. Because of that complexity, there's not a lot of competition in this space. Okay, when I go to the benchmarking, we'll kind of talk through that, but you'll start to see, why did you get into union versus selling to Amazon? And that's kind of the reason why. And it's federally mandated that they need to have that technology. So we work with Amalgamated Life Insurance Company. We work with unions and their funds, health and welfare, pension, and all the different funds they have. WAPA, they sell life insurance to the federal government employees. CIR at the end, that's the Committee for Interns and Residents. That's a national union managing all of those clinicians, and our technology is managing the benefits and the enrollment and pensions for all of those employees. So it just gives you an idea of the type of clients that we're currently working with. And what's nice is when we look at adjacent verticals, well, where do you go from here? This is the most complex. So everything we do from here is downstream is going to be a lot easier for us. Okay. So when you look at the competitive market landscape, and you see in the first column on the left, the benefit administration software as a service, with comprehensive, we being at the top, there are some niche players in that space, but we call them niche because that's all that they do. Then there's some that are TPAs, there's some that do price transparency, some that do medical management or financial recovery or pharmacy benefits. But really, the idea here is that we're, if not one of the few, arguably one of the only that has the ability, leveraging technology, to bring this full suite of comprehensive services to our clients. And what that allows us to do essentially is, we're not just selling a software widget. We're coming in, understanding their environment, what are their challenges, what are their strategic imperatives, and through the additional capabilities that we provide, we're able to propose a complete solution to them. And that's another thing that differentiates us in the space, which they look at as vendor consolidation. It provides them that single throat to choke. And, that's very well received in the marketplace. So it's always a good idea to do competitive benchmarking. And so here, you look at just what the market opportunity might be. And as you can see, we talked about somewhere between 4 and 6 billion across union, third-party administrator, self-insured employer, national and government pension administration, and others, government, hospital, payers, are all in play today. And then benchmarking, I had also talked about the fact that our competition that has been acquired by private equity, we're seeing those acquisitions being done at about 7 times revenue. Upper right-hand corner, Bridgeway is one of those Examples where 2 years ago Basis was acquired by a PE firm, and it was acquired, as I understand it, for about 7x revenue. And their valuation, with a revenue of about 50 million right now, is between $4 and $500 million.
Chris,
Yeah,
I'm terribly sorry. I hate to interrupt you, but we're coming right up to the top of the hour. So,
sure.
unfortunately, we're going to have to leave it there, but we very much appreciate your presentation. RedChip, of course, works with comprehensive healthcare systems, and we are going to have a live webinar with only comprehensive coming up in the next several weeks. So that will give investors a great opportunity to learn more about comprehensive. You can also call us at 1-800-RedChip or write us at CMHSF@redchip.com. Again, Chris, I apologize for having to cut in there, but I do appreciate your great presentation. Thank you very much.
Thank you for your time, and I look forward to hearing from anybody. Thank you.
Thank you very much, Chris. Thank you very much. Comprehensive Healthcare Systems. Thank you. Okay, our next company on today's RedChip AI Investor Conference is Lantern Pharma, ticker LTRN on the NASDAQ. With us today is CEO and President Panna Sharma. Panna, are you there? Okay, we're waiting for Panna to join us. Panna?
Good morning.
Good morning, Panna. And we see you have your presentation already up on the screen. We are ready to go if you are.
Absolutely. Thank you.
Well, let me just read the safe harbor statement very briefly. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Panna, go right ahead.
Thank you very much. Appreciate everyone's time. I know today's major topic is AI. I want to highlight how Lantern Pharma is using AI and artificial intelligence for good to really develop potentially breakthrough new medicines in cancer. Last year, we dosed over 100 patients in our trials, actual clinical trials, with drugs that were developed, advanced, and targeted using our AI platform, Radar. We've brought down the average amount of time to bring a new drug to an actual human clinical trial by 70 to 80%, and we continue to smash that timeline even further. Let me walk you through some of the ways in which we do that. First and foremost, in cancer, and actually many diseases, it's best to understand what are the biomarkers that are going to indicate that you'll get a good response. AI is used in our platform from Radar to do that, and it increases the likelihood of clinical trial success. Not only have we done that, but we've actually also now published on it, and a lot of the findings from our AI about which patients and which types of cancers and which mutations specifically would respond to our drugs are now true. We had 63 patients in a trial that ended last year, and the patients that were predicted to do best were in fact the ones that did best, the patients that had DNA damage repair mutations like CHEK2 and ATM and BRCA. We can also now predict what patients should be included in future trials. That's very important because that increases the likelihood of later stage success and also focuses your group that can cut down dramatically by 30 to 50% the cost of doing a trial. So we've seen a lot of success. We have over 10 programs that we've launched in the last 2 years that are actually in trials doing phase 1 and phase 2. And our business model, which is important to take a step back, is why are we using this AI-driven business model? Number one, we can find drugs and put them into trials quickly. We've done that now in a phase 2 trial that's focused on never smokers. We'll have some data coming out later this month on that. We can also develop totally new drugs with new interesting mechanisms, which we've also done with LP-284. And in fact, in that drug, we got a complete metabolic response with one of our patients. And again, that was predicted a year and a half earlier by our platform, and it was great to see it proven in the lab. But even that is not enough. But when we saw it with the patient, that was pretty phenomenal. We also do it not only for ourselves, but we've seen a lot of interest from other pharmas to use our platform. It's difficult to put together an operational AI platform at scale. And so that's a very different skill set. It's one that's very unique at Lantern, where we have both the discipline of drug development in addition to the discipline of creating large-scale AI systems. Now, the focus of these areas is to really get us to targeted clinical trials, whether alone or with pharma partners, and then to license those drugs or assets out. And that's what we've been able to do successfully. This is our pipeline today. As you said, we've got a phase 2 trial. We've got 3 trials that are now entering phase 2. This just completed. And these are all in very, very specific precision indications. We also got fast track designation in TNBC. In addition, we also created a totally new company using our AI platform. And as you can see, a number of orphan designations, number of fast track designations. And this entire subsidiary would not have been generated if it were not for our AI platform. And this is all in brain cancers. We plan on privately or publicly financing this company in the future. And we expect this to be very exciting because it'll be very, very focused only on brain cancer. It's called Starlight Therapeutics. And we'll hear more about this as this year progresses. We recently got a approval for our phase 1b, phase 2 study. And again, this is not theoretical. This is actually a drug that's been manufactured, that's already been put into patients, and is now progressing both in adult and also in pediatric brain cancers. We also have collaborators, other companies that are beginning to use, other institutions that are beginning to use our platform. And that's also very exciting because we have equity in Actuate Therapeutics, we have IP rights, and we have development rights. So our platform is really being used as currency, not only to help us compress the timeline and accelerate and discover new things, but also do it for others where we then take equity or payment, which is very great. Now, let's talk a little bit about our platform. Our platform, we've really developed it as an integrated experimental biology platform focused in oncology. I know the slide says 200 billion. It's probably approaching something now closer to 500 billion data points from our own studies, from studies around the world, from publications, from public sources, with hundreds of algorithms, many of these running all the time to kind of look at different topics that are of interest to us as an oncology drug developer. We've used these data and the algorithms, and more importantly, these capsules, as we call them, to create modules that are absolutely essential in drug development. These modules help us discover mechanism of action, prioritize disease indications, determine optimal drug combinations, generate signatures, characterize specialized attributes, understand binding site interactions, discover combinations. So all these are essential for drug development, and these are all things that our team has done over the last few years, but not only just for ourselves, but also for other companies. We're typically recognized as one of the top end-to-end AI drug discovery companies. It's a great time to hopefully get into the stock at, with all these this current depressed macro environment. But very importantly, we're not just a drug discovery company using AI, we're actually in trials. We've published 2 platforms. I would urge you guys to take a look at it. We'll do a quick demo here later in the presentation. We have an integrated molecular characteristics platform called predictbbb.ai. Urge you guys to go look at it. And it's just the beginning of first in a series of transformative platforms. The next one we released is called With Zeta. Again, we'll demo that here today. And With Zeta is a co-scientist. And again, you can go to withzeta.ai and learn more about it, but it's a multi-agentic platform that leverages large-scale recursive reasoning through all of our data and all of our modules. And so it's trained on really being a top co-scientist in rare cancers and cancer broadly. It is the largest curated database in ontology in rare cancers in the world. It's built on over 500,000 trials, 250,000 plus publications, 1.2 million knowledge objects. You can do anything from assess a molecule to design a molecule. And it takes minutes we'll get into a demo for this. The strategic impact of this cannot be underscored enough because this is now available to the public. So it's not just our own work. We've now taken the transformative action of making Zeta available for anyone. We plan on monetizing this as a subscription-based platform for anyone who's interested in understanding how molecules work, anyone who's interested in developing a drug, anyone who wants to optimize their drug. The market for this is pretty large, and very importantly, people do not develop in rare cancers, but we've got a lot of credibility because we've got 3 drugs, we've got 6 orphan indications, 4 rare pediatric, 2 fast track. So the urgency of this cannot be underscored enough. And so we'll do a demo of this. Now, all this knowledge isn't just from us, it comes from top researchers. So places like Johns Hopkins, Fox Chase, University of Texas, UMass Boston, Dana-Farber, Danish Cancer Society, MD Anderson. We've worked with all these institutions, and what we do is take the data, the knowledge, the models, and then put them into digital form so that our AI can use them. But now we're actually making a lot of this now available broadly. As I said, we've had a number of collaborations with pharma companies, and that's only growing. This slide says we have 11 FDA designations. We actually now have 12. We just got another one last month. And it's pretty phenomenal for a small company of 20 people to have 12 now FDA designations, 2 fast track. We now have 6 orphan. The most recent one being in a very challenging cancer for adult sarcomas. It's one of the few cancers that's actually growing globally as a percentage and also as an incidence rate on every continent, adult sarcomas. So it can't be underscored enough. And LP-284, which is a drug that seems to work well in adult sarcomas, is also in a trial today. More importantly, that drug has actually shown a complete response in one of the patients in the trial, which we published last year. So we know the mechanism works, we know that it's safe, and the trial continues to go. So again, all these drugs, our goal is to out-license them to larger pharma companies and then continue to generate the next generation of molecule. I'll talk a little bit about how we've used our AI platform, not get too heavy into the science and go into the demo, but we've used it in a drug called LP-300. It's for people who get lung cancer but are not smokers. And we used it to really validate the molecular features of the drug. Why does it work in these kinase mutations? And so what we did early on is that we modeled LP-300 to really look at why does it work in these never smokers. And we uncovered the mechanism of tyrosine kinase receptor binding. Again, theoretical, but now we've actually seen it in the clinic. We've dosed almost 40 patients now. We've seen that regardless of kinase receptor, the drug seems to slow down the cancer. And then once it's inside the cell, it seems to turn off the cancer cell from being aggressive and allows the cancer cell to then die. So again, it goes from being theoretical and modeled to actually in real life. And so this is the kind of work that is really takes so much cloud infrastructure and compute data. But now with the advent of all these new inference engines, we've been able to compress this. What took us about a year ago when we first started the company to do this modeling and analysis, now it can be done in the course of weeks. So let that sink in. This is work that would have taken years in the past and years in the clinic. We boiled it down to less than a year using our first generation of AI. And now that same process can be boiled down to weeks. It is really going to be a phenomenal time in medicine to use AI for good. We also modeled using digital twin capabilities, how people would respond. And we're seeing that now come true in the clinic. We had an 86% clinical benefit rate, which is pretty great for this trial. And again, as I mentioned, we've had good response regardless of the underlying tyrosine kinase inhibitor mutation. So let's talk about our next drug, 184. Again, we found the activator and mechanism. We optimized this drug using AI. The AI also pointed us to some very interesting indications. Because the drug is so potent, it's really important to figure out what is the indication that's going to be best. you've seen a lot of drugs that fail, not because they're a bad drug or a bad molecule, because the indication that was selected wasn't perfect. And so indication selection really needs to be a data-driven form, and that's really the way to do a very streamlined trial. And again, we have fast track and triple negative and also in GBM. We're pursuing it now in a form of lung cancer called metastatic multi-drug resistant lung cancers. And again, all this was predicted from the AI and now is being proven true in the clinic. We've dosed over 60 patients on this drug. When we used our RADAR AI platform, PTGR1 was identified as the biomarker. You can see here, it was very, very high scale SHAP value, almost straight line correlation, more PTGR1 or potency of the drug. We then took it to lab. We did this with Fox Chase. They said, well, let's make PTGR1 not available. Let's gene edit it out. And as you can see here, when we took it out, the cells lived. When we had expression of PTGR1, the drug used it and killed off the cells. This was very great confirmation. And this, again, was all done in months as opposed to years. We then took it to mouse models. Again, some of the predictors were TNBC and pancreatic, and we saw wonderful activity. And now it's in a trial. We just completed a phase 1A basket trial with over 63 patients. The market opportunity for this drug is massive, over $10 billion, we believe, in market opportunity. We achieved all our primary endpoints, got a very good safety profile, very promising anti-tumor activity. And again, the AI pointed to activity in certain cancers, which we're now pursuing into phase 2 trials. One of our phase 2 trials is paid for by the Danish Cancer Society and Denmark. This will be about a 40-patient trial, metastatic recurrent bladder cancer. Again, we validated a lot of the insights in a number of models, a number of studies, and we've published all of them. The next drug was a really exciting story because this drug was thought of after we went public on a whiteboard. We were thinking about what could we do with 184 slightly different. And that's how we created 284. Actually, initially on the back of a whiteboard, we then were able to manufacture it, get it into a trial, get a complete response in a patient, all in the course of about 2.5 to 3 years at under $3 million. We're now focused on not B-cell non-Hodgkin's lymphomas, which are about 4% of all cancers in the US and about a similar number globally, very aggressive. And unfortunately, they always come back. And we've had some great data in the lab to show why our drug works well. Again, validating it in silico, moving into the lab, and then moving into patients. So this active trial is going on today, and we expect this trial to be done later this year. And our goal, again, is to license out the drug to a larger pharma for them to pursue into approvals. We also created a new company called Starlight. This was an insight developed from billions of data points using AI with a very large market. Again, we've received fast track and orphan designation. We've already completed the phase 1A trial, and we're now moving into phase 1B and phase 2. And again, this is something that is really needed. There are over 120 different types of brain cancers, and the vast majority of them have no curative treatment, both in adult and pediatric. So finding this indication, finding how the drug works, has been a phenomenal effort that has typically can take 5-10 years. And because of the power of AI, we did this in a matter of going from an idea to a whole company to fast track to a trial, all in the course of the last 3-4 years. And the wonderful thing is now we can even do it faster. We got a lot of great data, a lot of publications, multiple patents around this. And then the landscape of biotech obviously is challenging, but the research indicates a lot of interest in CNS oncology, and that's why we're spinning it out. We've got a board member on who came from the Chimerix acquisition. It was acquired last year for $953 million. And as you can see, when a drug has shown some activity and works, the takeouts from pharma are pretty significant. Again, a lot of this is all driven through patents. We've got over 100 patents issued and pending across our AI platform and across our drugs. As of the last reported quarter, we had about 12 million in capital. Our burn rate's about 4 million a quarter, so we've got capital through the majority of this year into Q3. No warrants, no debt, 11 million shares outstanding. Let's now talk a little bit about what some of the highlights are for this year. We will be reporting clinical data later this month. We're reporting updates on Starlight and also the commercialization, as I mentioned, and monetization of our AI platform. So let's take a quick look at that today. So with Zeta, again, anyone can go to with Zeta, you can go to it now. And this is taking our platform and solving one of the biggest challenges, rare cancers. Hard to get data, hard to get experts, takes a long time, economically not sustainable to have large teams. So why not use a co-scientist? It's the perfect area for doing the kind of work that AI for Good can do. We developed a rare cancer knowledge base, a very specific Lantern proprietary cancer drug database, a library powered by over 500,000 clinical trial results, connected real time, though, to scientific knowledge around the world, to the NCI thesaurus, to an ontology lookup service, to OpenFDA, to PubMed, and also to our own LLMs. This is a multi-agentic system. And again, I urge you guys to go to it, but let's take a look at, so if we go to Zeta today, and we can answer questions about clinical trials, about molecules, drug characteristics, review literature, do biomarker analysis. But the great thing is you can actually develop your own drug. So this is going to be a very powerful tool in the hands of pharma companies. And again, our goal is to give this up through a subscription. So let's look at one of the conversations that I had. And in this conversation, as you can see, it highlights things in green and orange. And this is thinking the way a drug developer would think. It wants to know what is potentially important. And also, very importantly, it creates a knowledge graph. So real time, it creates a knowledge graph as you interact with the system. So I'm not just sharing my screen in terms of, cut and paste what the results are of my colleagues. I can share with them the entire knowledge graph, because this is how people think, or at least in knowledge industries. We create concepts in our head and connect dots and ideas. And sometimes there are things that aren't connected, just like here. And then I can share this entire knowledge graph. I can export it as a JSON file, as an HTML file, and work on it. Now, again, the question I'd asked is, what cancers can we target by impairing KRAS signaling? Very common question. And it real time will tell me what are the cancers most amenable to KRAS inhibition, tells me even additional targets, early phase trials, tells me what the landscape is like for some of these drugs, and tells me how many number of trials and what the considerations I should have. And actually, with this, I can actually go even further. And as you can see in some of my historical conversations, all my conversations are here. We can actually look at and design new drugs. So let's look at this one. This is a metal-3 inhibitor for bladder cancer immunotherapy. And this was quite exciting. This was not coming out of a database. This is actually real-time recursive thinking. And in the help of Zeta, I actually designed a drug, and it gave me its molecular weight, its all the medicinal properties, and it told me how it modified an existing molecular scaffold. So again, this is work that would have taken months, if not a year. And I did this literally in 20 minutes, designed a novel metal-3 inhibitor, which now we're creating in the lab and has unique characteristics. And not only that, I can actually get a game plan to actually, how are we going to test this? And this is quite exciting. This is a co-scientist. The whole point of these tools is to do in minutes or days what used to take months or years. And just even at Lantern, our own team now has been able to use this to develop 7 new drugs. Now, will they get into trials? I don't know. But we did this in 90 days. So the next generation of our portfolio is already being developed with a lot of precision. So we're pretty excited about the future of how AI will totally transform drug development, accelerate it, and Lantern is well positioned to monetize on that. So with that, I'll turn it over to questions people may have and answer any questions about our platform, about our drugs, about our strategy.
Thank you very much, Panna. Excellent presentation. To reach Panna with your question, if you're on Zoom, go to the bottom there of your Zoom window, look around, there's the Q&A button, press it, and then you can type in your question. We already have several questions for you, Panna. Why don't we start with this one? How are you balancing internal development with partnerships or licensing opportunities?
Yeah, that's the challenge of any biotech. I mean, we're very focused on out licensing our drugs. So, I think our goal is to develop and show that the drugs, compounds, molecules work in patients the way we want them to work. They're safe, they're tolerable, they're effective, and that they have good IP around them, and then license them out to pharma partners. Our model is not to go all the way to commercializing the drugs on our own. We know that the best people to actually take it to all the cancer centers and deal with the regulatory frameworks, pricing and insurance is going to be big pharma. As a small company, we're maniacally focused on being innovators, and people will pay up for innovation. If innovation works, it's a great place to be, and that's where we're at.
Panna, with multiple clinical programs in development, now I know you went over this on your 2026 slide, but just to reiterate, this person wants to know multiple clinical programs in development. Which assets or catalysts do you believe are going to drive the most value, not only this year, but going into 2027 as well?
Yeah, this year, LP300 and LP184. Those are going to be the primary catalysts. And then also the launch of Starlight as its own independent company. We've put in about $10.7 million so far into the development of Starlight, creation of the molecule, development of the trials, dosing of patients, pursuit of the FDA indications, the IND reviews, all that. And so we're going to monetize that. I mean, that Starlight alone has the potential to be multi-billion-dollar, but at least $1 billion company after the phase 2. The phase 2 trial is already for adult recurrent has already been cleared by the FDA. So that also will be a pivotal milestone. So again, to reiterate, 300 data that's coming out probably in the next 30 days or less, 184 launch of that trial in the phase 2, and then Starlight. Those are the three things that I expect over the next 6 to 9 months. Going into 2027, I think it's all going to be about the AI platform. And I think the AI platform has a lot of potential to be spun out and be its own company, or to be licensed by big pharma for massive dollars. There's no multi-agentic AI platform focused on rare cancers and cancers that works as well as our platform does, and more importantly, is easily accessible. So I think that's going to be very important going into the future.
And Panna, final question for you. What do you say to those skeptics who claim that radar is simply improving workflow and not creating a real competitive advantage?
Yeah, I mean, I think, competition changes. I think for us, the proof is in the pudding. I don't know any company that's spending $4 million a quarter that has multiple trials and multiple drugs that are in phase 2. So I think that's a big competitive moat for us. I also don't know any company our size that has 12 FDA indications. So always good to be skeptical about AI. There's a lot of hype and fluff around it, but I think ultimately the proof is in what can the company actually do. So I think it's always good to be a healthy skeptic, but at the end of the day, we have drugs developed by Radar, by our platform. Radar now is available publicly under the withzeta.ai. So I urge all skeptics to go there and try it out. It's pretty earth-shattering. The feedback we've gotten from our first 50 power users has been quite phenomenal. These include big cancer institutions, pharma companies, independent researchers, investment banks, CROs. So it's always good to be a skeptic in the AI space. And I think the proof is in our own portfolio and the cost and efficiency which we're conducting development, And also, very importantly, we're opening up the kimono and showing the world that, here's how you can do development in the new world of GPT-driven AI solutions.
That does it, Panna. Thank you very much for your excellent presentation and for answering the questions. For more information on Lantern Pharma, reach us at 1-800-RedChip or write us at LTRN@redchip.com. Panna, thanks again.
Thank you.
Now, coming up, we've got at 11:30 a.m. Eastern, BIMERGEN-ENERGY, that's ticker BESS, on the New York Stock Exchange American. Presenting today will be Bob Brilon, co-CEO and CFO. Bob, are you here? Hi, Bob. Can you hear me?
Yes. Yes.
Hi, Bob. I see you now. Hey, how you doing?
Great. How you doing?
Really, really good. Thank you very much for joining today. Will you be showing your investor presentation today?
Yes. Here,
Okay.
let me
Make sure that's
okay.
working.
Add it on here.
Excellent. Okay, we're ready to go. Let me do some preliminaries and then we're going to give the floor to you. Again,
Okay, great.
Yep. Again, it's ticker BESS on the New York Stock Exchange American. BIMERGEN-ENERGY. Bob Brilon is going to discuss the company and take some of your questions. Before we begin, let me just read that safe harbor statement once again. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements, and of course, forward-looking statements can involve risks and uncertainties. Bob, please go ahead.
Thank you. Appreciate it, Craig. Thank you, everybody, for joining today. Also on the line with us is Cole Johnson, the co-CEO and president. And as Craig said, I am the co-CEO and chief financial officer for BIMERGEN. Again, has its ticker symbol BESS. We also have tradable warrants out there under BESS.WS. Our company is very simple if you get down to it, but it takes a lot of cash to operate. To build this infrastructure, it's going to be over $2 billion. But really, it's done off balance sheet, if you will. It's done on the project level. So we just raised $13.6 million, went up listed to the New York Stock Exchange. And the uplisting was really just to get us, that notoriety, get us some other capabilities going forward. But we really aren't going to use that public entity to raise money for these projects. Right now, we have 23 projects. We bought these from actually Cole's company back in 2024. He is a majority shareholder at this point. We have 2 gigawatts worth of these development projects. That is in real terms about 100 megawatts is the typical per project. Each 100 megawatts can throw off about $20 million of yearly arbitrage when they're up and operational. As I said, we're going to need a couple $1 billion to get out there. But what was nice is over the last 9 months, we've got $250 million we'll talk about that has been committed now. And we now have some of that money in operation. We'll talk more about that as we go through here. That $250 million is project equity and mezzanine debt, just against the projects, not against the public company. But it also unleashes about $1 billion worth of bank debt. The bank debt is usually about an 80-20 mix. If you have 20 million of mezzanine, the bank will come in and put in the other 80 million. The reason that works out is because you've got $125 million you're putting into one project. But once you get that project operational within that about 9 months to a year time frame, you then get up to 50% of that capital outlay back because of the investment tax credits. You don't have to wait to use the tax credits. You actually can monetize those immediately. So that $125 million you put in the ground, you can get about $60 million of that back right away. You pay off your mezzanine debt guy at about 25,000. You pay down your bank debt guy. So now you've got $65 million against that $125 million asset that's throwing off $20 million a year in energy arbitrage. So as you can see, the numbers work out really nicely for this model. These batteries can last around 20 years. So you've got them in place for a long time, and your payoff is in that first 5-6 years. And going forward, you really have a good cash flow model. Our pipeline is 23 projects around the United States right now. These 23 projects are really in key areas. These key areas, and that's what Cole's firm did before we bought these projects, was did all the analysis, all the studies, finding the pinch points within the United States as to where is there an issue that you're going to put a $125 million asset, and there's going to be plenty of energy there that you can actually buy at very low prices, but put back to the grid when it's needed. That's the energy arbitrage model. And again, I said it's simple. Once you get into it, you realize that we are technology agnostic. So we have several technologies we can use on the battery side. And what that means for us is we don't worry about how technologies are changing. As they're changing over time, it's just going to benefit us in the future. 11 of our 23 projects are actually being in Texas. These pinch points that I talked about are the areas where they've identified that there is an issue and the arbitrage revenues are there. When we did this development process, and again, it takes quite a bit of time. You have a leg up here with 23 projects. You're about 2-3 years ahead of some other guys that are just getting started. And so what the other interesting piece about this is on these 23 projects, when we put these into a joint venture, we're going to get $7 to $8 million as a reimbursement for basically the project costs that were put into place before we acquired them. We acquired them for $22 million worth of stock. That's what they're on our books for. But if you do the math on this, when you have these 23 projects, each one at around that $7 to $8 million, you got about $150 million worth of value going to be coming to our P&L statement over the time. And again, that's during that first year of construction is when you receive that money and it hits your revenue line. The rising power demand and also the intermittent renewable supply is what makes this a very sustainable model for us. The rising power demand, again, AI that we're talking about today is eating up a bunch of power, and that includes the data centers. So over the next 4 years, it's expected to double in the United States is that usage. And it's great that the renewable supply is trying to keep up with the wind, solar, etc. But there is the traffic jam on the grid. So you have plenty of power. You have several terawatts yearly that aren't being used because they're actually being curtailed. They're being told to shut down certain times during the day because the grid can't take it. Well, that's where we step in. We buy that at very, very low prices and then put it back to the grid when it's needed. So that's that energy arbitrage model that we're talking about. So you just have a $125 million asset there working for you, these huge tractor trailer size batteries on about, and we call it a battery farm. It's on 10 to 30 acres, depending on the size. The deepening duct curve we talk about is over the last 15 years, they've tracked this. And again, it's just the supply chain and the demand is getting farther and farther apart. So the need for these batteries is really key. What's come around with this also is both sides of the aisle have really identified, the Democrats and Republicans have said, yeah, this is a key area. We really need batteries to balance this grid. What that also has done for us is that they've put it out to 2033 and really have siloed it now. It no longer has to be co-located with a solar or wind. It's agreed that these need to be there just to balance the grid. So that's good for us. It's also good for the economy. On this graphic you see here, what it really depicts is we don't care where the power comes from. It can come from wind, solar. We tie into the substation. So we're buying energy from the grid, selling it straight back to the grid. So right now our model isn't to sell to any single AI data center or to sell to any customer in themselves. Even though that is part of the model that we can do an offshoot for, we're really buying from the grid and selling back to the grid. We are also using a tolling agreement. So in this case, and this is really because we're getting $100 million bank debt, they require a guarantee that they're going to get paid back with their interest. So the loan pay down and the interest, they want to make sure it's covered. So we put a tolling agreement in place with some commodity desks out there. So these are large names that are in the industry, have run their own models, and they look at it and say, you know what? We believe that this $125 million asset for 100 megawatts is going to throw off $20 million annually in energy arbitrage. We're going to guarantee you X, and then we're going to give you the upside. We're going to share the upside. So 50-50. Round numbers here, we're going to give you 10 million, and then we're going to go ahead and share that other 10 million. So you're going to end up with 15, we're going to end up with 5. And again, that's the way the model will end up working. But it also de-risks it for us. So we have guaranteed revenues. So that's a very key factor when you have markets out there doing, different crazy things. But at the same time, we all really believe that it's going to go up over time, unfortunately, for us as consumers. But what that also means is we're in there at a 5-year tolling agreement. And that's because they require that, because that's about when they expect the full debt to be repaid. So again, that's great for us. We're fully repaid, and then we're operating that next 15 years with abundant cash flow. The strategic partners, again, we talked about the $250 million worth of mezzanine debt and equity capital that needs to pair up with the $1 billion worth of bank debt. First one here is Rely Easy. They are a China lithium battery manufacturer. We're the first group we signed up with, $50 million commitment from their side. They put $10 million into a joint venture, and it's a very strategic relationship. When we work with them on this, we will be using their lithium batteries. And so we did announce that the first project has kicked off. And it's with 80 megawatts that we bought actually from Aggreko. And these projects are in Texas. They're up and being. We just let out a construction bid on that. Actually, not bid. We actually gave the contract, and we announced that this morning. So things are moving very quickly now that we have our uplist done. And we've had these projects ready to go. So we're excited about this first project with Rely Easy with their batteries. And also we expect to do future projects with them with that $50 million there on the sidelines. So the other piece here is Cox. It's Cox Grupo out of Spain. It's a $200 million commitment. We're moving through the process of getting definitive agreement done. They have the projects that they're reviewing for acceptance. And so we expect that to move forward, and we'll do announcements on that as that moves through the process. Another one that came on, though, and I guess I should mention Gotion is a supply chain agreement that we were working on. They are also a very large lithium battery manufacturer, have brought some of their manufacturing to the U.S. for obvious reasons with tariffs, and also investment tax credits are higher if it's U.S. made. So, but Cox came to us and said, we have probably the best contract, supply chain agreement, and cost structure you could ever want with Gotion. We'll bring that to the party. So that was great for us as we're moving forward here. Lastly, again, that wasn't in our $250 million number, but EOS has stepped up, done a joint development agreement with us. We recently did an announcement that we'll be using their zinc bromide batteries on the Redbird project. And we'll talk more about exactly what that structure looks like with EOS and their financing partner. So we really expect that project to be moving forward really quickly here, and we will again give more details as we have them for our public. Scheduling and long-term tolling agreements. We've talked extensively about long-term tolling agreements. And again, it shows here the likes of a Goldman Sachs commodity desk. And again, they do this all day long, every day. And this is their business, is to guarantee your revenue stream, but also obviously taking the upside so that they can make a lot of money on it also. Tenaska is our scheduler right now. We're using them because we don't want to have our own day traders for energy, if you will. That's what they do, and they're very well known in the market. They have about 60% of the market, and they work very well with Goldman Sachs. So it's great to have just a third party there that keeps us from increasing our overhead and just giving a piece of the pie. Oh, sorry. The Redbird overview, again, this was really here just to talk about key partners. We have many key partnerships that have really been brought to us by the relationships that Cole and his team have had in the past. As you can see here, the battery suppliers, we have the interconnections, we have the EPCs, meaning the engineering, procurement, and construction. Again, the one we talked about today was actually TrueGrid is going to be working with us on the Greco projects that we purchased in Texas. We have tax equity partners. What's interesting is once you get some money, like the $250 million commitment, and also now that we've done our uplisting, you might imagine we have a lot more key partners now because they're coming out of the woodwork wanting to work with us because they can see that there's not a lot of guys out there with 2 gigawatts worth of power wanting to bring on. And again, we're wanting to do this over the next 3 to 4 years. So it's an aggressive timeline, but we believe we can hit it. Typical 100 megawatt project. Again, this is key for the project equity guys and also the debt guys. They want to make sure their money is going to physical assets as much as possible. And in this case, 68% of the funds are going straight to batteries or actually interconnection equipment. Company management, again, a lot of people invest in management as they, want to make sure it's somebody that can been there, done that, can execute. And that's what you have in this team. Cole Johnson has 20 plus years, and again, is very aligned with shareholders. He's a 25% shareholder at this point. And really has been in every aspect of the energy market. What that brings, he also has a key team with him that he has brought with him. These guys and himself have just, I call it priceless relationships. Meeting these relationships over the last 18 months, it's very important to understand how key they are, and that, when you have somebody that's written you a $100 million check before, it's easier to get them to write the $100 million check next time. And you're both aware of what due diligence needs to be done and what parameters need to be in place to move it forward. And that's what you'll be hearing about us. That's what you're seeing happen right now with our company as we grow. Myself is 30 plus years in capital markets. I've been industry agnostic. I've done many different public companies. And my side of this business is going to be to go out and make sure we do these type presentations. I want to make sure we get in front of the right institutional investors that can take a major position in the company when it makes sense, because in this, you don't go out and ask for a check or ask for them to buy in. You get on their radar screen, make sure you tell them what you're going to do, when you're going to do it. And when that happens, there's inflection points that the major institutional buyers will get in and get out. And so that works out really well for all stockholders, because having that liquidity and having that ability for people to go in and out is very important. The balance sheet is actually very, very strong right now. With we have the 22 million on the books, again, like I said, for the assets of the projects themselves. When we bought those, we have again $13.6 million in cash that came in from this last offering. We are doing at this point, we also are having, and again, I talked about that $22 million that's on our books. Again, that's fair market value right now of about $150 million out there. Our goal is to make sure that we unlock that for our shareholder value when shareholders really learn that how that's going to come into us, because we really expect, we talked about 3 large projects this year getting started and getting almost to completion. Then that'll bring on about $20 to $24 million worth of development fees onto our top line. And again, that when we're only doing 2.5 to 3 to 5, I think we said this year between $3 and $4 million in corporate overhead, where we did 2.5 last year. You cover that very quickly and very easily. So we really expect to be cash flow positive and profitable this year. And not many companies can say that when they just do their uplisting. Again, we raised that 13.5 million. We have a clean cap table in that we don't have any convertible debt out there, no overhang. The one warrants now that we have are tradable warrants. So these are $5 tradable warrants that just came out with this last offering. And if you go look at it, they're actually trading at a very nice premium. And what that tells us is there's a lot of people out there that are really betting on the company to grow, because those are at above where the current share price is selling. With that, I'm gonna we'll take some more questions, but again, I want to just hit these key points. 2 gigawatts worth of product and of these projects is just the tip of the iceberg for us, because those are what we have in our backlog. Like we just bought those Greco projects, which was 80 megawatts, put them online. We're going to be doing that also with other projects, because as we've grown here and as we've gotten the pieces of the puzzle in place, we're seeing projects weekly come to us. What's interesting though is that we are very selective. So when we look at IRR, we're looking in the high teens. We want to make sure there's plenty of cash flow there, and we're gonna model these purchases with positive cash flow in mind, obviously. And obviously we talked about, when we do this mezzanine debt, when we do the project equity, everything is siloed. So when you do a project, the debt you're getting, that $100 million in debt, is against that project. So it's, and everybody's kind of looking at it that way and saying, okay, there's got to be enough assets here, got to be enough cash flow that it makes sense for the banks to write this number. And then also there's no, additional recoverability on the public company. So the stable contracts, again, with the hedging agreements, we'll call them, with the likes of a Goldman Sachs and others out there that are at a certain fixed price with sharing 50-50 above that. And again, that is for the first 5 or 6 years, and then you can go merchant, which means you're in the market yourself, still using a Tenaska, but you're taking the risk on how much you're going to make. But reality is there's a lot of margin there you're giving away. And if you can do it, you can go merchant. But the Goldman Sachs really de-risks it for everybody, because it is that guaranteed revenue stream. We've really the ITC tax credits are very important, just because the numbers, it makes it really cash flows. And when you get half of your money back, people look at it and say, okay, I spent $1 billion this year. Well, you really didn't, because you got $500 million back from these ITC tax credits. So you do have $1 billion in assets out there, but you really have only $500 million against it, which is kind of unheard of in the kind of the industry, other industries. But when it comes to renewables, it's going to work out very well for us. And it does, it's bringing some jobs to the U.S. It's also bringing the stability to the grid, which is very important, because we know that we're all going to need that additional power with AI and the data centers just cranking up. We talked about the $250 million worth of committed capital. That was a very important catalyst for us. The other thing that's happened, though, is when you now have all the pieces of puzzle in place like we do, there's other groups that are stepping up to be that mezzanine debt. Because again, the mezzanine debt may make 12% over that first year, and then they get taken out by the tax equity. But it's a good money for that mezzanine debt, and we're happy to do it because it gets us the bank debt that we need that matches up to it. The partnerships, we talked about that, key partnerships that we have that we'll be moving forward with, and the rapid growth, the tailwinds of the need and the sustainability for this model really puts us in the forefront. So with that, we'll open it up to questions.
Bob, thank you very much for that very informative presentation. We remind our viewers today that you can join the conversation. Type in your question by clicking the Q&A button. It's near the bottom of your Zoom window there. There will be a text box, and you can type in any question for Bob Brilon of BIMERGEN-ENERGY. Bob, we've already received several questions for you. You were very excited about the 2 gigawatts of pipeline just now. You talked about that?
Yes.
Across multiple ISOs. What differentiates BIMERGEN's project origination and site selection strategy versus other battery storage developers?
Oh yeah, happy to talk about that. I kind of touched on it a little bit, but it's worth talking about again, and that is we are looking for areas where there's a pinch point, where there really is a need, and the analysis has been done that if you put this asset in this location, you are going to have some really good energy arbitrage, meaning has been a need where there's plenty of energy, but it's needs to be kind of the timing, if you will. We need to take it off the grid at certain times, and we need to put it back on. And again, when we look at these, there's some projects out there, you look at them and they're in the single digits for a rate of return. When we look at a project, we're looking for those high teens in a rate of return. So we make sure that we are looking at projects that are going to make sense, because ours are, the larger projects we have in our pipeline of the average 100 megawatts. It's important that when you're putting $125 million to work, that you're bringing home the higher rates of return. And that's going to be great for our investors, of course.
Bob, we're getting many questions about this. I'm going to kind of conflate them. It's basically, the gist of it is basically, why BESS to respond to the rise of AI-driven data centers? Why does it need to be BESS versus traditional generation?
Yeah, and that's what, it's an interesting question, but it's there. You need to look at them as two different things, in that the generation is great, but if you don't have the infrastructure, the grid that can hold it and take it, and because you can't hold power on a grid, that's why you have to have a battery system. And especially there in Texas, the grid, the transmission lines cannot own a battery. So it can't be the same. It's monopolistic reasons. So it's a synergistic relationship there. So yes, when these power producers, whether it be wind, solar, even the newer ones, as they come on, that's going to be great. But they still really need a battery to kind of fix the issue. We've talked to actually even solar farms. My group has worked with them and actually built them in the past, and they realize that when you build a solar facility, it's great, it's going to generate a certain amount of energy, but if it can't be taken to the grid on a constant basis, then it's not going to be as efficient, and it's not going to be as profitable. So you actually put a battery alongside it, or you have a battery that can offtake that power at the right times. It's really going to make it a profitable situation.
Thanks, Bob. Texas is known for having a very busy power grid, this person writes. Why is BIMERGEN focusing on smaller 9.9 megawatt projects instead of one massive site? And does this help you get connected to the grid and start making money faster than the so-called big guys?
Yeah, well, to answer the question is yes. We have some of the bigger projects in our backlog. We had an opportunity to buy this, and collectively it was 80 megawatts, and they were up and ready to start construction. As we said, we let out that contract today. So getting out there and getting operational, even this year, it was important to us. they were in areas where there was a need. So we really saw it as a way to get into the market very quickly. And these projects, again, we kind of said it where they're located, some of those in our press release today, and they were located in areas that really had the need for just a small, when I say small, the 10 megawatt batteries, and it will actually be, a very profitable situation for us. So we look at projects on that basis as to what is going to be the return and what makes sense. So it's not all about size. Sometimes it's about location.
Bob, this is again, we're going to conflate several people talking the same ideas. Goes pretty much like this. You have that big pipeline, but you also have a relatively small market cap. I think you would agree there.
Oh,
Now,
yes.
right. Now, how are you going to build all these projects without constantly asking shareholders for more money or issuing more stock?
No, it's a great question. And I kind of talked about it earlier, but it is the public company isn't going to be where we're raising the capital for these projects. These projects are going to be self-funded, if you will. An example is with Rely Easy. This $50 million they've committed, they put $10 million in the bank immediately. We're using that money now for these projects that we just talked about, the 80 megawatts. That money has gone to work on buying assets, moving the project forward, and that's using their money in our joint venture with them to do that. That will be paired up ultimately with the larger debt, the permanent debt, and also the tax equity will happen at the end of the year, where again on these projects. Say we end up spending $100 million on these projects in collectively, we'll have $20 million in it through the mezzanine debt, and then we'll have $80 million that from our permanent debt that will then get taken down, with about 40% of that. So we'll end up getting about $40 million back from the investment tax credit. So again, you'll take out your $20 million from your mezzanine partner. And then now you just have the bank debt that then comes into play and is your permanent debt going forward that gets repaid over that basically 5 years through the tolling agreement. So again, all this is done in the project level. We didn't go sell any more stock to go do this. And so that's how this runs. We're not financing $1 billion worth of growth here, actually $2 billion worth of assets over the next 4 years. Through raising money in the public company. And as you said, right now, our market cap does not reflect even the $150 million worth of, we talked about these development fees that come back to us. So just from the projects that we already own. So you'll see $20 million come to our profits, on our revenues this year, just from those development fees. And then once we're operational, which starts at the end of this year, then you'll see the operational assets or operational income start coming in late this year and then continuing from 27 forward. I think we've talked about it. Our goal is have $300 to $400 million annually coming in from that 2 gigawatts once that's all up and built.
Okay, Bob, great to be able to take you overtime a little bit, and I'm going to tell everybody why. Off the Hook would be presenting next. We're going to do something with Off the Hook, but we're going to start at about 12:05. That leaves us about 45 seconds for your answer to this final question, Bob.
Sure.
And it's a good one, and I'm glad you mentioned the investment tax credits. We've been getting a lot of questions about this so-called free federal money question. You've talked about getting up to 50% of your project costs back through those government tax credits. How much of that cash would stay with BIMERGEN to fund the future growth and versus going back to your partners? Again, you got about 30 seconds to answer if you can get it in.
Sure. It really doesn't go back to our partners. It goes back to us through the debt repayment. So it really takes your project so that you're only now paying half your project back. And so that's the important part is when if you didn't have that investment tax credit, you'd have a payback period of 10 years instead of 5 years. So that investment tax credit helps us in cash flow and profitability.
Beautifully put, Bob. We appreciate you respecting that time limit. It's Bob, thanks again. It's Bob Brilon, CEO of BIMERGEN-ENERGY, recently uplisted to the New York Stock Exchange American. The ticker is a memorable one, BESS. Thank you, Bob.
Thank you. Appreciate it.
For more information on BIMERGEN, you can, of course, call us at 1-800-REDCHIP or write us at BESS@redchip.com. Our next presenter, Brian John, CEO of Off the Hook, apologizes. He is in the air. He is on a plane and just didn't make it down to Earth again on time. Therefore, we are going to show you very good material about Off the Hook. Off the Hook is currently a RedChip client. We have a webinar. We have an investor. We have an interview where we talk at length about AI with Brian John, and we're going to show that to you. We also have something we call the company overview, where Brian is going to talk, pre-recorded of course, about his company in which AI performs such a crucial role. This interview and the overview were created very recently, so it's fresh stuff. And then as we approach the bottom of the hour, we're going to put some RedChip videos in that talk about how RedChip is using AI. So everything fits in very well with today's theme. So we've got that video ready, gentlemen. You may fire when ready, and we'll see you towards the bottom of the hour. Enjoy these videos on Off the Hook. Hello there. Today we have Brian S. John, the Chief Executive Officer and Director of Off the Hook, trading on the New York Stock Exchange American under the ticker symbol OTH. Brian, thanks for coming up to Orlando and meeting us today.
Great to meet you. Good to see you.
Brian, for investors who may be completely new to the story, introduce us to Off the Hook, and in particular, what makes you a boat marketer more than just a dealer?
A great question. So Off the Hook is an AI-driven technology platform, and that platform was developed 13 years ago. And what it actually does, it keeps us from making mistakes. So we're like a trading platform. People deemed us a market maker when we were doing our IPO a couple months ago because we basically set the price for used boats in the market. We're basically the Kelley Blue Book for used boats. There's nothing accurate out there, and that's where we come in. So think of us as a trading platform where we have buyers on one side of the platform and sellers on the other side of our platform, and they're communicating 24/7 throughout the platform to make boat transactions happen.
So people, when they're selling a boat, they really just don't have a clear idea, as opposed to the car market, about how much their used boat may be worth.
You're correct. It's very different than the used car market. Used car market, you could pick up a number of publications and find out what a used car is worth very accurately. There's nothing that's accurate like that in the boating industry. That's where we come in.
Sounds amazing, Brian. I really didn't know that the boat market is so much less certain than the car market when it comes to selling your pre-owned boat. But how do you turn that into money? How do you make money?
So our platform that I just described to you earlier allows us to be the largest buyer and seller of used boats in the entire country. So that's what we do. If you look at the car industry, we're very similar to like a Manheim. So we take a lot of the trades from the dealers out there in the markets. 3 or 4 boat transactions like cars have trade-ins. And new boat dealers are set up to do new boat deals and their brands and don't really deal with trades. And that's where we come in. We take the trades from the dealers. And that's how we make money. That, and of course, we have Azure and a bunch of other divisions that all touch parts of the boat buying system that all feed on each other. So we offer through Azure, like a F&I department, a car dealership, we'll offer financing, we'll offer insurance, we'll offer warranty, we'll offer prepaid maintenance, all those things that a car dealer does. Most of those products carry 50% margins with them as well. So that'll go straight to our bottom line.
Brian, the whole RedChip team just met you off stage. Great time we all had. And you were so excited about this next question here. You just announced a definitive agreement to acquire Apex Marine. It is expected to add $30 million in revenue annually while providing an estimated $3 million in cost savings. but I don't want to take the words out of your mouth. Why don't you tell us about this acquisition and what it means?
It's a great question. You're right. I am very excited about this acquisition because it does so many different things for the company. I could literally sit here and talk about it for 20 minutes, but basically in a nutshell, what it does is, when you can buy an already producing marina that's already cash flow positive, they always have overcapacity and more rooms in their lots. So being able to take a marina like that and be able to store our boats there, service our boats there, maintain our boats there, all those things will save us a tremendous amount of money that we spend roughly $3 million on a year now. But more importantly, those areas become, sales and service centers for us.
Now, where are these places?
So there's 5 locations. There's one in Haulover, right by the Haulover Inlet. The main one's in Miami. And then there's Lantana. There's one in Ocean Reef and Key Largo and Stewart.
So all in Florida.
All in Florida. The 2 biggest ones being Miami and Stewart are what we call super centers. So they're massive. They can haul, we have a 150-ton lift in Miami, so we can pretty much pull any boat out of the water there is to probably 150 feet. In Stewart as well, it's not that big, but big enough to store all large boats there. And that's where most of our expense comes from. The bigger the boat, the more it costs to maintain, the more it costs to store, the more it costs to dock. So being able to do that in our own locations is a tremendous savings for us. But all that's just the basic stuff. To have areas like this that have great boat brands that we can take trades from and make deals happen, those marinas become sales centers for us, right? We have, flocks full of people getting their boats maintained there, serviced there, whatever the case was, and all those people are always looking to buy and sell boats. So we'll be there to offer them financing through Azure, offer them insurance through Azure, offer them warranty through Azure, and finance their deals and take their trades and make deals happen.
Can you tell us real quick about Azure?
So Azure is our finance arm, but it's like a F&I department in a car dealership. It's not just their job to finance. They sell you all those things that an F&I guy would do in a car dealership, being warranty, insurance, prepaid maintenance, things like that are very big profit margins for us. 50% profit goes right to the bottom line for those offices. So it's something we definitely want to implement into all the Apex locations and be able to expand our margins as we move forward. But Apex is a great acquisition for us. It's something that people are going to be talking for some time.
Brian, in all the short while I've known you, your enthusiasm has been infectious, and this next question is probably going to tell a lot why. Your company generated more than $82 million in the first 9 months of 2025, and you're projecting $140 million in revenue in fiscal 2026. Your fiscal year ends on December 31st, right?
Correct.
Okay. Now, all this forecasted growth, does it even include the Apex acquisition?
Great question, and no, it does not. That's why it's so exciting for us to make this acquisition, because we're dying to see not only the money it's going to save us, but in addition to our top line with all these new great boat brands we took on, Pursuit, Fountain, Solace, Nautistar, some great brands they've been selling for a long time. But it's a good point, and it should be noted too that, one, that doesn't include that, and two, the numbers we're producing now, they don't include our increased floor plan. So one of the goals we set to do when we did our IPO is taking a little money so we can increase our floor plan, which is the line of credit we use to buy boats with. From 25, it just got increased to $60 million. So none of that is factored into numbers that we've released yet. So I'm very happy to see both what Apex does and what the increased floor plan does to our numbers over the next couple of quarters.
Brian, you said floor planning. Now, that's not architecture here. Tell us what that means in your world.
So floor planning, it's like a car dealership. Great question. A lot of people don't know it, but floor planning is a line of credit that we have with a bank that allows us to buy our inventory when we buy boats. It's our floor plan. So our floor plan, before we went public, was only $25 million. So it limited our business a lot. There's probably 3,000 dealers in the United States, and we were working with probably 75 on a regular basis, mostly because we didn't have enough money to service them properly. So by going public, 2 weeks ago, we put out a press release that our floor plan just went from 25 to $60 million. So now we have more than double the buying power we did before. And that's why I was telling you the numbers before, very curious to see now, because the numbers you'll see coming out the end of the year are without our floor plan in effect. So these next couple quarters are very exciting to me, both because of the Apex acquisition, implementing that within the business, and also our increased floor plan gives us double the buying power we had.
Now, Brian, you're based down in Jupiter. You do a big chunk of your business in Florida, but you're not only a Florida company. In fact, the market for boating is huge all over the country. How big is it?
It's a huge market. I think the whole boating market's about 57 billion a year. But there's, 10 billion in used boats and over 1 million used boats sold every year. This year we'll do, well, I'm not going to say revenues wise, but we'll do somewhere between 450 boats this year.
Yeah.
And we're out of 1 million that are done every year. So we're just scratching the surface, and this increased floor plan, acquisitions of things like Apex are really going to drive the revenues and the profitability of this company moving forward.
And Brian, it's obvious that vertical integration is getting really strong with your company. Talk to us about that a little bit. How is it?
Yeah, so we own things like WeBuyBoats.com. We have an auction site. We also have Azure, which is our finance arm. Azure is very important to us. As we always look at our company, how we're going to increase margins as a wholesaler. Margins are typically, 9%. How do we get to 12, 13%?
Yeah.
And we feel it's by, acquiring things like Apex, but also inserting Azure into every deal they do. They don't even offer financing at Apex. So for us to put our Azure team in there, they sell not only finance, insurance, warranty, prepaid maintenance, all those things we can now do from the Apex locations on our own as well. That should greatly drive our margins.
And you said you own WeBuyBoats.com. That's your website.
That's our website. That's our main kind of lead finder. We get, 200-300 leads a week from there. People that just log on and enter the information on their boat and they want to find out what it's worth and if they can sell it.
With all the activity there, you still get most of your leads like through word of mouth and referrals and things like that?
I can go into that for a long time because we typically use boat focuses, right? We don't have depreciation. We don't have any of that stuff. So typically you get the best price on a boat from Off the Hook because we sell used, right? So all the, I know boat brands, you could buy a $2.3 million boat and a year later it's worth $1.3 million. That $1 million, we don't see any of that. So we typically always try and have the best price on every boat for both sides so that people want to come back to us time to time.
And again, just to reiterate, your used or pre-owned boats only. You just don't deal with brand new boats, right?
So, we are used focused. We're number one in the country buying and selling used boats for a reason. It's because of our platform. A normal boat dealership will turn their inventory 1, maybe 2 times a year.
Yeah.
We, because we're used focused, can buy any brand for anybody we want. We have no EM constrictions, and we turn our inventory 5 times a year. That's incredibly active compared to most people there, and that's because we're used boat focused. And we're able to do that because of our floor plan and because of our technology platform.
Okay, Brian, final question, but it's the most important one. Give our viewers the value proposition. Why should anyone be interested in Off the Hook right now?
I mentioned this earlier, but it's a great question. We are growing organically at a great rate. Right, our numbers were released, before March is over, we'll call it, and I think everyone will be very impressed with those numbers. And those numbers, it's very important to know they don't include our increased floor plan. So we had a $25 million floor plan that's now $60 million as of 2 or 3 weeks ago. So now we have double the buying power. So technically, hopefully, we're going to double the business. Right, there's that, and it also does include the Apex acquisition. We know they did $30 million in sales last year, roughly. There's a lot of things that they don't do that we do. Putting the whole Azure group into every deal they do should be a tremendous profit center for us. Being able to take their trades, make their deals happen even faster should be a great proposition for us. But we don't know yet how much money exactly having those locations are going to save us in storage, maintenance, and just washing boats and moving boats around, having them centrally located in our own marinas. So very exciting time to become involved in the company because it's all great growth stuff that we don't even know how much it's going to grow yet, but it's a good time to find out.
Looking forward to those 2025 results, and I am sure 2026 is going to be a great year. Brian, great meeting you, and thanks for coming out.
Great meeting you, great having you. I appreciate it. Hello, everyone. My name is Brian John. I am the CEO of Offthehookyachts. We are the largest buyer and seller of used boats in the entire country. We have an AI-driven technology platform that was started 13 years ago that keeps our teams from making mistakes. On the buy side, it's really important in used boats that you don't buy a boat wrong. You can make mistakes and have problems really quickly, and our system prevents that from happening. And on the sell side, it allows our 70 rep access to our inventory 24/7 They know where a boat is, where it's located, what's in the boat, what they can sell it for if there's any work being done. And the system's gotten so smart it actually connects the dots between buyers and sellers for our sales teams now. So in other words, if we're even shopping a boat or putting a bid on a boat, our system will automatically go out and find a broker that has a customer looking for a similar boat within our system and ping that broker and tell them to go show that client this particular boat. So it's really set up to keep us from making mistakes, and that's why we're number one in the country. It's our platform that allows us to do so. Recently, we put out a release, we signed definitive agreements to acquire Apex Marine Group. It is a very solid acquisition for us because it does a lot of things for us. It not only centralizes our inventory, but it brings us some great new boat brands. It gives us 5 locations throughout Florida where we can store our inventory, we can maintain our inventory, and these marinas will actually serve as sales centers for us as well, where we can have groups of people that store boats or work on boats inside these marinas that are always looking to buy and sell boats. So I think it's a great time to take a look at our company. We've been growing very well for 13 years. I'm looking forward to putting out our earnings, sometime this March, our year end. We've grown organically very well, as you'll see in those numbers. So it's a very exciting part for me because those numbers don't include our increased floor plan. Our floor plan is the line of credit that we have to purchase used boats with. Pre-IPO, we had a $25 million floor plan. Just recently, we announced that we now have a floor plan up to $60 million. So we have double the buying power we had, up through last year. So these next couple of quarters should be very telling. We also acquired, like I said earlier, Apex Marine Group that did roughly $30 million in revenues. We spend roughly $3 million a year servicing, storage, and moving boats around throughout Florida. So there's great potential for increased revenues as well as increased savings with the Apex acquisition as well. So very much looking forward to what the next 2 quarters look like when these things get implemented into our already proven business model. If you'd like to learn more about our rapidly growing company, you can always go to our website, offthehookyachts.com, for more information. Thank you.
Hi, it's Michael with RedChip. RedChip, it's an AI platform built to bring clarity and speed to capital market analysis. In fast-moving sectors like fintech and digital assets, investors and analysts are constantly evaluating strategy, risk, and positioning across multiple public companies, often in compressed timelines like today's conference. RedChip delivers content-rich answers sourced directly from SEC filings, press releases, and official company disclosures. That means no speculation, no hallucinations, only verifiable content. Instead of manually searching through filings or building one-off response packets, you can rely on RedChip to surface disclosure-backed answers instantly. That's time that you can get back for everything else in your portfolio analysis. What makes RedChip unique is that it's not just a wrapper on top of ChatGPT. We built a pipeline in-house, optimized for financial disclosures. Our proprietary retrieval augmented generation system ingests the SEC filings, our curated financial news networks, press releases, and more, and then, using a multi-stage processing pipeline, returns verifiable answers with citations. For investors and analysts, that means confidence. When you ask about corporate structure, governance, capital markets history, or the business model, that answer is coming directly from SEC file disclosures and not a large language model's best guesstimate. Let's put this into context and get hands-on with RedChip. We're hearing from multiple presentations, and we want to quickly validate how these companies define themselves in their own SEC filings. Take a look at Obook Holdings, trading on the NASDAQ with the symbol OWLS. I just heard from the C-suite management, and I want to understand its public market history. So I can ask RedChip, when did Obook Holdings become a publicly traded company? And through what type of transaction? RedChip surfaces registration disclosures from Obook Holdings, detailing the IPO and the transaction structure. Within seconds, I now have when and how the company entered the public markets. Again, sourced directly from trusting documents. In another scenario, Let's say I want to have a quick capitalization reference. I can ask RedChat, how many shares were outstanding as of OBOK Holdings' most recent filing? RedChat highlights the most recently disclosed share count from those filings. This provides a structural and current snapshot without manually scanning through financial statements. Now let's take a look at Blue Gold. I can ask Blue Gold, how does Blue Gold describe its business model? And on screen, we see that RedChat pulls up business language from Blue Gold's official filings. This shows exactly how management defines the company's model in a formal disclosure, not just how it's framed in a presentation. In another scenario, we could ask, what do they actually do? What does Blue Gold state is its primary business activity? What's its model? RedChat highlights the company's overview section from Blue Gold filings. This allows investors to quickly anchor to what the company actually does according to its filings. In a governance structure question, we can ask, what is the structure of Blue Gold's board and who serves on it? Instead of sifting through web pages or trying to search in a document, RedChat surfaces governance disclosures from Blue Gold's annual report or a proxy filing, listing the board members and the structure. In seconds, we can review the board composition and the governance structure, again, directly from those filings. Before we move on to our presentations, let me show you how to access RedChat at redchip.com. It's quick, easy, and it's free for investors. For the best access, you can find RedChat on the Apple Store, or by visiting red.chat, or selecting any stock from our portal at redchip.com. You can register for free and get an account that gains early access to premium features. For institutional investors that are seeking expanded capabilities, our team is available and can provide additional access options. Simply email info@redchip.com. Thank you again for joining this demonstration of RedChat. We'll begin in just a moment.
AI is consuming energy at unprecedented levels. Overwhelming power grids. Now meet BIMERGEN-ENERGY, just uplisted to NYSE American, symbol BESS, advancing 23 high-capacity battery farm storage projects, which will be a $2 billion suite of operating assets. BIMERGEN-ENERGY is backed by $250 million in strategic capital commitments, long-term revenue contracts, and federal tax credits. BIMERGEN-ENERGY on the NYSE American, symbol BESS.
As global AI infrastructure investment surges toward $500 billion annually, investors are focusing on the companies building the backbone. Now meet Sharon AI. Recently IPO'd on the NASDAQ with a $125 million capital raise, symbol SHAZ. Partnered with Cisco and NVIDIA, accelerating enterprise AI and high-performance computing throughout Australia and the Asia-Pacific region. Expecting rapid revenue growth. Sharon AI, SHAZ on the NASDAQ. Lantern Pharma, stock symbol LTRN on the NASDAQ. Lantern Pharma is revolutionizing cancer therapy development with its AI platform RADAR, the world's largest AI platform for oncology drug development. With over 200 billion data points and over 200 advanced machine learning algorithms, Lantern is developing breakthrough approaches across 12 cancer indications with 3 clinical stage lead drug candidates in clinical trials. Lantern Pharma, symbol LTRN.
AI data centers are pushing grids to the limit, and behind-the-meter power demand is booming. Meet ZEO Energy, symbol ZEO on the NASDAQ, commercializing its behind-the-meter power solutions that leverage advanced thermal and solar technologies for long-duration storage. Signed MOU to develop 280 megawatts of baseload power for a planned AI data center gigasite. Q3 net revenue up 32% quarter over quarter. ZEO Energy, NASDAQ symbol ZEO.
Billions have been invested in artificial intelligence drug discovery platforms. Now meet BullFrog AI, symbol BFRG on the NASDAQ, a technology-enabled drug development company using artificial intelligence and machine learning to enable the successful development of pharmaceuticals and biologics. BullFrog recently announced it has entered the commercialization phase of its robust AI drug discovery platform, BullFrog AI. Drug discovery technology is now being used to optimize clinical trials. BFRG, NASDAQ.
Property crime is a $27 billion problem. Meet Cloudastructure, NASDAQ CSAI, an award-winning AI security platform chosen by 5 of America's largest property management firms, including the nation's largest. With 97% proven deterrence, real-time AI surveillance, and operations in 18 states, CSAI delivers lower crime rates, lower losses, and lower costs. Now commercializing at triple-digit revenue growth, Cloudastructure is the future of property security.
America's public safety challenges demand innovative solutions. Meet Knightscope, NASDAQ symbol KSCP, led by former leaders from Ford, GE, Honeywell, and Deloitte with the mission to make America safer. Their AI-driven robots target a $230 billion market, now deploying with the U.S. federal government. Key partnerships include Verizon, law enforcement agencies, and winning contracts with the U.S. Air Force and Veterans Affairs. With 3 analyst spy ratings, Knightscope is transforming public safety. NASDAQ symbol KSCP.
The global market for AI-driven smart city solutions is expected to reach $11 trillion by 2030. Now, Gorilla Technology, NASDAQ symbol GRRR, has emerged as a leader in AI solutions for smart cities. 29 patents, a $1 billion sales pipeline, 220% revenue growth in the first half of 2024. Recently announced $6 million share buyback program, over $40 million in cash reserves. Gorilla Technology Group, GRRR, on the NASDAQ.
Every industry is undergoing a tech-driven reset. Now meet Off the Hook, symbol OTH on the NYSE American, bringing a centralized AI-driven technology platform to the marine industry, making it the largest buyer and seller of pre-owned boats in America. In 2024, Off the Hook reported $98.9 million in revenue, with management guiding up to $145 million in 2026. Off the Hook, symbol OTH on the NYSE American. RedChip. We build investor audiences for small cap companies, retail and institutional. 33 years, thousands of clients. We are experts in messaging, national TV ad campaigns, investor webinars, digital media, reaching hundreds of thousands of investors. RedChip. We do it well, we do it right, we do it big. RedChip. Call us or email us today.
Welcome back to the RedChip AI Investor Conference. It is 12:31 p.m. U.S. Eastern. Starting today at 12:31 now is going to be Knightscope, ticker KSCP on the NASDAQ. Presenting today is Bill Lee, Chairman and CEO of Knightscope. Bill, are you with us?
I'm here. Greetings from Silicon Valley. Hope everyone's doing all right out there.
Nice to see you, Bill. This is going to be not a formal presentation, but kind of a fireside chat with your questions featuring prominently viewers. Before we begin, just let me read that safe harbor statement. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Now, before Bill speaks, let me introduce Knightscope just a bit here. Knightscope is operating at the intersection of artificial intelligence, robotics, and public safety, with a long-term mission to make America the safest country in the world. The company is building what it calls an autonomous security force, integrating robotics, AI-driven software, and human oversight into a fully managed security platform. What's particularly compelling here is the scale of the opportunity. Security is a massive and growing market, estimated at more than $200 billion in the United States alone, and yet much of the existing infrastructure remains fragmented, labor-intensive, and often ineffective. Knightscope's approach is to fundamentally rethink that model, moving from standalone products and personnel toward a coordinated technology-enabled service designed to deliver better outcomes at lower cost over time. Now, if you have a question for us today, please join us by clicking at the bottom of your Zoom window there, the Q&A button. A text box will appear and you can submit your question there. Bill, are you ready?
I'm ready. Go for it. All the
Okay.
easy questions are incoming, I guess.
We're only going to give you the good questions.
All right.
Bill, we've collected many types of questions, but if we could conflate them all, it would be something like this. If you had to summarize Knightscope in one sentence for investors just completely new to the story, how would you define the company right now?
Combination of hardware, software, and humans to better secure our country. And the next generation of technology it's not automation, it's orchestrated. Basically getting all those three key things to work together in one managed service provider platform.
Now, Bill, you and I have spoken before, and you have said to me that the existing security infrastructure is fundamentally broken. And what is specifically not working? What's specifically wrong?
So let's talk about what is the infrastructure, because most people don't know, and then why I can assert it's broken. First, there's about 1.5 million guards. There are about 1 million law enforcement professionals, so about 2.5 million humans, about 100 million cameras, plus or minus. I think only 2% of them are actually remotely monitored. There are about 300,000 law enforcement vehicles. And the reason I can say that it's broken is because crime has a $2.7 trillion negative economic annual impact on the U.S. economy. It's a hidden tax we all pay in blood, tears, and treasure, and we're kind of just seem to accept it. You know, a violent crime occurs in the country every 26 seconds, and a property crime every 4 seconds. We do not have to live this way, and somehow we've gotten ourselves into this ditch that the local, state, and federal government is not set up to fix. I love our country, but in this particular area, there's a huge problem where outside our borders is one person in charge, the Secretary of Defense, $1 trillion budget. We give the troops every level of capability you might ever imagine. On our own soil, we do not do that. The U.S. Department of Homeland Security and the U.S. Department of Justice have no federal jurisdiction over 19,000 law enforcement agencies, 8,000 private security firms, and there's literally no one in charge. So you need a private sector company to reimagine and re-architect how we do security within our own borders.
Bill, now would be a good time for you to tell us how the company actually works, or the system actually works, from detection all the way to response.
Yeah, so the strategy is to deter, to stop the negative activity in the first place before it even gets going. Then you need to detect that something's actually happening. So we're in the process of putting 1 million machines in network across the country that can see, feel, hear, smell, speak, and autonomously cooperate. And then you need a response, something to respond. And that's two things. One is a remote monitoring capability for our future AI agents that we're working on, plus our humans to interact with the facility that we're remotely monitoring. And then most recently, we just announced the acquisition of Event Risk, a leading national guarding company of armed and unarmed security agents, for us to provide that full suite of capabilities to better protect the places people live, work, study, and visit.
You pioneer security as a managed service. I think that may be your quote there. How does that model translate into recurring revenue and customer stickiness?
So, we always talk to investors about, 3 risks. Do you have a market risk? Do you have a execution risk? And do you have a technology risk? We've now operated more than 4 million hours fully autonomously across the country. The technology can always be better, and we're working on a bunch of really cool stuff coming. But we don't have like a technology risk. there's a market risk. No, not really, because the market for crime is not going away tomorrow. It's not like everyone's going to wake up tomorrow morning, everyone's going to start behaving, and everything will be fine. So there's not a market risk. So what we really need to focus on is basically just execution. And for us, it's really important to be able to go to market in a unique way. So let me just be frank. Most humans don't want to change. Most large organizations don't want to change. So if you were to imagine a PowerPoint presentation here with a bar that was this tall, and you have all the guarding companies over here that employ, you know, a million and a half folks. And then you have all the Tom, Dick, and Harrys that have some sort of widget that they want to sell into public safety, law enforcement, security to disrupt this area. It's a tiny percentage in terms of headcount. And this hasn't changed over 10, 15 years. So what I told the Pentagon and DHS and Congress is, and my own board, are all these CEOs incompetent? They don't know how to develop new technologies or develop new products and services? The boards can't set the right strategy? Or is it the market doesn't want to change? And it's likely, in our thesis, that the market doesn't want to change. So we need to put this in a format that folks will more easily accept. A good example, Craig, would be, I think I've only know of one county that's ever put out a request for proposal for X number of security robots. Most requests for proposals come out with, I need X number of cameras, Y number of guards, and that's it. So if you're a technology provider, you literally can't quote. You don't have the guards to actually deliver that. So what we're doing very carefully is to be able to sell into these large existing clients of ours and new ones that are in the pipeline, for us to come to them with a solution of, you know, you wanted guards, here you go. Here are a bunch of technologies that we can help you implement and have us be accountable for it. You always got to remember, Craig, that most chief security officers are ex-military, ex-FBI, ex-law enforcement. They're now being asked to be, please be chief technology officer, please be chief information security officer, please be the head of facilities, the IT person. Like, that's not what they were trained to do. And society has now put all this technology on them, and they're trying to figure out how to get all the pieces of the puzzle to work. Need one company, one managed service provider to be able to be that trusted advisor and supporter of that chief security officer.
Bill, you have brilliantly outlined the market that is, you're saying, resistant to change, but there's willingness to change, otherwise you wouldn't be in business. Would that be right?
The industry is so fragmented, and we've tried for a very long time to just focus on the AI side, on the software side, on the robot side, and we can continue to build awesome technology, and there's some really exciting stuff coming the balance of this year. But if you can't get it implemented, like, you're going to have a problem.
Yeah.
The US federal government, like, I think we probably could have saved them $10 billion a year by now, by just, if you would just frankly just implement the commercially available technology, but you're unwilling to do so. So I've been working with a bunch of folks to try to pass a national robotics strategy. And part of what I've been proposing is for there to be a mini mandate by Congress or by through executive order from the administration to mandate that every department and agency must take 1% of their operating budget for maintenance, service, and support, and thou shalt use automation, robotics, whatever it is. We're not asking taxpayers to spend more money. We're asking the government to properly use the funds that they have to be much more efficient with our own tax dollars.
Brilliant, innovative ideas born of decades of experience. It's just seeping through here, Bill. But why you? Why is it only you? Why can't anybody else come and set up a company that replicates your model? Why are you special?
Well, we try really hard. We're not perfect. But we get up every morning, and even though we got punched in the nose, you get back in the morning and dust yourself off, and into the ring you go. And we're on a mission. People think I'm kidding around. Like, we're serious. Or this next month will be our 13th year anniversary We're not going away. We are going to force what we want to get done for the country to get done. Plenty of other companies have tried. Three major corporations and at least three funded startups. All of them have failed, gone bankrupt, or given up. And it's because why? It's hard. Autonomy is very difficult. When I said this in 2013 when we started, I mean, now there's finally a little bit of scale with billions and tens of billions of dollars spent by all the self-driving folks. Still haven't gotten it to scale across the country. So the technology is difficult, but then you've got a sector, and I'll try to be polite here. The public safety, law enforcement, security part of our economy is not the most technologically progressive sector in the world. And so you're trying to get folks to change. But there are folks, a lot of prospective clients that have seen what we're doing and going, so you're going to be held accountable and you're going to help me improve quality and you are going to hopefully reduce my costs and reduce incidents because you have an orchestrated combination of hardware, software, and humans that can actually tackle the problem and not fragments of a bunch of equipment just dumped on the site and then no one's monitoring it, no one updated the firmware, no one's looking at it, no one's getting the detection from the camera or sensor off to the guard for the remote monitoring person to actually dispatch things in a timely manner. That doesn't happen today. And so I think the country deserves a strong level of technology, no different than what we do outside of our borders.
Glad you mentioned the country. That segues nicely into this question. As you said, or we said earlier, we're going to make America the safest country in the world. And now what would that exactly look like in, say, 5 or 10 years?
Okay, so I think we've worked the problem for more than a decade now. The mission sounds ludicrous. Probably the more ludicrous statement is I think we actually know how to do it. Now we just need to focus on execution. Just a quick math problem, Craig, for the audience, and maybe that'll help with the understanding here. So I mentioned there's about 2.5 million humans trying to secure the country. But remember, they're running 24/7. So at any given time, there's only maybe 600,000 people. So 600,000 humans are supposed to secure 332 million Americans across 50 states with the technological equivalent of a number 2 pencil and a notepad, and then we're wondering why it doesn't work. It's like, okay, well, you've got 20 to 30% massive understaffing in law enforcement agencies. You've got 100 to 400% employee turnover rates in the guarding industry. Yeah, it's kind of broken. So our theory is that if you were to have an orchestrated solution to actually lock down a premise and have consequences for negative activity, plus you would add 1 million machines in network that provide the physical deterrence and would be the additional eyes, ears, and voice for those guards and officers for them to actually be able to do their jobs much, much more effectively. You're basically adding, instead of just the 600,000, you'd have 1 million machines supporting those 600,000, the likelihood that we can lock down a place properly and have a positive impact on insurance rates, positive impact on municipal budgets, positive impact on your local business, on the safety of your family. Like literally you would change everything for everyone. And that's why I've decided, after 9/11 to dedicate the rest of my life to better securing our country. And, people should, think about if someone's willing to go to the mat for over a decade and actually make progress towards the goal, like maybe you should reconsider how you think about Knightscope.
Thanks for that, Bill. Okay, so we talked about 5 or 10 years from now. How about like the next year or maybe into the middle of 2027? What milestones or proof points would you be able to point out to investors and say, look, we're doing it in that time frame?
Man, there's so much on the list for this year. So in no particular order. One, we just announced this significant acquisition. Obviously, there's that 71-day rule that we can't really disclose the financials until they're all audited and everything else. So that'll put us basically sometime during the second quarter. You can see the impact of that acquisition. We did announce that we quadrupled the headcount of Knightscope, so we're now more than 400 strong. And that's not adding a bunch of costs. That's revenue generating opportunities for us. And you'll see the financial impact of that when we file the 10Q probably in mid-second quarter. Other shorter term thing, if folks are here in Silicon Valley or wanting to come and visit, we're having our first annual Autonomous Security Force Day. So that'll be April 2nd to unveil some new technologies, get some market feedback, and also celebrate our 13th year anniversary here at Knightscope headquarters in Silicon Valley. So you can check out our social media feeds for the RSVP there if you want to join and come see the technology for yourself. Next one, the K7. We have a four-wheel vehicle coming out in limited release the second half of this year. If the board's excited, the management team's excited, the team's excited, the vendors are excited, the market's excited, and the recruits that are dying to come work on the machine are excited, like maybe we're onto something. So we're really excited about working on that. And then we have an all-new K1 capsule and super tower, so the next generation of blue light emergency Internet of Things devices also coming out the second half of this year. So you're going to see product, you're going to see financial impact, and then an all-new breakthrough software solution that we call Signals that will orchestrate all this technology and human activity into one very interesting field of view.
And what is, how can people find you on X?
It's at iKnightscope, and for me, it's W Santana Lee, and happy to interact there.
And what is that conference next month in Silicon Valley? What's it called again?
So it's going to be Knightscope's first annual Autonomous Security Force Day on April 2nd. So the afternoon will be VIP sessions only for chief security officers, major decision makers to get a private preview of what's going on. And then the evening will be an open house for folks to come get a robot selfie.
Now that leads to this question. When you're at that conference, are you going to say that autonomous security is going to become the default model for the industry, or are you going to say something different?
I am going to let our results speak for themselves. And we're just we know we have the right strategy. We just need to go execute, and then we'll let the industry do what it's going to do. But we're focused on our clients and on delivering much more positive outcomes and improve the efficiencies overall.
Now, when these customers and prospective customers come up to you and talk about why they need Knightscope, what are they saying? Are they saying, is it increasing crime? Is it labor related, labor shortages maybe? Oof. Is it cost pressure? What's on these people's minds?
So we go through these oscillations, right? So unfortunately, the chief security officers is going to sound terrible, but in organizational structure, sometimes low man on the totem pole. So they're the cost center. They don't generate revenue, don't enhance the brand, blah, blah, whatever it is, right? So the management team keeps cutting their budget, and then incidents start happening. And then they start like, hey, but I don't have the budget to do what I need to do. And oh, by the way, all this is fragmented and I can't get all this stuff to work, but let's keep cutting the budget. And then finally something awful happens. Then they get a bunch of budget. Then they try to fix the problem with, kind of duct tape and taking the existing solutions, and then it goes through the same cycle again. So they're dealing with a lot of incidents in terms of theft, people just breaking through critical infrastructure locations and stealing copper. Someone at the Pentagon told me first 6 months of last year they had like 17 foreign nationals try to get on military bases. It's like, guys, we kind of need to lock this stuff down. So a lot of it has to do with incidents. I will be frank, a lot of them have a lot of challenges with budget because of the cost. It's similar to cybersecurity. You're not ever going to be done, and it can be costly. So what we want to do is turn the whole thing upside down and see if we can re-architect it so everybody can get what they want. Let's lower the incidence and let's see if possible to reduce the cost and improve the efficiencies.
You talked a lot about the human factor just now. Why hasn't a purely software or purely hardware solution worked in this market?
Because that's not how the world works. You're gonna download a law enforcement patrol vehicle from the cloud? Like, like you need to be able to deter activity. A lot of cameras, if they're on, are really good for evidence and investigations, but that's not going to deter any kind of negative activity. And that's an unfortunate, foolish thing that, a lot of Silicon Valley used to think. I think it's finally changing. Like, oh, software is going to fix everything. I'm sorry, but that's not how the world works. So the other part of that human element is the response, the enforcement, but that also needs to get reimagined. So we will be defining the next generation security guard, or what we're going to call the augmented security agent, to actually put interesting set of technologies on the person for them also to be that much more effective and contribute as well as the robots do.
Now, your network, as it scales, does the installed base, does it learn? Like, does the data or the AI advantage, does it compound over time?
With the new set of technologies, that is the idea, to be able to both from a detection standpoint and a navigation standpoint. From an autonomy standpoint, you want to think about it. We're patrolling the same thing over and over and over and over again. We should be able to learn from that environment, use the historical data, but also from detecting different types of activity. I think is 93% of alarms are false. So a lot of the work that a remote monitoring center needs to do is labor intensive and unfortunate. There's a lot of opportunities for us to put in a bunch of AI agents, like an autonomous layer, for that to be handled by compute and not by human, and only escalate to the human when you actually need decision making and a response. So again, this is what I mean by orchestration, is like take all the awesome technologies that are out there, from telecom to data storage to data transfer to compute at the edge to autonomy to robotics, electric vehicle technology, solar technology. Take all that and put it into an orchestrated, thoughtful, new architecture to basically secure the perimeter and secure that location.
Thanks, Bill. Couple more questions here. People still want to know about the bottom line. Like we could frame it this way: the evolution of your margins. What's going to happen? How should investors be seeing your margins as you move from those more human-heavy deployments to greater autonomy?
I think over time, you're going to see us grow significantly the top line revenue as we add the additional security force guarding element. And then over time, we're going to continue to add more and more technology for better outcomes. So AI should basically rewrite the economics of the industry. And this is not intended to like, oh, well, we're just going to put people there and have like a staffing company model, and that's the way it's going to work. Is basically, how can you get wildly more efficient capabilities using technology so you can get some really nice margin expansion while delivering a higher quality service to our clients.
And again, people want to know about growth, Bill. Next 12 to 24 months, you may have covered it before, sorry, but if you could just reiterate, the biggest growth drivers for Knightscope in the next year or 2 years.
3 items that we've been focused on: organic growth from the existing business, new product-led growth, like the new K1 capsule, Super Tower, K7, and our new Signals software platform. And then inorganic growth. We'll continue to look at possible accretive acquisitions, and we're really excited about our most recent one, which is, in my view, transformative for the company. We literally quadrupled the size of the team, and I couldn't be more excited about Knightscope's future, even since the inception. Like, finally, everything's clicking. We got an awesome board, awesome management team, technologies in place, acquisitions in place, access to the capital markets. Everything's kind of clicking. So we're in very, very good spirits here.
Excellent, Bill. Great talking to you. A very interesting discussion. I love this format, just getting the viewers' questions. It's just a good way to talk. You are passionate about what you're doing. It really shows through. Again, that's Knightscope. That's NASDAQ symbol KSCP, Knightscope. We've been talking to Bill Lee, who is the CEO. Bill, thank you very much for being on with us today.
Thanks, Craig. Everyone be safe out there. Thank you.
Thank you. Thank you,
Cheers.
Bill. All right, next at 1 p.m., which is 8 seconds away, we've got Jack Liu, Director of Corporate Development for Ainos, ticker AIMD on the NASDAQ. Jack, are you there?
Yes. Good morning. Good afternoon.
Morning, good afternoon. We're all around the world, so it could be morning or afternoon wherever you are. Jack, thank you so much for joining us. Again, it's Ainos, ticker AIMD on the NASDAQ. Jack, let me just get some preliminaries out of the way, and you can begin.
Right.
Of course, we want your questions, so please, if you're on Zoom, find your Q&A button there at the bottom of your Zoom window. There will be a text box, and you can type in your question. Let me do the safe harbor statement real quick here. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements, and of course, forward-looking statements involve risks and uncertainties. Jack, please go ahead.
All right. So, good afternoon, gentlemen. My name is Jack Liu. I'm the head of corporate development from Ainos. So I'll be doing the presentation today, but before I start, due to the connectivity issues on my end, I'm going to turn off my cameras and we'll focus on the slides. Okay, so our title is Smell the Futures, and this is going to be the kind of implied our business and also the rest of the slides. Here's our own version of forward-looking statements. Just to leave it here for a while for everybody to understand. Okay, so let's get to the main points. So our company, Ainos, ticker AIMD, we're in the business of teaching AI to smell. And really, there is just this mega opportunities that we're seeing over the next decades to come. That is, AI cannot smell yet. If everybody has tried AI, they have mastered text. They can speak really well. They can give you, all kinds of content really well. They can hear really well. They can see really well. But there's always one sense missing. That is the sense of smell. If you went through the GTCs on NVIDIA a couple days ago, typically they come up with all kinds of robots. And you will see one universal theme is none of the robots have a nose. And that's the secular multi-decade opportunities that we think we are trying to capture. And we think we have the right technology to do that. The way we do that is we are converting smell data into machine-readable data. So longer term, this could be a new kinds of tokens that AI can play and understand with. And our solutions is called AI nose. So very straightforward. We're trying to be AI's nose. We're trying to digitize smell into smell IDs. And the reason we say that this is kind of a multi-decade mega trend is that if you think about how computer vision have evolved, it took about 30 years ago. I'm holding a Nokia phone with a very basic VGA cameras. And now today, with the advancement of camera sensor getting so good today, we can do Zoom calls. Our cameras are now taking pictures in tens of millions of megapixels. There's 2 or 3 cameras on your phone, sometimes even 4. Your cars are now equipped with all kinds of sensors. And that's all the underlying principle is the camera sensor just gets way, way better. And you add connectivities and all the computing power, and this is where we are today. And from our perspective, we think smell, we're at that beginning of that moment. So there's a massive, massive runway to go for this technology, in our opinions. So how we're doing it, we're basically turning smell into scalable intelligence in really 4 easy steps, as I show here. We have a sensor hardware that are deployed into the real world environment and trying to capture the sense signals, sometimes in a very, very tiny traces, in the sensitivity down to parts per billion level. That's the kind of level where human nose simply cannot smell. Sometimes dog even cannot smell that. So once the hardware captures the data, we convert that analog smell signal into digital signals. We call that smell IDs. So you can think of that like the Face ID, but this is for scent. And then we have a AI, our proprietary AI that we've been trained for about 13 years. It's called the Smell Language Model, or SLM for short. And what this model does is basically contextualizes the smell IDs, giving that smell ID content. Is this banana? Is this coffee? Or in industrial environment, is your cable gonna overheat, or are there gas leaks? Or sometimes in the medical settings, are you sick? And then we can turn all that into intelligence and apply it to the real world settings. So 4 simple steps. It sounds really simple, but there are a lot of the know-hows into it. It's really a process of teaching AI to smell, kind of like how you teach a little baby to smell. How do you teach a baby to smell a banana? You give them the banana, let it smell 100 times, and keep telling them, baby, this is a banana. And this baby, over time, you remember, okay, this is a banana. So next time I smell something like this is the banana. You took another type of banana and then it trained it, and you will learn. This is that simple process. And for us, the process is very, very quick. For our AI to understand a new smell, you really just have to let it smell it for roughly about 30 to 100 times. And then you will literally remember that. And that's the benefit of having a trainable SLMs to do this process. And we deliver everything, our hardware and our also SLM analytics service, into what we call the Smell Tech as a Service business model. So we're turning smell business into a SaaS business, and in turn, we are trying to generate a recurring revenues as we scale the deployment across our target use cases. So on that strategy, what we are trying to build is a data flywheel based on the Smell Tech as a Service. It's very simple. The more noses out there collecting more smeller IDs, the more data that we can feed into our SLM, and it gets smarter over time. And then as this thing scales, this becomes a very, very positive data flywheels, creating actually a very strong data moat for us. And the smell ID will be the key data assets that we will be possessing and gonna be very, very valuable. One thing throughout this process, we think we can create a very strong entry barriers because collecting smell data is very different from, say, how ChatGPT or LLMs learns the language or other senses. You can't really scrape smell data from the internet. You just gotta literally deploy the product and smell it and understand it. So there is a real process to go through. And whoever gets the product deployed into the market first and collected the mass amount of data first, we think this company will have a real competitive advantage in this very new AI category. And in our opinion, we think Ainos is positioned for that. To optimize our business model, we kind of turn this AI nose technology, put it into two entities. The nose entity, the hardwares, and the physical deployment, the gateway to the real world. That's Ainos, AMD, the parent company. The SOM, the brains, is going to be developed by our 100% owned subsidiary called Send AI. So within AI nose platforms, Ainos is the nose, and Send AI is the AI. And this we will close this loop and within our group and controlling this data. So the benefit of that is as deployment grows, our data advantage compounds, the advantage scales further, and our underlying recurring revenues will continue to grow bigger and bigger. So this is our systems that are currently deploying. It's roughly the size of a smartphone, roughly the size of your iPhone Max, Pro Max, slightly thicker. So this is a completely portable device. We designed it this way so that our customers can easily deploy into their target use cases. Within this hardware, we use about the best sensors from the best companies in the world. So there's about 13 sensors within this little tiny boxes. Within this box, we optimize the sensing environment for, say, humidities, for temperatures. We make sure all the sensing happening within the box so that we can create a very controlled environment because catching smell, one of the big issues is it's a dirty environment. There's all kinds of noises. When I say noises, I mean you got to think about temperatures, you got to think about humidities, distance, etc., etc. And we kind of just normalize all that within this simple box. So this one is really like a breathing device. There's a air inlet where it sucks in the airs and do the processing within. And then there's an exhaust vest, kind of like your nose breathing out that air. And then every cycle, our machines will clean up itself again so that it makes sure the environment within is clean and controlled over time. In certain industrial settings, we'll even set a buzzer outlets. So if there's an anomaly, our clients will be able to see it. And there are indication lights so that our clients will be able to see it. And it's completely cloud connected, software controlled. The data can be sent out to our clients, whether it's through cable wires, Bluetooth, or just Wi-Fi, depending on their choices. Our clients will be able to see them on their dashboard or connected to our devices on the back end. Or we offer apps so they can see it on the iPad or the iPhone so they get this instant alert. The best thing is this is not just a typical, gas sensor on top of your roof. This is a trainable device. You can train it to smell what you want. And as you deploy it at scale within your factory, for example, we can actually help our clients create what we call a scent map, a unique smell-based fingerprint of their environment. And that's the assets that they really, really want. So unique thing about our technology, We actually developed AI nodes started from healthcare. 13 years ago, our first products were for medical devices, testing breath or other parts of human emitted volatile organic compounds for different kinds of disease indications. Over that 13 years, because of our healthcare background, we really set up a few foundations that help us to scale further out. Number one, because it's a medical device, it has to be super sensitive and super accurate. We have to go through, so it's a very robust technologies. So we went through that cycle for about more than a decade. And roughly 2 years ago, we always know that this technology is very, very scalable across all industry verticals. So roughly 2 years ago, we started to do a strategic industry expansions. Within this chart, we first go from the left side. We started to targeting industrial market. That is smart manufacturing, meaning that factories with all kinds of sensors, smart factories, robots, defense, public safeties, because a lot of robots go out for patrols. Also, we know there's a huge opportunity on the right for food safety and environmental safety. But for our expansion journey in the next 12 to 24 months, a lot of the tractions that I'll be talking about in the next few slides will be focused on the graph on the left, smart manufacturing, defense, public safety, and robotics. And all this, the underlying principles are the same. Sensors, SLMs, digitizing everything into smell ID stored in the cloud. If you see this, a lot of robot head on the right, that's how we train this AI node to smell in our labs. Each boxes is a unique robot nose. So a lot of that in our lab, trying to collect data and train the SLM so it gets smarter over time. So within the industrial market, our first target is manufacturing. And within manufacturing, our first traction happens within semiconductor manufacturing. What we realize is again, like I said, the more devices we deploy, the more data we can extract. This SLM gets smarter, and our smell ID becomes more valuable. So the best application scenarios is actually factories, because factories, everything is constant. They're generating all kinds of data, and they run 24/7. To us, this is like a gold mine. And when we go and talk to our semiconductor customers, we started to realize there's a real need for them, because if you if you go into any of these semiconductor factories, the first thing you realize is it's now fully automated. There's all kinds of sensors within those factories, monitoring how the machines work, camera sensors, vibration sensors, humidity sensors. But the universal thing that they're really trying to catch is scent. Because at semiconductor manufacturing is a very chemical intensive process. So naturally, there's all kinds of scent. The first thing they worry about is as these manufacturing technology gets more complex, as they make chips for NVIDIA's next generation GPUs, tiny contaminations, tiny factors can affect the entire process. And scent is something that they're always trying to capture. Very small contamination, there's a big impact on the yield. So smell often is the signal that you first get before you can see it or hear it, especially when it comes to chemicals. And these factories, they run 24/7. So our product, we offer them a 24/7 monitoring that help them to cut down downtime if there's an issue, because we can help them monitor constantly, alert problems before it really becomes a problem, because we can sense things at parts per billion sensitivities. And that really improved their efficiencies, because right now, one of the problems they're facing is there's a gas leak. They gotta bring everybody out, try to debug the situation. And then that typically takes a few hours, and then bring everybody back. In semiconductor, they just can't waste that kind of time. So we have a real value proposition for them. As they deploy our product at scale within their factories, they can build their own smell ID data. And for us, it improves our SOMs. And for us, it improves the customer stickiness. For our customers, then scent become a new manufacturing data that can help them improve process, help them improve equipment maintenance, improve worker safety, improve environment, and emissions monitoring. So there's a real opportunities here. And within semiconductors, for those who are unfamiliar with the process, there are two general process steps. We call it front end. That's the big wafer you see on the left of the pictures. These are companies like Intel, Micron, TSMC. They make chips on these little wafers. And then there's another process called backend, where pictures on the right. You turn these bare dies, you package them, you put them into the tiny little modules that eventually goes into the machine boards. This is the backend process. We have right now tractions within both market. Our first commercial traction actually happened in the backend first. We already have a signed deployment relationship with this company called ASC. This is the world's biggest backend semiconductor process company. You can imagine all the Apple chips, Apple Watch products, NVIDIA products. ASC package all of them and test them. They have over 50% market share, and with manufacturing footprints all over Asia, in the US, and even in Europe. So we've been working with them for a while. Now we're in the stage of secure our first order with them. Now we are deploying about 1,400 Ainos systems into their factories. Now, because we set this up to be a subscription-based service, so for that 1,400 orders, the 3-year subscription value is about 2.1 million. That's just on certain areas within their factories. We have a long-term roadmap, to scale the deployment up to from in the near term, in the first agreeable terms, into somewhere around 20,000 AI nodes. Allow that to scale that, we still need to subject to further validations and contract agreements. But this is the roadmap that could potentially scale our confirmed order by more than 10x in the next 12 to 24 months, if we depending on our commercial traction with them. So for this 1,400 AI nodes orders, we are now targeting to complete deployments by around end of Q2. So this will become a revenue-generating product for our company going into back half of this year. And we already received a deposit from this particular customer for these particular orders. So this business is now secured, and there's a potential scale to go up 10x down the road. And we think we're barely scratching the surface. So that's the back end. The other thing we're working on is on the front end, the chip makers. And we are conquering this particular market through our ecosystem partners, because we realize that front-end manufacturing is a very, very complex process. Every little modules within the fab is like their own ecosystem. So we need different kinds of partners with their unique capability to help them serve these front-end chip makers. And this is the most valuable part of the semiconductor supply chain, because They spend billions and billions of dollars in capex and building giant mega fabs. Even now, like Elon is talking about building a chip fab because he knows there's just not enough out there. So our first partner is a company called TSC for short. This is a Taiwanese company. They've been serving the Taiwanese semiconductor supply chain for 35 years. And that's basically from the very, very beginning of this industry. They bring very strong customer access and a global service network because they've been this trusted partner for these chip makers for a very, very long time. So they are a natural extension of our sales force to serve these front-end companies. Our first target, again, is on the front-end chip manufacturing companies, but we think this relationship can go far, far beyond semiconductors, even go into environmentals, wastewater treatments, or even food business because they are a conglomerate and they have business in these kind of areas. So this is our partners, number one. Our partner number two, this is a company, another Taiwanese company called Truthful. Again, they were helping us penetrate deeper into these front-end chip manufacturers by a few ways. They are the installers or service providers for all these fab infrastructures. So they know the ins and outs of the chip fabs. So when we go in and trying to install the product within these chip fabs, they are our best partners. And we already have a committed minimum commitment of 600 Ainos systems in place. Robotics. We now have a partnership with an Asian company called Merle. They make robots and robot dogs, as you see on the right. And they are looking to deploy this into industrial settings like semiconductor factories. So for us, adding this sense of smell onto the robots is a very natural fit. And this is something that we just announced, and now we are in co-developing stage. Expansion opportunity in the food safety. We already done that in our labs. We're able to test fruits, meats, seafoods, bananas, good bananas, bad bananas. We even been able to identify coffee, even down to brands of coffee with more than 90% accuracies. So we think there's a real opportunity for us to explore the food safety market down the road. Healthcare origins. These three products are the basis of our development for the past 13 years. We've been developing products for women's health, pen, these are breath analyzers, or even intensive settings like pneumonias in the ICUs. And all these set up the foundation for us to deliver very accurate, very sensitive solutions into the industrial markets and beyond. And these are all medical devices. So as you can see, there's no joke when you're trying to develop medical devices. And within the healthcare, we are now extending beyond the product I just showed you into elderly care. Our first target market is Japan, where there are now roughly 65% of the populations are now 65 and older, 2/3. So they really need this kind of product where we can deploy into the care centers and help them to constantly monitor these senior people's bowel movements and trying to reduce the labor burdens of the caregivers because right now there's just not enough of them. We've been working with the Japanese companies on this front. And throughout this process, we also de-risk our business model in the healthcare. This product is not a medical device. It's a monitoring tool. So we save a lot of risk on trying to conquer the regulatory hurdles that a typical medical device will be facing. So long story short, investment summary. We are in a secular mega theme in smell. We think smell can be a new AI infrastructure data. We have a first mover in trying to define smell as a new category for AI. And throughout, we're building this into a smell tech as a service recurring revenue business model. 2026 kicks off our first commercial inflection point with a paying tier 1 semiconductor backend customer and the scale roadmap to potentially go 10x down the road. We have a growing industrial ecosystem where we are now in the front-end validations on the front-end semiconductor side with about 200 AI nodes. We have an ecosystem committed for 600 Ainos. We have development in robots, healthcare, and consumers. So things are looking up for us. That's it. Thank you, guys. I'm opening up the floor for questions.
Yes, Jack, thank you very much. We've been receiving a lot of questions. We only got 90 seconds left, so let's make them short. Basically, the idea that we've been getting is this from the investors. What do you believe the market is still underappreciating about the long-term revenue potential of Ainos?
Absolutely. I think this year is marked the beginning of our commercial inflection point. Last year, our industrial expansion set up the foundation. Now, as you can see, this year is our time to scale, and we've been trying our first target. We already have a confirmed orders, and that could potentially scale 10x. And semiconductor, this is a massive business because these guys are cranking out factories like nobody's business. As they build these new fabs, it's natural for them to develop the next generation sensings, building smell into their value chains. And as I just told you, we haven't even get into the robots, food safety, automotive environments. So the opportunity is massive. I would say if you look at CMOS sensor market today, we are probably 30 years from now, we're probably there.
Beautiful way to wrap it up at 1:30 p.m. exactly on the nose. Thank you very much, Jack. It is Ainos, AIMD on the NASDAQ. For more information on the company, reach us at 1-800-RED-CHIP or email us at aimd@redchip.com. Jack, beautiful presentation, fascinating company. Thank you very much.
Thank you, guys.
All right, it's 1:30 p.m. U.S. Eastern. Our next company is BullFrog AI, BFRG on the NASDAQ. Vin Singh is the chairman and CEO. Vin, hello.
Hi, Craig. Good to see you.
How have you been doing?
Doing great.
Great to see you again. Looking forward to this update on your great company. Let me get some preliminaries out of the way. I see you've already got your presentation up on the screen, so we're ready to go. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. And of course, forward-looking statements involve risks and uncertainties. To our many viewers out there right now, we would love to hear from you. Go to the bottom of your Zoom window, click the Q&A button, a text box will appear, submit your question. We will collect the questions and ask them to Vin at the end of his presentation. Vin Singh, please go right ahead.
Okay, great. Well, good afternoon, good morning, depending on where you are. It's great to be with you today. My name is Vin Singh. I'm the founder, chairman, and CEO of BullFrog AI. We are an AI innovator applying AI to the challenges in the world of life sciences, biotech, and pharma. Really excited to give you an update on what's happening with BullFrog. So what we are really aimed at doing is solving some of the big problems that exist in the pharmaceutical industry. Many of you are probably familiar with this, but let me just run through it. Basically, pharma spends a lot of money on R&D, and their success rates are incredibly low, and they really shouldn't be. And this is the reason BullFrog exists. This is why I started the company. It may be a shock to some of you to learn that big pharma fails about 50% of the time in phase 3. And remember, it takes 10 to 15 years and $1 to $2 billion to develop a drug. So that's a lot of very expensive failures. And small biotechs, they don't have the tools needed to help them de-risk their projects and get to the finish line. And really, there's an urgent need in our industry for AI solutions that are designed for drug discovery and development, and that can be scaled. And that's what we have at BullFrog AI. I always like to start off with, why should you be investing in BullFrog? Why should you care? Well, there's a few really important reasons that I'd like you to know. Number one, we, like I said in the beginning, we're an innovator. We have a proprietary AI platform that is built for drug discovery and development. The technology, the core technology comes from Johns Hopkins University Applied Physics Lab, which is a $2 billion subsidiary of Johns Hopkins they work on sensitive defense-related work. Incredibly innovative organization. This technology that they developed, this AI platform, won Innovation of the Year there. So we came out of the gates with blue chip technology. And I can just tell you anecdotally, we have advisors from big tech, and they've looked under the hood, and they've told us that what we have is 10 times more sophisticated than the things that they've seen. So we know we have really good technology. We also have some phenomenal partnerships. One in particular is around CNS, and I'll talk more about that a little bit later. Also, we are engaging big pharma for commercial deals. And you've probably heard me talk about this for a while. We're very, very close to getting these deals done. We have a very nice pipeline. The deals that get done with pharma, typically, you're going to start off with a pilot and then move up from there. And we're hearing very, very positive things from pharma. We've heard from multiple big pharmas that nobody can do what we can do, meaning BullFrog. And that's really exciting and comforting. But the proof is, in the pudding, and that is get a deal done. And then, we will show them exactly what we can do. And also, we have a very lean operating model. We only burn about $6 million a year, which is, incredibly low, especially if you look at other companies in our sector. And I've been saying this for 8 years since I started the company. If you have really great AI, you don't need lots of employees. We've been consistent with that since we went public 3 years ago. Our burn has not changed. It doesn't need to. And even if we win contracts, we'll have to do very little hiring. So the economics are phenomenal. So with our AI, we can basically decode the complexities of biology. And biological systems are incredibly complex. What we do with AI for biological systems is the most complex application of AI. Okay, we deal in a world where the number of samples or the number of individuals can be small. It's not millions, billions like in other industries. It could be 50 or 100, but it could also be in the millions. And then the number of variables that we deal with is incredibly huge because of omics data. Those variables can be in the millions, whereas in other industries, it might be dozens or hundreds. Just think about all the different applications, right? Electric vehicles and energy and so on and so forth. This is a very challenging space, and our tool, our technology is a good fit, and we've proven ourselves. And again, the core comes from Johns Hopkins. We've continued to sign improvement licenses with the APL. And then we've added our own secret sauce on top of that. And now we have what we believe is truly one-of-a-kind platform. The market for data is rapidly expanding because that's the other side of the equation with AI. You need great technology, but if you don't have the right data, that tech is useless, basically. Fortunately, the markets for data are rapidly expanding. And this is the type of data that's really rich and valuable, and that's where you can make discoveries and insights. If there's an opportunity in the future, a chance to eradicate disease, it's because of what you see on the screen right now. So this is good news for us, and it's good news for the industry as a whole. I said at the top, we are an AI innovator. So, what we've done is we've developed a series of tools, AI tools, okay? And we're applying them to problems and challenges that we see out there. These tools can be part of partnerships with pharma. They could be one-offs that get us in the door with a company, and then we can expand from there. But we now have end-to-end solutions, okay, for this market. The first solution we have is something called BF Prep. More than 60% of companies across all industries do not have AI-ready data. But we hear about AI in the news all day long, every day, right? And how those, the monster companies are integrating, their software, their solutions into the systems of companies from, every industry on Earth. That's great and all, but if your data is not ready to be ingested by an AI, then you can't do anything with it. We have a solution, an AI solution that cleans and prepares and structures data, and we can do it extremely quickly. And we've done it, like I said, with the most complex data, messiest data that you'll see across any industry. We can do what would take a team months in days, maybe even hours, just depending on the situation. So this is something that we're marketing. We're out there talking to companies. It's a great way to get in the door, and we're getting a lot of interest. The next thing we have is BF Leap. That's our analytics engine. That's the core of that comes from APL. Part of that is something called causal AI. So we have causal AI capabilities, and what that means is typically in AI, you're looking for patterns and relationships. With causal AI, you can identify the magnitude and direction of the relationship. So what that enables you to do is, in a complex biological system, you can identify the drivers of disease. And that's how you come up with true precision medicine breakthroughs that are going to make a big difference for all of us. And then the last piece is an AI decision support tool, which we don't think exists anywhere in the industry, in any industry. So this is something that gets layered on top of the outputs of the AI. So if you were presented with a series of options by an AI, how do you know which one to pursue? Well, that's the tool. And by the way, we're officially launching this next week, and we announced this launch several weeks ago. We have a webinar on X Talks also next week, where you can learn all about this incredible tool. So now we have end-to-end capabilities to support companies in our industry. The last thing I want to point out is typically with AI, it's a black box that spits out an answer. Well, for some, that might be okay. I think for a lot of us, that makes us uncomfortable because you want to be able to trust what the AI is telling you, right? And in our industry, it's especially important because you may be making a life or death decision, a decision on a multi-billion-dollar drug. Don't you want to know how the AI came to that recommendation? So what we have is transparent and explainable, and it always has been. That's the great part about this. It's nothing new for us. But we think this is going to probably be an important differentiator in the future. So I want to talk about briefly about a couple of really interesting case studies. The first one was this company, Alazon Pharmaceuticals. They have several phase 3 ready or in phase 3 drugs. They asked us to help them with their phase 3 pancreatic cancer drug. And they presented us with a mountain of data, literally tens of thousands of pages of PDFs, handwritten notes, a big mess. I don't think they thought we could, find anything that would be valuable to them. In any case, so we got our hands on this, incredible clinical data set, and we were able to, clean their data, structure it, and that process, the algorithms and methodologies we developed to do that are what became BF Prep. So this was like an extreme case. That's why I'm saying, in some cases, we might be able to do that data cleansing and prep in hours. So we analyzed the data, and what we found, what we were able to identify is biomarkers and a subgroup of patients that resulted in a 3x increase in survival, which is phenomenal. So you're talking about approximately 2 months to 6 months. Pancreatic cancer is a horrible disease, horrible prognosis, and it's littered with failures in the drug development world. So we were really excited by this. Liaison was excited, and they said, hey, let's submit an abstract to ASCO GI. We did that, it was accepted, and it was presented in January. So this was a great example of our capabilities, and we know we added value. Liaison can take this great information and take a precision medicine approach and really focus on this subgroup of patients, because obviously this drug has a much better effect on those patients. Maybe they can raise money and good things can happen. So we wish them all the best. They also asked us to prepare another proposal for another one of their drugs, because I think they were really impressed with what we've done. So this was a phenomenal opportunity for us, and it really attracted a lot of attention in pharma, because look, phase 3, it's all or nothing at that point. And when you can find something that can lead to success, that's a really big deal. The next thing is, I mentioned earlier, we have this very valuable partnership, CNS partnership with the Lieber Institute for Brain Development. They have the largest collection of brains in the world of neuropsychiatric patients. We had exclusive access to all of their data for a period of time, and we made some phenomenal discoveries. Basically, we identified the genes that drive major depressive disorder, schizophrenia, and bipolar. We believe they're the genes that drive those diseases. And with our explainable platform, we can actually illustrate why that's the case. But these are the genes that are the root of those diseases. And we're going to market with those discoveries. We have commercialization exclusivity on these discoveries. So this was a phenomenal project, and it's a big deal because for those of you who invest in companies working on neuropsychiatrics, very challenging space, right? Diagnosis, drug development's all primarily been based on behavior. Well, we just layered on the biology. Now you got a precision medicine approach to addressing these diseases. Very, very exciting, big markets. So these discoveries are the really focal point of some of the conversations we're having with Big Pharma. So what is our business model? It's very simple. Okay, we're looking to do deals with pharma, these partnerships, these early deals, maybe will be pilots. That's, pharma likes to kick the tires first. But we're getting very, very positive reactions from pharmas. And once we get the first one done, the rest are going to follow very quickly, because you'll have a bunch that are on the fence. They don't know who BullFrog is. They're not the leaders, they're going to follow. But there are some leaders out there. And those leaders are the ones that are giving us this phenomenal feedback. And that feedback, by the way, when they tell you that nobody can do what you guys can do, you guys definitely have special sauce. That's a big deal, because as you know, Pharma has done numerous AI partnerships over the past 10 years. And they built their own in-house teams. So they've invested a lot. They are very, very intelligent when it comes to understanding what's out there. I can give you a little anecdote. We were at the AI Drug Discovery Conference in Boston back in November, and we had one of the top pharmas come up to us. At the end of the conversation, they said, hey, nobody can do what you guys can do. We want to work with you. And they asked for an NDA at the conference. This is a big pharma. Anyway, so we're excited. We're getting close here, but we want to get to those big biobucks deals, right? But we're going to have to start off with smaller ones, these pilots, right? It's like a 6-month type project, but it's revenue for us, it's validation, and then we want to continue selling those suite of tools I talked about: BF Prep for data prep, BF Leap for analytics, and our AI decision support tool that we're launching next week, because we can really make a difference in this high risk industry. We can compress timelines. We can reduce failure rates. We can do the things that the industry desperately needs, but we got to get in the door. And we've been making these, getting these wins along the way. And the last thing is we're continuing to innovate. Every week we have an all hands meeting, and our head of AI talks about kind of what's the state of the art, and where we sit relative to that. And we know that the things we can do, nobody can do to our knowledge. And I'm talking about the biggest companies, the name brands that you hear about every day. But we have to continue innovating. We can't just sit still. So this is a key part of our business, and it will continue to be. So as far as what are the target milestones, look, we came into 26 with a lot of momentum, a nice pipeline of opportunities. Okay, we are at a stage that we've never been at before. So this is a great way to start the year. Now we got to close some of these deals, and then what's going to happen is the sales cycle will get compressed. If it's a year or more now, we expect that to get compressed down to at least half that time, maybe even less, because like I said, we'll be validated in the eyes of the market. And we do have a strategic channel partner in Signature Discovery. It's a CRO based in the UK. They are promoting our end-to-end solutions to their customers around the world. They've been doing that for the past several months. And we're looking to partner with others as well. We're also interested in talking to big tech about what we're doing, because the feedback we're getting is we got some special things that we're offering here, and we're building up our use cases, and they're pretty impressive. As far as our leadership team, about me, Josh Blatcher's our CFO. He's the CFO of many public biotech companies, tons of experience. He's worked as a banker as well. Our chief business development officer is a medical doctor by training, has worked in banking, worked in BD for big pharma. And then our senior director of CNS, she's also a professor at Hopkins Medicine. She's very, very well connected in with the Lieber Institute. She was actually probably part of the founding team there, and worked there for many years. So that's really been instrumental in solidifying that relationship, that partnership. Something has changed in the industry. So you've been hearing about the AI biobucks deals for years and years here. Well, guess what? Now we've heard about an acquisition. I believe it's the first AI acquisition by a big pharma. AstraZeneca executed that about 2 months ago. So what's happening is big pharma wants to own their models. Okay, so that means they're going to want to start probably doing more acquisitions, and then you look at what Lilly did with NVIDIA, right? So that's where the shift is happening. I think we're beautifully positioned actually for all of this. We're going to get in the door with probably multiple pharmas this year. I expect to do that, several pharma deals this year. And then we're going to expand inside those organizations and become an invaluable, integral partner for their R&D pipelines. I expect great things to happen from that. But we're definitely seeing that shift. So just think about how everything's evolved. Started off with AI partnerships, then pharma started building their own AI teams, Now we're moving to acquisitions and then doing some big strategic type things with big tech. So, this is the direction I think, we're going to be in now for a while. So again, just to reinforce the message, why do you want to invest in BullFrog? We got great technology. We got great data and discoveries that have come out of that. And by the way, once we get the cash flowing and get some deals done from those discoveries, what we'd like to do is take some of that cash and then advance those discoveries ourselves, maybe 1 or 2 stages. We're not interested in becoming a biotech, and we don't want to go into the clinic, but each step you take it down through the discovery process, right? You discover the drug target, which we've done. You validate it in the lab. You find, a drug that fits that target. You do those next couple steps, the asset is de-risked and it's much more valuable, and you can do bigger deals. So that's something we're looking at as next steps. Continuing to engage big pharma, get these commercial deals done. And I've been saying this for months. We're very close to some deals. Can't guarantee anything, but it's looking very promising. And we're continuing to be a lean organization. Has not changed. And even if we win in the future multi-million-dollar contracts, we probably won't need to hire more than 1 or 2 data scientists because our technology is that good and it can scale. So very, very excited about where we're sitting today. And that's it. Thank you.
Thanks, Vin. Let's hear from you, viewers. Go to the bottom of your Zoom window, click the Q&A button, and then there will be a text box. You can type in your question. Vin, we've already received several questions for you. Let's use this one. Can you become a cash flow positive or profitable company in 2026?
Yeah, that can definitely happen. It'll take more than a pilot deal or 2. But like I said, once we get something done with a big pharma, everyone else, in the industry will look at that and say, hey, whoever they're working with did their diligence. These guys must be good. And things are going to open up for us. So we're maybe the only AI company out there that can make that statement. And the key is having a low burn.
When you talk to big pharma companies, what do they say to you about your AI platform and your general capabilities?
Yeah, so, I talked about our end-to-end solutions. I mean, we haven't launched the last solution yet officially, but for BF prep, the data prep, and the analytics, we've heard multiple times now that nobody can do what you guys can do. You definitely have something unique and special. A key part of that is, the relationship with the Applied Physics Lab. So that, like I keep saying it, that's blue chip technology that sets us apart from 95% of the companies out there.
Early pharma relationships, are they typically pilot deals, Vin? And what would the revenue range be for a pilot?
Yeah. So yeah, especially because we haven't done one yet, they're going to kick the tires on BullFrog. Okay, they're not going to just jump in, where this tiny company that they never heard of and do something massive. They're going to want to kick the tires as a pilot. Pilots, you're probably looking at, they're around 6 months, 3 to 6 months. It could be $500,000 to $1 million type deal. But for us, very significant. That's material revenue for us. And it's going to lead to much bigger and better things. We're already hearing from them that, hey, the key is to get in the door with them. And then they're like, hey, we want you to do this and that and work on all these other things. So I think it's just a stepping stone, and it's going to lead to much bigger opportunities, even within that same pharma.
Getting a lot of questions that we can sort of head under the big pharma feedback thing. Again, big pharma. You presented your AI findings at major conferences like ASCO 2026. what is the number one thing, again, getting back to what big pharma people are telling you, what are they telling you about the missing link in their current AI tools that BullFrog can give them?
Well, that's sort of related to the last one of the last questions, but our data prep tool, big pharma, they have data lakes, massive, massive data lakes. And if they're going to unlock value, they need to have their data prepared and structured. And they can't do what BF Prep can do. They've told us that point blank. Okay. The other thing is our BF Leap analytics engine with causal AI capabilities. They cannot do what that platform can do. I mean, it's as simple as that. So, and believe me, this is going through many rounds of conversations with very big teams on their end. And we've been asked every question you can imagine. But, the key next step is, get these deals done. And the other thing, Craig, is more than 90% of these companies are not hitting their milestones with these partnerships. And we are very, very careful about that. When we propose something, we only propose something that we know we can deliver on. And that execution is going to put us at the top of the pyramid. We're going to be in a very, very company of just a few companies at that point.
Okay, we got 15 seconds left, but just to sum up, you're telling these big pharma companies that if you try to build it in-house, you're not going to build it as well as BullFrog can do it for you. Is that a fair
They don't
statement?
have our technology. If we were just using open source tools from AWS, NVIDIA, and these other companies, we wouldn't be able to say this because that's what everybody else is using, okay? We are not.
All right. Thank you very much, Vin. Thank you. We're finishing up just about on time. Again, this is BullFrog AI, BFRG on the NASDAQ. Vin Singh, CEO. Thank you so much for being with us. Great presentation.
Thank you very much. Have a great day. Bye.
Okay. If you want more information on BullFrog AI, reach us at 1-800-RedChip or email us at bfrg@redchip.com. We're a little bit over 2 p.m. U.S. Eastern today. Our AI Investor Conference continues. Next up, we've got ZEO Energy. Tim, are you with us?
I am, Craig. How are you today?
Nice to see you, Tim. Tim Bridgewater is the CEO of ZEO Energy, ticker ZEO, on the NASDAQ. We're going to begin with Tim's brief presentation in a moment, and then, of course, we want to hear from you. We're going to talk about your questions. And again, I'm going to keep everyone's lines muted throughout this presentation, but if you have a question, just go to the bottom of your Zoom window, click the Q&A button, a text box will appear, and you can then type in and submit your question. Before we begin, please allow me to get the safe harbor statement out of the way for you. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements. And of course, forward-looking statements involve risks and uncertainties. Tim, go right ahead.
Okay, great. Thanks so much for having me on today. Let me just share my screen. Can you see that okay?
Yes.
Okay, so ZEO Energy, we're listed on the NASDAQ. We went public via the de-SPAC process, a merger with a SPAC in March of 2024. So we're just a young publicly traded company. We're in the residential solar space. See if it's going down here. There we go. What you just read, Craig, there's the short version of it if you wanted to read it on the safe harbor and forward-looking statements. But basically, our company is in two sectors. Our core business is residential solar. So we sell, install, and maintain residential solar systems in various states. We've been better than our peers in the market. It's been a couple of rough years for the residential solar industry. Quite a few large companies, some public companies have gone bankrupt, Sonova, SunPower, and others. And high interest rates and other things have led to that, but we've been able to beat our peers in many regards. It's been kind of a flat couple of years, 24 and 25, and the industry looks, from our perspective at least, to be recovering now, and we look forward to a very good and profitable year in 2026 from the residential side. Long duration energy storage. We made an acquisition last year of a company called Heliogen that was involved in long duration storage, so effectively batteries for projects behind the meters. We have been developing some projects around that, which I can speak to a little more. Just announced a project in central Utah with a Creekstone Energy to develop 280 megawatts. And so we're working on the storage and the solar side of that particular project. So from our core business, we are vertically integrated in that we sell, we install, we have installation teams, W-2 employees that are out installing projects. We have a sales force of about 350 sales reps that go out and knock during the summertime. And it's a strong sales machine. And then we install in 30 to 45 days after the sale, after getting permitting and whatever else is needed for the residential solar space. We did not have a lot of debt when we went public, and we still don't have much debt on the balance sheet. So we've been able to fund our business through cash flow over the history of our company. We really started this business in 2018, and we've been careful to go into various states now where our sales reps can sell and we can install residential solar business. To give you a little idea of how our business works, we have our sales process includes setters who go out and knock doors, 50 to 125 doors a day, depending on where they're at. Those setters set up a meeting for a presentation. The closers will then go in and make a proposal presentation. They close about half of those presentations, and they are managed in each different area and office by a manager who both recruits and then manages during the summertime. And we have specific KPIs that help to drive the sales side and then move our installation cycle through a methodical process where we install on the homes and then we work with the utility to get interconnected to the grid. The value proposition for our customers are that we're competing with their existing energy pricing, their power bill, and we can effectively sell them and finance over a long period of time, 20 to 25 years, their purchase, and actually save them on a monthly basis what they're already paying to the power company. It's also helpful that they can sell power back to the grid, so they monetize excess power generation. In many states where we're in, it's a one-to-one net metering process, so they can put power onto the grid and then pull it back off at night. And it's a good value proposition for them. People are looking for resilience to be off the dependency on the grid. And another value proposition that we provide is that we sell, we install, we service, and we help put the financing together if the customer needs financing as well. And so we're kind of a seamless one-stop shop for our customers. We started in Florida in 2018, 2019 timeframe, grew our business rapidly. The market was growing quite rapidly during those years, 18, 19, 20, 21, and then high interest rates slowed the industry down quite a bit in 23, 24, and 25. We've been able to stay nimble versus our competitors and be, I think, in a position to expand carefully to other states over that time frame. We're in Virginia, Ohio, Pennsylvania, Illinois, among other states. We're just starting to expand into California as well. And we look forward to this coming year where we already see some positive signs of growth, even though some of the analysts are predicting a further contraction in the residential solar space. So the great thing about residential solar and solar in general is that the US is relatively far behind the rest of the world. The adoption in Australia is over 15%. Germany, Netherlands, Europe, they're in the mid-teens. And the US is about 8% now, just under 100 million homes that are in the US, and only about 8% penetration right now. So there's lots of room for growth. And as interest rates continue to stabilize and hopefully fall back down, that should increase the opportunity for selling into the residential solar market. A lot of policies and states are looking to try and lower the cost of power for consumers, and solar is one of the best ways to do that. So as we look forward at the growth, there's huge demand on the grid right now with all of the AI data centers demanding more power. Pricing is increasing from utilities, and so we see an opportunity for residential solar in particular to continue to fill a void and give stable, predictable pricing to consumers who want to have solar on their homes. The ability to put solar on a home frees up more capacity on the grid for other needs, and we think that in addition to our residential business, there is also a great opportunity for our solar storage business, which is basically building long duration batteries, large scale batteries that I'll talk about here in a minute, that can be used for grid management or for behind the meter systems that power data centers and other commercial and industrial users. Basically, the company that we acquired in August of 2025 was in the CSP, concentrated solar and storage business. And we decided to acquire them in part for the cash on the balance sheet that they had and for their technology and expertise around long duration energy storage, 10 plus hours per day, where you can store power and then use it in the evening time to run whatever the power is needed by, whether it's a data center or an industrial user or other users. So that company was founded in 2013, was traded on the NASDAQ originally, had not had success in the US in deploying concentrated solar projects, but they had an engineering team, cash on the balance sheet, and we acquired them. And then during that time, we've been working on projects around data center development, and we recently signed our first partnership with a group called Creekstone Energy. They're building a gigawatt data center in central Utah, and we are working on solar plus energy storage with them to build a 280 megawatt baseload facility to support their data center. So we're excited about that. It's early innings, and we expect to have more progress as we go down with that project and others that we're working on. The energy storage technologies that we are working with are twofold primarily. One is molten salt storage, where the energy is stored in a very hot solution of molten salt that doesn't lose its energy, and then you run a steam turbine off of that hot molten salt. And then the other is compressed CO2 storage, where you're storing the energy in liquid CO2 in tanks, and then you expand that and you run a gas turbine to generate electricity. And those are the two technologies that our engineering team has unique expertise in and that we're working on these projects. Data center demand, as everyone knows, is just it's off the charts. There's a need for resilient behind the meter solutions because the grid just cannot keep up with the demand for power. On-site power generation to fuel the data centers is really almost a requirement now for the expansion of these data centers. And you get reliable power through these large-scale storage systems, power storage systems. Our systems are no emissions, and they provide leverage the opportunity to use some grid power, some natural gas from gas turbines if that's available, or just expand with 100% off-grid behind the meter power storage solutions. So the batteries are generally powered with wind or solar. We're a solar company, so our focus is really on solar energy that will power these storage systems to support data center demand. Basically, you'll have a solar field, photovoltaic, and you'll be able to provide that energy to the data center. They may have reciprocating engines and other sources of power as well to fuel a giga center. But our focus has been on the solar plus storage solution to support these data center expansions. So again, we're early innings, just made the acquisition in August, but all things are going well from our engineering team and the projects that we're working together on. The project that we did announce recently in February is located in central Utah around Delta. The Creekstone partnership is designed to have a gigawatt of power in their first phase, and we're providing 280 megawatts of that through our energy storage and PV systems. The company just recently signed a lease for 13,000 acres. They have at the site natural gas turbines and reciprocating engines that will come online in the first half of 2027. And so we're excited about this project and its potential for expansion using our storage systems. Our company generally, we're a small company. We went public with about 110 million in revenue before the high interest rates really took hold. So we lost some momentum in 24 and 25, relatively flat through those 2 years. But we expect 2026 to be a rebound year. We're off to a good start. We're sending out our sales team into the field right now. We're typically a summer sales model for our residential solar business, and we have a good group going out starting this month, and they've begun to sell, and all prospects make us feel like we're going to have a good year in the field. The business right now has been sustainable, cash flow positive since we started, and we expect that to continue in 2026. I think if you look at the market trends for solar, residential solar and solar plus storage, it continues to be high demand, even though the big beautiful bill curtailed some of the tax credits. There's still strong demand for solar power, strong demand for residential solar power. The long-term economics make it a cost-effective solution for consumers. Utility price continues to increase, and that's a nice tailwind for solar adoption. There's also a growing demand for virtual power plants through having storage systems, batteries at the home, and allowing greater resilience of the grid for tapping into these storage systems that are basically distributed across our customer base. The market for energy storage continues to grow, and the investment tax credits did not, or they weren't curtailed in the big beautiful bill, so you can continue to get credits for putting in battery and storage through 2032 right now. And we think that the opportunity to build reoccurring revenue through leasing and energy storage batteries continues to be a substantial tailwind and a trend that is positively impacting our industry. ZEO has historically grown organically, just growing our sales force and adding states. But we have our Heliogen acquisition that we made, expanding into the commercial sector. And we expect to continue to look at strategic M&A bolt-on acquisitions in the coming year, maybe 1 to 2 acquisitions a year, and then adding additional integrated services such as roofing and other things that the consumers need. As we have a sales force out and we've made a relationship with the customer, we have upselling opportunities there as well. So that's basically just a quick overview of our business. The investor deck is available on our website. Basically, our core business is the residential sales and installation business, and we're expanding more and more into the commercial sector in the coming year, and we expect to see a lot of continued growth. I'll just run through a little bit of the technologies in our appendix without getting into all of the deck, but compressed CO2 is one of the technologies, and what happens in compressed CO2 is you have gas in a gas dome, looks like a tennis court dome, that is compressed and stored into tanks as a liquid, and basically that energy then is available when you need the compressed CO2 to discharge, and then as you discharge those liquid CO2s, it comes out of the tank, goes through a vaporization process, expands, and then goes back into the dome, and it's turning a turbine as it expands, and that generates the electricity on demand for the end user. There are a couple of companies that have developed this technology. One's out of Italy called Energy Dome. This is one of their sites where you can see how the energy storage system works. Google has invested in their technology. They're deploying a couple of projects, one in Italy, one in Wisconsin right now. Another company using this technology has a 10 megawatt project in China and a 100 megawatt project that's just going through commercial operation. And we think this is a promising technology, and we have an engineering team that can do these kinds of development projects, which is what the Creekstone project is looking at. A second technology that we work on is molten salt storage, which I mentioned earlier, and you can have 6, 10, 12-hour storage. It's a lower cost LCOE, below 10 cents, that you can build these systems and put them to work. There are hundreds of systems around the world that use this molten salt storage system, and it's environmentally friendly and can be charged with PV systems or wind or off-peak grid power to provide low-cost energy to end users like data centers. And I won't get into the details too much on this, but you're welcome to look at our investor deck on the website. So that's basically an overview of our business, Craig, and happy to open it up now for Q&A.
Absolutely, Tim. Thank you very much for that comprehensive overview of your company. We've been getting a lot of questions. I've been working here to kind of conflate the ones that we've got so that we don't spend too much time. A lot of people are wondering about what I would call the identity shift question. As you mentioned, you started out in Florida. You started out as a residential solar company, but you just signed that massive deal to provide the 280 megawatts of power for the AI data center in Utah. How should people view ZEO now? Is the residential business still the focus, or is this AI power side the new main growth engine?
Great question. I think the core business, we're a solar company, we're a renewable energy company, and both of these segments are in the renewable energy space. So I think you look at us as a diversified renewable energy company. We have a core business that's going well, that we send our teams out, we sell, we help originate $100 million of financing for some of our financing partners that provide long-term loans. We would like to long-term get more involved in the financing side of the residential space because we think that's a highly profitable business. But that's our core operations, and we have an expertise, and I would say we're nimble and better than our peers in many respects in running that business. The diversification is opportunistic. I think anybody that's not thinking about in their business how to take advantage of AI, broadly speaking, and in our case, energy that fuels AI, you're missing one of the great opportunities, in the last couple of decades. And so we acquired an engineering team, we acquired an expertise, and now we're deploying that to support that booming industry. And so I think just having your investors watch us and see how we perform in our first project, plus others that will be coming down the pipeline, is what I would look at as how we can differentiate ourselves from just a residential solar business or just a solar business. We really want to be part of the revolution that powers AI data centers and off-grid power solutions that could be in mining industries and cement factories, a lot of other areas that need a lot of power, and the grid just doesn't have the ability to keep up. So we think there's enormous growth opportunity long term, and we want to carve out a little space in that business. And as that grows, we expect to continue to grow both sectors.
Perfect that your answer led you there, Tim, because the other heading that I would classify these inquiries under would be something about like profitability versus growth. And of course, that's common to microcaps companies, of course. People ask, you've narrowed your losses recently, as you talked about. You've seen the revenue growth. But as you move into these much larger industrial projects, Tim, are you confident that you can keep your $6 million to $10 million, correct me if I'm wrong, expense line under control while chasing these multi-billion-dollar opportunities?
I think we'll need to partner. We're in conversation with partners, people that have can bring other components to these projects, their experience on large-scale utility projects. I think we're a component. We're the engineering team, the development partner in the project. So we're not Bechtel or some large EPC company per se. We're really the owner, operators, engineering partner, carving out a section of that. You're talking multi-billion-dollar projects on each of these just to build the power resources. So there's a huge demand for capital. We're building, I think, a development expertise around long duration storage versus typical lithium ion battery. There's plenty of people doing lithium ion batteries, and they're doing them well. But we have, I think, a longer duration storage niche that we believe will attract other partners and projects coming down the pipeline. So, it's a loss. You're going to spend a lot more money. It's going to take longer till you get to revenue on these projects, but the potential is enormous, and we're excited about already the inquiries that we're getting and the projects that we're looking at to become a part of, like the Creekstone project.
Does being a public company give you a benefit, i.e., in things like cheaper project financing compared to a smaller private competitor?
It should. I think as we get more and more project development under our belt in the commercial side, we'll be able to access the public markets more easily than a private company would. Again, we're quite small, so we have a lot of growing to do. We went public because we saw an opportunity to consolidate in our industry and other complementary industries like roofing and other home services businesses. And so I think we're hoping to see good progress, good growth. We're careful, conservative in our approach. We acquired this engineering team based on the cash that they already had on their balance sheet, plus the project pipeline that they were working on. And we're looking to have a very positive year on the Creekstone and other similar projects who have this absolute demand for energy that they have to find a solution for, and we're part of that solution. So we're a solution provider for behind the meter power.
Got less than 2 minutes left, but that should be enough time for two more important questions here, Tim. Data centers, they don't turn off, of course, as you know, when the sun goes down. Now that you own Heliogen's storage technology, can you explain how you plan to provide baseload power, that is 24/7 electricity, using only solar and batteries without relying on the traditional grid? And then save some time for the last one. We got about a minute and a half left.
Sure. So so what we do right now in residential solar is behind the meter solutions for a home. You put solar on the roof, battery inside. You could run off the grid if you wanted to. Most people stay connected to the grid in the case of those homes. But we have an expertise, I think, at designing and developing standalone power systems, and the molten salt and compressed CO2 are large-scale industrial solutions that will allow you to get power from, you might have natural gas, so you can run gas turbines a little bit to charge the systems. Solar is what our primary focus is, wind, other things that will hold that power in the storage system and then allow 24/7. That's the design of the solution that we provide. So hopefully that helps answer the question, Craig.
Thank you. 15 seconds or less, if you can do it. If you were an investor looking at ZEO right now, do you think this market is still looking at you and pricing you as a small Florida solar company, or do you think they are starting to realize the value of the 2 gigawatt pipeline and the AI data center angle?
I don't think the market recognizes yet. We need to have more substance in our commercial side, and as we do, I think the market will reward us for that development on the AI data center projects. We need to get further down the road. I don't think it's valuing us with that in place.
Much appreciated. I know you could have gone on for that one, but I appreciate your conciseness there, Tim. Tim Bridgewater, ZEO Energy, ZEO on the NASDAQ. If you want more information on ZEO Energy, please reach us at 1-800-REDCHIP or email us at zeo@redchip.com. Tim, thank you.
Thank you.
See you soon. Okay, it's 2:30 p.m. U.S. Eastern, and we've got yet another company on the RedChip AI Investor Conference. It's PowerBank, ticker SUUN on the NASDAQ. Presenting today will be Richard Liu, the founder, president, and chief executive officer of PowerBank. Richard, are you there?
Yes, Craig. It's so happy to see you again. It's
nice to see you.
Not
How
too
have you
long
been?
ago, and really enjoy seeing you again.
Yeah, good to see you too. Looking forward to your presentation. Let me just get some preliminaries out of the way. Are you going to be showing your presentation today?
Yes, I have screen sharing already up and running, and if you have it, and then we can share. Did I share the screen already?
I'm not seeing your presentation right now. Yeah.
Let me share the screen, and we have the screen share now.
All right. Yeah, there it is. We are in business, Richard. Let me just say a few things here. Again, this is Richard Liu with PowerBank, ticker SUUN on the NASDAQ. We would love to hear your questions, viewers. Click on your Zoom window, click the Q&A button. There will be a text box that appears. Type in your question and submit it. We'd love to hear what you've got to say. Before we begin, let me get the safe harbor statement out of the way, Richard. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management constitute forward-looking statements. Any statements that are not historical fact should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Richard, without any more ado, please go ahead.
Wonderful. Thank you so much, Craig. And good afternoon to everyone. I understand this virtual conference is well attended. I'm a little anxious to hear questions from 65,000 people on this virtual conference, and thank you all for giving me your time. My name is Richard Liu, and I'm the founder and CEO of PowerBank. Just to start, you're looking at my title page, and this actually tells all about PowerBank. My history in Canada, 36 years with utility, so that you can see the wires. I started this company 2012. And started as a solar company that in Canada moved to the States in 2017 and continue to operate today in both Canada and the US. Along the way, that even though solar farms are still our bread and butter at this moment, a large share of our business, and we are strong in energy storage, and we have 3 long-term contracts already. We are bidding on a 2 gigawatt-hour, another long-term contract we're building in the US. So that's become our second horizon in terms of looking forward to the next 10 years. We currently, the key driver is actually data centers. I will share with you our positioning strategy and the commercial model of our data center key driver. Nothing different, is only that the shift is about customer. We used to send power to the grid, to the CNI customers behind the meter, to community solar subscribers. Now we focus on sending the powers to the data center just because the highest demands coming from there, right? You will see a little agentic AI there, and that's really to share with our investors here is that we are very cognizant about creating value for our shareholders. That is by increase our productivity, increase our efficiency, and reducing our cost. And agentic AI, both outward facing on the investor relations side and inward facing on helping our people to quickly get analytical reports, are installed in our system. You also knew that we announced a treasury strategy some time ago. We plan to, subject to market conditions, of course, as in current market condition is questionable, that we do have one of the 100 solar farms that considering free cash to be in the treasury strategy if the market so demands. At this moment, I think it's a big question mark, but we do pay attention to the market development. You probably also, the last little picture on this title page, you probably know that we actually currently have a data center circling the Earth every 90 minutes, right? That is the satellite we launched with a NVIDIA H100 chip running a large language model on the low Earth orbit, providing services, right? Giving the talks about where's the best place to build data center, how do you avoid the delays on Earth, how do you get to power with speed. That is certainly in the long-term vision of this company. However, today I will focus on our initiatives, our current driver, profit making in terms of solar, battery, and data center. Okay. I will move to the purpose. The company has to have a purpose, right? And if you ask me, what does PowerBank do, right? PowerBank is a power company. We deliver power, right? Solar power, battery power. We have done natural gas turbine. We have done CHP. We have done geothermal. We even have done energy efficiency. Our purpose is to deliver power, all power, to our customers and with speed. So speed to power is where our competitive advantage is, right? If you look at our bird eye view, where's the resources, where is our battlefield, and where are our distribution of our resources and activities that, coming from utility that, I always align our distribution of resources from generation, transmission, distribution, and services, retail services. So we have large scale development, purposely designed for edge data centers. We are currently have one battery storage up and running with IESO with 22 years of long-term contract, another 2 gigawatt-hour large projects in the works. We have done a lot about this community solar in the States and in Canada that have tens of thousands of subscribers selling power to the subscribers. We also own a lot of assets that on the commercial industrial, also grid connected in Ontario, bringing a recurring revenue of $10+ million every year, right? So of course, I mentioned our AI approach that is really to increase the capital efficiency and our productivity. And I also mentioned the space solar as a longer term, 5 years out visionary items. Right. So if you look at the market, we are very strong in commercial and a community and commercial C&I solar market, giving it the compounded annual growth 6.3%. We're very strong in the community and C&I battery market that growth rate 14.6. We also are very active in the edge data center field that, with a annually compounded growth rate of 15%. Space power, as I mentioned, is a long-term vision, but I will focus on the first 3 key market here. The technology is the same, solar, battery, and other power sources, right? And the purpose is the same, to deliver power. Is really about how do we deliver those power safe, reliable, and low cost, right? A little bit about the team, and as I mentioned, we have about $10 million worth of recurring revenue, enough to cover this company's burn rate. Right? We have done almost $500 million project financing. And if you look at our financial filing, you're probably thinking that we have borrowed a lot of debt. And I'm happy to report is that our long-term debt are project level non-recourse debt. Right? That's a minimum, if any, debt at the corporate level. Right? We do own about $140 million of assets, right? Hundreds of projects, pipeline is strong. The managed a lot, not only for the ones we own, but also for our customers, such as charities, Honeywell, QCell, and the names that those logos that you have seen, right? The team has been with me for very, very long time. The combined history is very big, 100+ years, very stable, very focused team. And one satellite is running, and also the subscribers, we provide the services, right? So it is a team that end-to-end capabilities and focus on delivery, right? So that's where our competitive advantage coming from. I set this company really from a production concept. I used to be in the solar panel production business. I have made solar cells in Germany, silicon in Canada, panels in the Southeast Asia. But now, I'm purely a development company that we do development, we do EPC, engineering, procurement, construction, and we do operation maintenance, and also we are a independent power producer, right? So if you look at this one, you will see this company are not single revenue sourced company that very risky, right? We have actually 4 revenue streams of this company. So we create value through this vertical integration. So when we start secure a site, bring this project to construction ready, that's the end of the development cycle, we can sell the project or we can keep the project. Really depends on how much free cash we want to move around between working capital and the long-term assets, right? So when we sell the project to Honeywell, to QCell, to charities, and to other customers, and the condition is that we do the engineering, procurement, construction. And because we are a licensed engineering firm that we manage procurement hands-on, and we are the general contractor for all the projects that we developed, built, and sold or owned, right? So that gives a cost control, that gives productivity, and that also gives the local relationship a chance for a long-term relationship, because investing in infrastructure is a long-term, 25 to 35 year long assets. We want making sure we set it right, build it right, so that we can get into our operation maintenance, right? So our second income is as the builder. The third income is as the operation maintenance service provider to the systems we build. And obviously we have $145 million of assets as the IPP. Right, so those are the 4 revenue streams that we have in this company. The visibility of our stability, not only from the cash perspective, from recurring revenue perspective, also from a pipeline perspective. Right, the 35 megawatts plus, we already own operational. That's where we have recurring revenue. We already built the 39 megawatts for Honeywell, currently in the interconnection stage. All the field work is done. We have built a 20 megawatt hour battery storage for the Ontario grid. Everything is done. I think it's currently being hot commissioned. We are actually building another 2 battery storage projects now, and another 100 megawatts is in the late stage NTP and early stage mobilization stage. We actually, if you paid attention to our announcement recently, we have a spring kickoff on this year's construction of those 104 megawatts. So overall, we have about, a gigawatt's worth of a pipeline. And obviously, these are all in compliance with the big, beautiful bill, which you probably remember. We have about 14 projects past the physical work test, so that it continue to maintain the RTC eligibility. And then timing-wise, those are secured until the end of 2030. So the visibility to our growth based on our traditional business of solar and the battery are very clear. On the battery, we're not only building, owning, operating the sites in Ontario. We have already secured quite a few sites in the States and pushing forward with our solutions. Okay. So I know this conference is about data center, and I give my last few minutes the focus on data center, right? So what is our key growth driver, right? So our key growth driver is actually to power the data centers. We see 2 challenges with the current market on the data center development, right? If you think about this, you will say the first one is being the workload increase, which is the demand increase. 2023, that's only 4% of power consumed, grow to 15% by 2030. In 2025, the demand is only 80 gigawatts, right, in the States, and growing to 12% in 2030. So those are huge demand coming from the digital economy, from the data centers, right? So on the other hand, we all hear those timelines for grid-connected projects as illustrated in this map, right? The time is literally money in the data center world, right? So in North American, interconnection and substation upgrade takes 5 to 10 years, right? And we all know for every 100 megawatts data center, if you can start early, on day 1, you make $15 million. Imagine that you delay the opening of this data center by years. It's simply detrimental to the capital efficiency, right? So for us, speed to market will determine the market share. That we are happy to see that the data center industry has shifted from capital optimization to time optimization. And we are here to enable and take advantage of this trend by deliver power with speed where the power is, right? Because we believe power equal to computing capabilities equal to profitability. 6 months improvement, we will bring about $1 billion of data revenue to data center operators, right? The 2 maps you are seeing here on the left is where PowerBank's asset and development sites are. And on the right, are potential sites that we currently in discussion with data center operators where we can build edge data centers, right? So it's not only a vision, not only a plan, but in the execution stage for us to deliver power to data centers with speed. You're probably asking us, why do we focus on edge data centers, right? We announced our data center initiative about 14 months ago. We did pay attention to the mainframe centralized data centers. And over the last 8 months, first 8 months, that we realized that are a long-term, long-cycle uncertainty related to the development. You saw we have strategic relationship with utilities, as we announced recently. We are in their system planning department. We are looking at their power situations, and it is 3 to 5 years just to get the power, right? On the other hand, if you look at the industry, we do need the central frames to do AI training, right? However, you and I, using our cell phones, using our computers, asking AI models, those questions is not sending to the central data center thousands of kilometers away from you, but rather the data center near your location, right? So that's where the edge data center come into play, right? And that's where you can increase the market share by capturing customers, by reducing the deficiencies in terms of time delays and so on and so forth, because it close the source, right? So that's the market we specifically focus on, right? And if you look at this one, why we think that PowerBank can be competitive, and this is why, right? So all the centralized data centers take a long time. There are things operating, that's great. That's why we can now use AI on our phones, right? But our phones and other edge devices are communicating with the edge data centers, right? So those are the real-time data analytics. Those are real-time action responses. Yeah, it has some temporary data storage and communication messaging, so on and so forth, right? They are a lot. If you just look at where I am today, which is Toronto, Ontario, Canada, you have tens of those distributed data centers, edge data centers providing service today. Those data centers are being overwhelmed. Those edge data centers are obsolete, and the rack density, currently probably still a few kilowatts, where the newest chips are going to tens, if not hundreds of kilowatts, right? So the demand is certainly there. So what PowerBank's competitive advantage here is that we know the grid. I come from the grid. I come from the utility, right? So we know where the power is. Not hundreds of megawatts, right? But could be tens of megawatts, which is the average size of existing edge data centers. We do build the solar farms. We do know how to connect them, whether behind the meter or ahead of the meter, that give you a solution as a overall solution. Our battery storage are up and running, right? So that's provide N+1 reliability to the data centers. And we have done, reciprocal gas engines that we could provide, right? So if you look at this one, we probably can provide edge data center with 5 to 20 megawatts power with speed, let's say 12 to 18 months. And meantime, we have space, we will do a solar farm. Where we have limited space, we will do a battery storage, right? Let's say 20 megawatt hour units. And where the gas line is nearby, I also worked at Enbridge for a long time. And so we do have access to the maps that we could introduce 5 megawatts units, right? You probably hear people say, no, 5 megawatts is too small. You need hundreds of megawatts, 200 megawatts. I agree. If you are doing centralized data centers. If you don't mind, it takes 5 years to finish. Not our game. Our game is get the edge data centers up and running in 12 to 18 months from a power perspective, right? And on the right are potential sites. We're working with our collaborators that you can see that, a perfect combination where the centralized data centers will provide AI training. We will provide scheduling to those edge data centers. And what the edge data centers are distributed geographically, service billions of those edge devices and further enhance our digital economy. So this is my last page here, and talking about our business model, right? So PowerBank delivers power with speed. So the reason you want to talk to us is that at the distribution level, that we can connect the modular edge data centers anywhere between 5 to 20 megawatts of power increments, right? So speed to capacity. It's very resilient, and because the distributed model reduces the reliability risk, right? Because of redundancy, and also have a lower carbon because we do consider those powers with battery storage that, when the carbon content is low with renewable behind the meter, right? And it's de-risk execution because those sites that we just showed you already have our solar farm or battery storage operation. So in other words, we already have site control. We already have permits. We already have interconnection. And we own the land, or we have site control of the land, where it's easy for us to put another concrete pad to power it for modular edge data centers, right? So we handle all the hard parts. The fact is we already have site control, already have interconnection, already have permits for existing operations, significantly shorten the time required to get a edge data center up and running, right? So how does it work? Site selection that I showed you the map is currently is heavily evaluated by data center operators, right? Power connection is our expertise, right? We deliver power. Because it's the infrastructure, is there, so we connect to power, cooling, and the network. That's part of the overall deploy infrastructure, right? And we have them those inference compute online, right? So that's kind of a production line that you have a site, you have a connection, you have an infrastructure, then you have it up running where that fiber cables, power cables, and site controls are intersect, right? We are very flexible in terms of commercial models, right? We could just provide a powered shell, right? And sign a power purchase agreement with the modular edge data center operators or owners, right? We certainly do turnkey co-location, right? Because our ability, having built more than $500 million worth of assets, enable us actually to provide those turnkey colo operations, right? But we are not just a service provider. We do carry assets. Would like to get into the IPP recurring revenue business. We already own about $145 million of assets, so that joint venture capable potentials are also welcome, right? So I will actually stop here and see if there's any questions. Craig, and back to you.
Thank you, Richard. First question, and we're getting this a lot. Your owned assets. Is the goal to stop selling your projects to other people and instead keep owning them so that you can collect a steady utility-style check every month?
The question has two aspects in terms of answering. Most of our projects are long-term feed-in tariff, long-term power purchase agreement with the utility, such as IESO in Ontario, AESO in Alberta, and also in the United States. For those ones that we feel there's contract obligation operating very well, we will have it finish, right? However, some of the contracts already halfway through, right? So upon economic calculation, we could terminate early if that's liquid damage is not too much, but we intend to deliver the fully. However, because we are there sending the power to the grid, the power can also be drawn from the grid. And when we build the solar farms, the battery farms, we have setbacks, we have additional space. So that's the places for the modular edge data centers. And because of the same use as the existing use, that it will be relatively, I would say, significantly easier for us to amend existing sites, right? So that's where we will say, we will focus on the existing operations and build a co-locate beside it. And of course, when the existing asset retire from the current contracts, that would just increase the size of those edge data centers.
Richard, we've only got a minute and a half left, but I got two great questions that I'd love to see you address. This one, that name change, Solar Bank to PowerBank. We're getting a lot of inquiries about that. Of course, it's not just a new name, right? It has to reflect your shift from being just a solar company to a broader player in AI data centers and battery storage, or correct me if I'm wrong.
Craig, you're absolutely right. My opening slides just said the future is bright. The future is bright by what? By the sun. So that's what the solar energy is, solar power is, right? However, our end of the day is that we're here to delivering power. As I mentioned, we have done solar, we have done battery, we have done gas turbines, we have done geothermal, and many different forms of this, right? So upon further reiteration of the thinking of the company, and our investors and our boards believe, actually, as rightfully, is that we are actually a power company, not just a solar company. It's just that from a solar perspective, every energy is from the solar as the source, as we all know.
Okay, well, Richard, I would have loved to have gotten to that second one, but we've just run out of time. We do appreciate your great company, and thank you for your amazing presentation.
Thank you so much, Craig. I'll see you soon.
Okay, we'll see you soon. I'm looking forward to that too. For more information on PowerBank, reach us at 1-800-RedChip or email us at SUUN@redchip.com. See you soon, Richard.
See ya.
All right, it is 3 p.m. U.S. Eastern on today's RedChip AI Investor Conference. We are going strong today until 4 p.m. U.S. Eastern. Our next company is Cloudastructure, ticker CSAI on the NASDAQ. Presenting today, James McCormick, the CEO, and Greg Smitherman, the CFO. Greg and James, are you on?
Yes, sir.
Are on.
Excellent, excellent. All right, let me get these preliminaries out of the way, and then you're going to dive right in. To our many viewers today, you can submit your question. Press the Q&A button at the bottom of your Zoom window, and then a text box will appear, and then you can enter and send your question to us. And we've got the safe harbor statement to do. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements. Of course, forward-looking statements involve risks and uncertainties. Gentlemen, please go ahead.
All right. Hopefully our screen is being shared?
Yes, we can see it. Yes.
Excellent. James?
All right. Thanks so much. Yeah. James McCormick, CEO of Cloudastructure. And as mentioned, I'm here with Greg Smitherman, our Chief Financial Officer. Very quickly, high level, what is Cloudastructure? We are a video surveillance company, mainly servicing enterprise customers with some differentiations. We use advanced artificial intelligence to evaluate the video that's being captured. And we also have a component of humans in the loop or remote guarding that really differentiate us as well. So with that, let's start with what we believe is just some absolutely astounding numbers. And this chart shows the volume of surveillance video that's captured on a daily basis worldwide. It's estimated that there's about 1 billion surveillance cameras deployed globally. And those cameras capture 1.44 trillion minutes of video footage every day. And in our experience, what we see, only a small fraction of that gets reviewed, and which means that security is still reactive, not proactive, even when it includes video surveillance. So let's talk about our differentiation and what we do. So we have a patented artificial intelligence platform. And what do? Our artificial intelligence reviews 100% of footage that it's capturing, 24/7. It indexes those videos for quick search, much as Google indexed the web. We index videos to make them actionable, searchable, those sorts of things. We mentioned remote guards. We have in-house guards that provide cost-effective solutions. They're actually, when we identify something as a potential threat or a compliance issue, it will go to our remote guard team. They'll evaluate it. And if it is indeed something that needs further processing, right? Either contacting local security, law enforcement, or talking to the perpetrators through a speaker system, we have a demonstrated 98% deterrence rate, meaning we are stopping matters from happening before they happen 98% of the time.
Sorry, this little system is
jumping around.
It's really jumping around, and I apologize for the for some reason with Zoom it is I can't.
We could do it randomly.
It kind of is what it's feeling like.
Yeah. Go ahead. There you go.
So there we go. Jeez, it's very sensitive today. And the single page advance is not working. So my apologies. So what does all this mean? What it means from our perspective is we are seeing tremendous growth. People are understanding our message. They are understanding the flood of video that is coming in. And they understand that they really can't handle that by themselves, and they are turning to solutions like ours that leverage AI. And we have really seen 2025 was really a banner year for us. 200+% revenue growth. And as you see this chart, I always like to talk about it's really the knee of the curve. Companies always have out in the future some mythical thing that's going to happen, and you always see the charts, there's an inflection point, the knee of the curve, and we're actually living that right here. So this is 23 through 25. It's been pretty exciting for us. Also helping that is what's going on in the AI video surveillance market in particular. If you look at the overall global security market, it's even bigger. But this chart is just reflecting the AI video surveillance market, and it's projected to grow over the next several years at a really healthy clip, north of 21% annually. And this is what we're a part of. This is what we are helping to drive. And this is partly why we're been able to have such significant growth ourselves.
Okay, just a little bit about us from a timeline standpoint. In 2021, we were able to raise essentially through Reg A crowdfunding methods, some significant funds to really push the technology forward. You'll see 2023, we hired our first remote guarding team, the Humans in the Loop. So even going back 3 years, we knew that that would be an important differentiator on top of our base video surveillance offerings. We'll get into it a little bit more, but by 2024, we had signed contracts with 6 of the top 10 property management firms in the United States. We'll get into some of the logos a little bit later, but as of today, we work with 6 of the top 10, 7 of the top 11, and 8 of the top 15. So it's a very strong vertical for us. We went public at the end of January of 2025 through a direct listing on NASDAQ. And we announced earlier this year, Greg showed you the quarterly growth, that we achieved 270% year-over-year revenue growth, sort of cementing the point that we are living indeed the knee of the curve right now from a business growth standpoint. Just some key statistics. We've talked about this, but just to have it on one slide, 98% deterrence rate of all threatening activity. We demonstrate that over and over. Something we feel is very impressive. We're very proud about. We just talked about the year-over-year revenue growth, and we're deployed right now between, we mentioned enterprise customers, between transportation and logistics, commercial properties, and multifamily properties. We're deployed right now at over 100 U.S. locations.
So if you look at, one of the things that's really driving this, it's crime. And for multifamily, the number one location of violent crimes are multifamily properties. 85% of multifamily properties report crime is on the rise. And crime statistics sometimes can be controversial. Some people say they're going up, some people say they're going down. Regardless, at multifamily, people feel that it's really on the rise and significant. And the higher the crime rate at a particular property, it drives vacancy rates, which drives the bottom line, which is why a lot of these folks are coming to us, because we've got a solution that works well. And we've talked about it a lot, but let me play this little video of how our system works, real-time stopping video. These are videos from our actual customer sites. So here, someone is walking in, a guard gets alerted. Okay, a person's in the mail room, maybe not a problem, maybe it is, but the guard sees he's pulling out a crowbar.
Area. You are being watched and recorded by a live agent. Please leave immediately.
And this video was actually a little bit older, where our stats showed 97. We're actually at 98 now. But that's the thing, right? As soon as the guard starts talking, that thief wakes up and walks away, and the crime never occurs. We stop it in action. It's preventative instead of what historically has been a forensic. Something bad happened. Let's go see the video and see if we can find out who it is. This really takes it to a completely different level, and our customers are noticing the impact. And speaking of our customers, as James said, we've got 6 of America's 10 largest property management firms, including some of the largest, Greystar, Cushman & Wakefield, names that you will know. But it's not all that we've got. We've got a very large list of customers. But again, it's 6 of the top 10, 7 of the top 11, 8 of the top 15. And together, these folks manage more than 2.5 million units. And we're in a relatively small percentage. It gives us a lot of opportunity to grow with these customers. Huge opportunity for us to grow. And again, why are they doing it? As we said, crime, they want to protect crime, but it also hits their bottom line. Not just bottom line from keeping people there and keeping their renewal rates there, but it's also real cash out the door. So this is an actual example of one of our customers and why they signed with us. They had a live guard on site, and they were spending, almost $100K a year with that guard. When they were looking at our solution, the first year cost to them was $67K, which included some upfront hardware as well as a full year of surveillance monitoring and remote guarding. So just in that first year alone, it was a 43% ROI by being able to get rid of the guard. And by the way, that guard, one guard sitting at the front door, our guards are looking at all the cameras. So parking garages and pools and the front door and the back door. So you're getting not only better coverage and better service and better protection, you're doing it in the first year with a 43% ROI. And then on a going forward basis, you obviously don't need to repurchase any upfront equipment. It turns out that it's on an annual basis, 133% ROI. So very compelling financial numbers on top of the better service. Why we're having success.
Okay. Yeah, thank you. Let's talk a little bit about the verticals, some of the verticals that we're addressing right now. We talked about a few times now about multifamily. I think the thing that we are seeing right now in 2026 and a little bit towards the end of 2025 is the land and expand strategy. Obviously, with 2.5 million units under management for the folks that we work with, there's a huge opportunity for us to get in with initial properties and then expand out across the portfolio, and we are seeing that right now. Some of the other verticals that use the same technology, but depending on what the vertical is, we address it in different ways, meaning how we actually introduce our technology to support these folks is one is critical infrastructure, right? Like utilities and energy and surveilling like large solar farms, that type of thing. Construction, specifically active job sites, in multifamily or other commercial customers, we have a fixed system of cameras, speakers, and our proprietary cloud video recorder that sends images up to the web and down to our AI servers. For construction sites, you need different tools. Think mobile security trailers that have our brains inside of it. And that is a very promising vertical that we're just getting started with. Another vertical, trucking and logistics. Think secure truck parking lots, docks, yards with trailers and materials. Cargo theft continues to be on the rise in the United States, and we are finding more and more as we introduce our solution to people in the trucking and logistics space that they really understand and appreciate the value that we can provide of reducing or eliminating cargo theft. That's going exceptionally well for us. And lastly, commercial real estate. Think, mixed use, offices, shopping malls. And what we do mainly is protect the outside of the properties from a couple standpoints. One, keeping the property secure at night to keep people from going in, but also, and we think this is pretty important, people after hours going back to their cars after they're done working for the night or locking up the storefront. We protect them through different means when they're going back to their cars, when it's dark and they're vulnerable. So lots of verticals that we're working on that is driving the revenue growth. Award-winning solution. This is just some of the awards that we have that we've been awarded, I guess you would say, over time, going back to 2022. It's not all of them. It's not a smash. It's a grouping. But I think what this shows is it's not just us saying we have a good solution or solutions. It's the market saying that we are a demonstrated leader in the marketplace from a technology standpoint. Financial highlights, we've talked about some of this. 271% revenue growth year over year, and you can see the breakdown of the different components of hardware, remote guarding, installation, and our base cloud video surveillance standpoint. In 2025, we secured $6.3 million in customer contracts, in new customer contracts. We set a record for installations, but maybe even more importantly, over 99% customer retention in the last year. Once we're in and prove the value proposition of what we have, we don't lose customers. Seasoned executive team. Let's just put it this way. All of us have been involved in running public and or private companies over the years. We're bringing our expertise, or we bring our expertise to Cloudastructure. We don't have everything figured out on a daily basis, but we know how to work together effectively to solve problems and to bring new features out into the marketplace. And that's it. So thank you for taking the time to let us present that. And I think we have some questions.
We sure do. Thank you very much, gentlemen, for that excellent presentation. And I'm very curious to hear some of your answers to some of the questions we've been getting from our viewers. We can group these few questions under the crime deterrence heading. As you shared, you shared a striking 98% crime deterrence rate, right? All right. Now, tell us again how your AI actually stops that crime in progress, like a car break-in or somebody trespassing, as opposed to a dumb system that only records it for later.
Yeah, sure. Let me take this one. So, couple things. If you think of traditional security offerings, it sort of runs when we talk about reactive systems. I hate to say, the dumbest of the systems is like my home alarm system, right? It only goes off when something happened, and by that point, it's too late, right? If someone triggers the alarm, gets in my house or gets in a commercial property or an enterprise customer's property, it's too late, right? The best that can happen is forensic evaluation after the fact. There's one. Two, let's talk about network video recording or perhaps other solutions that are using video surveillance. Basically, if you don't have some type of an approach to address what could be happening before it happens, you're stuck once again with forensic evaluation. You've recorded the video, go back to the 1.44 trillion minutes. You've recorded the information. Maybe you know something happened, but you're stuck reviewing hours of footage. Maybe you catch what happened, maybe you didn't. With our solution, and you mentioned a couple of interesting applications, I guess you would say, parking garages. Greg showed the clip of the mail rooms. But parking garages, you would be amazed at the amount of video we have of people in parking garages with tire irons and crowbars trying to break into vehicles. And right, again, go back to that 98%. Once we see what's going on and we talk down to those people, or our remote guards do, the humans in the loop, with speaker systems saying, hey, you with the black hoodie and with the crowbar in your hand, you're being recorded. Authorities have been notified. Please leave immediately. They leave. So those are the differentiations that we see.
Okay, you've sort of painted a great picture there, but let's develop it a little bit. Are we talking about completely replacing on-site physical security guards, or what? And how much could a property owner save with your system as opposed to a human being?
Sure.
On-site human being. Sorry, on-site human being.
Yeah. So Greg gave us a little bit of a view, right, on what savings could look like or do with, some of the cases that we have. But let me answer the first one, or the first part of your question, and Greg, why don't you answer the second part, right? So the first part, are we replacing physical human beings? And the answer is depends on the customer. Okay. Some like to have physical guards on site, even if they are using our solution. But I think what we find is that they're downsizing the number of people that they're actually employing, if that makes sense, right? So maybe they had 6 guards and they've taken it down to 1 or 2 just so they have real-time response on the property. I will share this with you. It's interesting. We have a particular customer of ours who is funded almost $1 billion a year by CalPERS, which is the California pension system, which is the largest pension fund in the United States. And why would CalPERS invest in, a property ownership group? Well, they're looking for ROI for their investments. And why would this company potentially be interested in working with us? They were very, very interested and enamored with the statistics that Greg showed on the savings we can provide over physical guards. And that allowed them to start working with us, that and the functionality of our system, as well as the ROI of them being able to remove physical guards from their property. So win-win, I guess you would say. And Greg, do you want to cover the second point on savings? You had it in the slide, but maybe just...
Yeah. Well, and the savings was, that was getting rid of 1 guard, so 100,000, and that's actually at the low end. We're talking to a customer the other day, and they're saying to fill 1 person kind of 24/7 throughout the year, it's more like 250,000. But the 100,000 was kind of an 8-hour shift every day of the year, and that's a fairly reasonable number. But what they often find is that person is asleep most of the time. They're not necessarily really providing guarding. And so whether they get rid of it or not, if they have guards, 100% they reduce them. We've had them where they get rid of them. And a lot of our customers don't have guards. And the return for them is in lowering the crime rate, providing a better quality of living, right? Chasing people out of the pool at 3 a.m. So you're not waking up all the tenants. There are a variety of
reducing
functions.
Possible liability. Yeah.
Getting rid of a possible liability. So it's not all crime. It's also dealing with quality of living, which means people renew their leases, drives up their ROI because it's really expensive to have to go out and find new tenants. So really compelling numbers. And again, just for getting rid of 1 person on an ongoing basis, it was 133% annualized ROI. Very compelling metrics for them.
Thank you, gentlemen. In early 2026, you launched solar-powered enclosures and autonomous drones. Now, are these just cool tech, or are they a massive shift into protecting massive off-grid sites like solar farms and construction zones?
Great question. As we all know, let's start with the drones. Drones, that's a hot space right now that everyone's jumping on the bandwagon of. We actually view drones as a incremental protection feature, generally paired with mobile security trailers, which we also offer. It's just a faster response mechanism, right? To get eyes on the situation and get to the perpetrators quicker. And frankly, just to kind of shake them up a little bit. So we see it as a real solution, drones that is, right, to adding protection for our customers. Enclosures, we talked about construction as a particular vertical for us. Enclosures we have developed specifically for the construction market, although there's also applications we believe where it can be used in transportation and logistics and other types of environments. But the enclosure, either powered or solar powered, absolutely works perfectly in a construction situation where there's expensive tools, materials, copper wiring, and basically the enclosure is, as opposed to a fixed system, is just our brains and our cloud video recorder inside a device, either with solar panels or powered, to provide the same protection for different verticals as we do with fixed solutions for multifamily and commercial properties.
And the only thing I would add to that is, drones are one, but it could have been robot dogs. It could have been some other advanced sensor technology. We're not developing, the next robot dog, the next drone, right? That technology is going to continue with other folks doing it. We are the brains behind it. And we can connect to any of these new technologies as they come on and leverage their capabilities, but it's our brains and AI solution that really drives the value.
Great answer, gentlemen. Thank you very much. Just trying to bring together all these. How about ordinances, regulations, that question? Maryland and Florida, you recently won several major contracts there because of new local laws and insurance changes. Are these regulatory tailwinds? And if you believe they are regulatory tailwinds, are they becoming a big sales tool? And basically, is AI surveillance becoming a must-have rather than a nice-to-have?
Great question. What we see, and you referenced one of the press releases that we issued recently, PG County in Maryland, Prince George County?
Prince George,
yeah. Sure. They mandated last year to multifamily property management groups, you must have video surveillance, right? You must. So regulatory tailwinds are, we're starting to see more of it. And it certainly is a benefit for us from a sales process standpoint. We just got our 4th property in PG County. And what was interesting about this one, it's a 13 building complex. And as opposed to us just starting with one property and then going to the next, they just said, nope, we want you to do the entire thing, right? We want you to protect the entire community. So it's not just that there are regulations that are coming up, there's regulations, and these property management groups are taking it very, very seriously because, unfortunately, given the litigious nature of the world right now, we're starting to see, specifically in multifamily, what are called nuclear judgments. Huge, huge payouts to individuals that have claimed, maybe true, maybe not, that certain things have happened to them. Either a tenant altercation situation or a pet bite or something terrible happened from a pool standpoint. And what we're finding is property owners and management companies, they want and need the video evidence of what transpired to allow them to defend themselves if they need to from a court standpoint. So lots of interesting things going on in the space that we operate in, and we're proud to be right in the middle of it, protecting customers.
For sure. James and Greg, thank you for joining us today. Again, the company Cloudastructure, CSAI, on the NASDAQ. For more information on the company, call us at 1-800-RedChip or email us at csai@redchip.com. James, Greg, thank you again. We'll see you soon.
Thank you so much. Appreciate it.
Okay, well, it's 3:34 p.m. U.S. Eastern, and we're going to start now with SHARON AI, ticker SHAZ on the NASDAQ. Presenting today will be James Manning, the co-founder, chairman, and CEO, and Ross Barrows, head of capital strategy and investor relations for SHARON AI. Again, this is the RedChip AI Investor Conference. We've been going since 9:30 a.m. U.S. Eastern, and SHARON AI is our final company of the day, so we appreciate everyone who has joined us today. Gentlemen, James and Ross, are you on?
It's only James, unfortunately, but
Okay.
You got the better looking half, is what I'd like to say.
James, great to see you again. Are you going to be presenting your investor presentation today?
Yeah, well, we'd love to share an investor presentation. I'll walk you through that, and then maybe at the end, if you've got any questions or if anyone's got questions, we'll allow a little bit of time for that. And I know it's the end of the day.
And we'll even run this a little bit after. I know we got you started late. I apologize for that. We'll run you till 4:05 U.S. Eastern, so about 30 minutes for you to get your full presentation in, plus some questions. I'm sure we'll be getting a lot of those. Speaking of questions, to our viewers, you can click the Q&A button at the bottom of your Zoom window. A text box will appear. You can type in your question. We'd love to hear your questions for SHARON AI. And before I begin, gentlemen, let me just do the safe harbor statement. This segment may contain forward-looking statements within the meaning of the Private Securities Litigation Reform Act of 1995. All statements pertaining to future financial and/or operating results, along with other statements about the future expectations, beliefs, goals, plans, or prospects expressed by management, constitute forward-looking statements. Any statements that are not historical facts should also be considered forward-looking statements, and of course, forward-looking statements may involve risks and uncertainties. Gentlemen, the floor is yours. Please go ahead.
Perfect. So thank you. And everyone, for those who don't know me, my name is James Manning, and I'm the CEO and co-founder of SHARON AI here in Sydney, Australia. I've spent 22 years working across tech, finance, and large-scale development, but the last 7 years have been completely focused on digital asset infrastructure. And together with the team, we've built or deployed more than 300 megawatts worth of digital asset infrastructure across North America. But in the last couple of years, we've been building what we think is Australia's leading neo cloud platform. And across the last year specifically, we spent our time aligning this business very carefully to scale. And each step of what we've done has been focused on how we align that timing to maximize our market opportunity. So who is SHARON AI? We deliver AI native, HPC grade compute infrastructure so that enterprises, governments, research organizations, and other AI companies can train and run their models in these high intensity environments. We do it really efficiently, we do it securely, and we do it with data sovereignty, and that's a really important point. We are similar in spirit to the other listed neoclouds, your CoreWeaves and your Nebuses, but we're a little bit earlier stage. And I think we have two really important differences. One is our customer focus. So while the CoreWeave's biggest customers are mostly the hyperscalers themselves, and we do have hyperscaler customers in the pipeline, our primary focus is the large Australian and Asia Pacific enterprise, regulated industries, and mission critical workloads. And then the other one, which I'm going to spend a bit of time, is our geography and sovereignty advantage. And so while most of the listed neoclouds that you'll hear about and talk to are very US centric, we're headquartered here in Australia, and we're focused on both Australia and the Asia Pacific region. We've been built specifically for the data sovereignty needs in Asia and Australia. And in an environment where data sovereignty is becoming a non-negotiable, we have a strategic advantage in able to deliver customer solutions tailored to their needs. So we like to think of ourselves as the trusted, domestic, and fully onshore alternative for your AI compute requirements. So I often like to think about why Sharon AI has such a regional advantage. And when I think about that, there's several reasons we think about. We believe Sharon AI is very well positioned. While this category is very large and very well established in the US, in Australia and the broader Asia-Pac region, it's still very early and somewhat constrained. The region's constrained on power, capacity, and access to the latest generation GPUs. But here at Sharon, we like to think we brought this all together in a world-class high-density compute, together with our partners NVIDIA, to give customer solution across both Australia and the Asia-Pacific region. And when I look at the map that you can see up on screen, I like to think about why Australia has that advantage. And it's largely geographic. Australia is a very large country with a population of only 30 million people. We're in close proximity to the Asia-Pacific region with phenomenal fiber capability into the space. What that translates to for us is the ability to export tokens. So we can install GPU compute workloads and export those tokens into the region. So we have a strategic advantage as a country with a small population and a large natural energy install base to be able to install GPU compute, and our country won't consume everything we turn on. And a great way to think about that is if you're looking at, say, South Korea or India, whatever compute they can turn on in the next 12, 24, 36 months, they're naturally going to consume those tokens internally. Their domestic population, their domestic workforce and industrial complex will need all the compute that they can use. Whereas in Australia, because of our small population and our large energy resource, we'll be able to export some of those tokens. And that's why Australia is becoming a very strategically significant and advantageous region to build GPU compute out. The third thing is there are only 3 NCPs in Australia. So very different to the North American market where there's lots of cloud providers, neo cloud providers, and lots of NCPs. And NCP is the NVIDIA Cloud Partner status. And that means NVIDIA has certified the equipment you design and implement meets their standards. In Australia, there's only 3. And with that, there's a huge competitive moat because we are one of 3 unique businesses that have the scale and the opportunity to serve the region. But all of this wouldn't be able to be done without our partners. And key partnerships is how Sharon has thought about building this business. So we like to think about doing our business in a partnership-driven model, and we've done it by leveraging the best-in-class expertise across our value chain. We look to find partners both globally and domestically across hardware, power, security, and connectivity to ensure that we deliver our end customer, which is where our demand's coming from, the opportunity to have the greatest computing solutions in the market. And so, I'm going to talk about 4 key partnerships, and it's not all our partnerships today, but 4 key partnerships for us in our businesses. One is NVIDIA, and I'm sure everyone's heard about NVIDIA, and they've all heard about the great things coming out of NVIDIA at GTC this week, and I'm sure everyone before me has spoken a lot about NVIDIA today, so I'm not going to drill into the NVIDIA relationship. The next one, however, I will. And so the next one's NextDC. NextDC is Australia's largest listed data center operator, and they have a pipeline of over 3 gigawatts worth of energy. We've fortunately secured 54 megawatts worth of energy this year for deployment with NextDC, and we're working to deploy our GPU solutions inside of their facilities. The next one is Cisco, and everyone knows that house name Cisco, but we partnered with Cisco to provide managed enterprise cloud AI solutions. Critically, the Cisco enterprise solution allows us to create what we call a secure AI factory. And this is a really, really important solution where you have a business that specifically has a high security environment, very important for things like government contracts or highly regulated industries like financial institutions and insurance firms. So this highly secure AI factory is a Cisco unique product that ties into existing corporate and enterprise networks. So it's a phenomenal relationship for us. And with that, Cisco have a go-to-market strategy where they're actively out there selling the SHARON AI compute solutions to their end customers. Finally, WWT. So WWT is like the great company that no one seems to know. WWT for 10 years has been NVIDIA's #1 implementation partner globally. They're a very large organization turning around $28 billion US a year, US based. They handle our procurement and deployment. They ensure that we buy the best equipment for the best price, whether it's from Lenovo or for Cisco or for Dell or Supermicro. They get it on time and deploy it into our facilities. And that's a really important relationship for us to make sure we can leverage their buying power, their expertise to get our compute online so we can run our inference cloud. So I always think it's really important to think about where we've come from and where we're going. 2021, we started this business. We started it as a cloud storage business. Back then, we had some A40s and 3090s. So, we're talking almost 5 years of experience running GPU computing. 2022, we started to pivot that GPU workload into this emerging field of AI compute. 23, 24, we started to acquire GPUs specifically for AI use. So we started to acquire L40Ss and H100s. And those returns turned out to be incredibly attractive, and we really started to capture partner attention. In late 2024, however, that's when we became an NVIDIA cloud partner. And that recognized the fact that as an organization, we had the largest install base of GPUs for public cloud consumption in Australia. But 2025 was the year the whole business changed. And so in early 25, we started to build Australia's first NVIDIA reference architecture supercluster here in Australia with NextDC in their M3 facility on H200 GPUs. By mid-25, we'd started to see that cluster started to attract real serious enterprise interest. And in late 25, the whole thesis was validated where we won Canva as a customer. And that was a really interesting win for us because winning Canva, they're a very large AI native business. They do a lot of their compute on AWS, and that was a very competitive process. So in that Canva conversation, they wanted to benchmark our organization and see how our compute stacked. And what we came out was with great compute performance results. We were 30 times faster the first token and 40 times faster on storage. And so we got a contract with Canva successfully awarded to us around our ability to deliver high performance computing. And we think about how we win these and do all of these things, and it's all through these partnerships. It's through partnerships with our storage providers, Vast. It's through NVIDIA. It's through Next. And this is how we create a diversified and long value chain that ultimately enables us to secure world-class customers like Canva. But 2025, we didn't finish just there. Late 2025, we raised $100 million in a convertible note. That enabled us to acquire a B200 cluster and a B300 cluster. But we didn't stop there at the end of 25, and that was late December. And the last weeks of December, we sold our interest in TCDC. So that was an investment we had in connection with New Era AI. They're another RedChip customer. You may have heard from them today. So, we initially invested $3.5 million in that project. We subsequently sold that for $70 million back to New Era. We anticipate getting those proceeds from that sale between March and June this year. We then signed a $500 million debt facility with USD.AI, and we signed off on a $200 million revenue share with Digital Alpha and Cisco. All of that was about $770 million worth of non-dilutive capital back in the business that enables us to focus on our core thesis, which is being an AI native neo cloud business serving GPU compute. Since then, however, we've worked through the procurement of how we think about in our Sydney S6 facility. Since then, subsequent to that, we did a capital raise on NASDAQ with Lucid Capital Partners in February this year, where we raised another 125 million. Since then, we've been working actively about how we now build and deploy our next phase of our business, which is on a GB300 in Sydney's S6 facility. So to give everyone a bit of a feel for that, that's approximately 10 megawatts worth of computing power. And if you look at the sensitivity table, 10 megawatts equates roughly to the second row, so 4,608 GPUs. So the second row there. What we're seeing is, and we like to think about how we model our business. We like to see our GPU rate per hour around $4 an hour. That's how we think about when we model our business. And I'll give you some economics around, and you can see those on the screen. So 4,608 GPUs, 10 megawatts worth of power. It's about $440 million worth of CapEx to build something like that today. It generates about $161 million worth of revenue at a GP of about 80%. So a highly profitable business model when fully deployed and sold to the right customer. That $4 an hour is a really good base case scenario. And the CapEx profile is how we're using these proceeds. So when we did our NASDAQ capital raise, where the funds are going to, we partner that with debt. And I previously just spoke about the USDAI and the Digital Alpha facility. We're currently in the market looking at other components of how we finance and scale the business out. So always useful to see the capital insights in a single slide, and this one really does it for us. So all up, the company's got about $305 million worth of capital available to it for deployment in this AI vertical. And so that's the $100 million convertible note in December, the sale of the New Era stake for $70 million. We've got $200 million and $200 million for Digital Alpha, $500 million for USDAI, and then the $125 million cap raise. So underlying capital, $300 million, plus the debt, $700 million, north of $1 billion worth of capital available to the business to deploy for the right customer, the right experience fundamentally. It's always good to talk about the Texas transaction because, the team at Sharon AI have a lot of experience building digital asset infrastructure. And part of that is, the ability to identify early sites, work through the engineering and the approvals process and get them all the way to the point at FID. But at its core, Sharon AI is a neo cloud and we're focused on our GPU business. So, when we partnered with New Era AI to build what we call Texas Critical Data Centers, we started in January 2025. We had some uncertainty about the project and the site, but, we committed to the land. By June, we'd, however, done enough diligence and enough engineering work to sign a non-binding LOI. We then subsequently worked through all the engineering processes, firmed up, energy supply, firmed up design, and ultimately ended in exclusivity in November 2025. And really, at that point, you started to realize the business was at FID for an end customer, and Sharon realized, from its perspective, it was better to exit the transaction at that point in time and focus on its core business, which is GPU compute. So hopefully the New Era AI guys go through and finish building out the facility. It's a phenomenal opportunity, up to a gigawatt site, and we'd love to be a tenant of theirs one day. But for us, it was a strategic opportunity for us to exit the project and realize $70 million worth of value. So, great return on equity. We invested about $3.5 million in the venture. We were receiving $70 million in proceeds. We believe in the venture, and so we've actually taken script in New Era AI as part of the transaction. We believe they'll execute this transaction out in the future, and we wish them all the best and luck in the transaction. And finally, I'd just like to wrap up a bit about our team. So, I've spoken about me today, obviously CEO, co-founder, Andrew Leese, ex-Macquarie Bank. He has a lot of experience running a MSP prior to this role. Nick Hughes-Jones, he spent the last 7 years alongside me building digital asset infrastructure in North America. He was part of that team along with Tim Bridgewater, our CFO. We built north of 300 megawatts in North America. We subsequently on-sold those projects. So you'll see sites that we initially, the three of us built, they're currently owned by Bitfarms, they're currently owned by CleanSpark. And then Dan Mons comes from a higher education university technology background where he's built some of Australia's leading supercomputers. So phenomenal executive team. And it's not just the team. There's so many more people I could add to this slide today. The team's expanded. They've got a lot bigger. We've got a lot more depth as we look to execute out on our model. And then finally, just a couple of things about our board. So Peter Woodward, people might know him from his business TSS, another NASDAQ listed company. They're Dell's #1 integrator in North America. So a lot of expertise and experience in compute. Alistair Cairns comes with a lot of management experience. He's ex-McKinsey & Co. Phenomenal board member, lots of insights in best practice in running and scaling a business. And lastly, Drew Kilton, who's had a phenomenal career and currently sits on the board of an Australian company called Superloop, where they're building out the fiber infrastructure and telecoms around the region for AI companies as they grow. So with that and keeping to the time limit, that's the end of our presentation today. I'd love to switch back now and stop the share and we can go through some questions. But, to summarize, Sharon AI, phenomenal neo-cloud opportunity in Australia, servicing the Asia Pacific region, listed on NASDAQ with the code SHAZ.
And thank you very much for that. And I appreciate you being cognizant of the time, James. Here we go with the questions for today. We've got plenty coming in. The Blackwell question. You are one of the first companies to deploy NVIDIA's Blackwell Ultra GPUs. Since these chips are in such high demand, does having them in your data centers right now give you a massive pricing power advantage over other providers?
Great question. We like to think of our business as being customer-led. And so what we're seeing in the market is phenomenal demand for all the chips. There is more customer demand for chipsets than we can actually deploy. So yes, you do have, the short answer is yes. If you have chipsets and they're available and they're online, you have phenomenal pricing advantage over someone that has to deploy those chipsets in 6, 12, 24 months time, whatever their time frame is, whether their facility needs building or whether they're just, got the lead time on the equipment. So we do have a pricing advantage is the short answer for chips that are available online. And, we are regularly working through contracting out all our equipment day to day.
James, we get a lot of questions about finances, of course. Path to revenue. You just raised $125 million in your IPO. How quickly does that money turn into chips on racks and actual monthly checks from customers? Go ahead and start with that, and then he's got a follow-up.
Yeah, no. So that's great. So we have revenue. We have revenues. We have contracted customers. But to specifically give you a good example of the time from raising some capital to actually deploying, when we order equipment, we have approximately 10 to 16 weeks to turn that equipment online. And that's the lead time between initial order of equipment and deploying it, assuming we've got the data center space organized. And we have a pipeline of data center space that we think about, and we match that to our, we've been very strategic about how we map that. So from our perspective, we've thought about, when we raise capital in the market like we have recently, it's been around a specific end goal, around a specific customer contract. And so what I think you'll see from us is, as we come to market around a customer contract, what that customer contract is and where the deployment's been. You're on mute.
Sorry, thank you very much. James, a lot of people are asking why Australia and the broader Asia Pacific. Could you reiterate why it is such an attractive market?
Yeah, I think Australia is the right spot for a couple of reasons. Our proximity to Asia. the Asian market is huge. The population base there is phenomenal. The requirement for compute is really, really large in region. And, when you think about that, the TAM, or their total addressable market in Asia Pac, is huge. And then from an Australian perspective, we're geographically remote, that we don't have to worry about all the geopolitical issues that are going on in rest of the world all the time. So we're a very safe and secure place to put a lot of compute online. And with that, we have the opportunity to, and a small population and lots of natural energy and large energy base, we have the opportunity to be able to, deploy here in Australia and service the region. And that's why we think Australia's in a great position to ultimately service that Asia Pac region and be the GPU powerhouse for Asia Pacific.
Thanks, James. Strategic partnerships. How do they reduce execution risk and strengthen your platform?
Yeah, so great question again. So WWT is a really good example of that partnership. They're a global, technology provider. They have, they turn over sort of $28 billion a year. They have access to, incredible supply chains for deployment centers around the world. So, by way of example, let's say we buy some equipment tomorrow from arguably, Supermicro or Dell or Lenovo. They will take delivery of that gear. They will bring it in their factory. They will test that in their procurement timeline and process. They will rack it for us and then ship it to us racked, pre-configured, so that we can roll it into our data center facilities and turn it online. So it's about speed to execution, as well as a QA, quality assurance process, to ensure that the equipment we've got is working and it's going to come online, so that we can get to end customer online in a faster period. So, that's a great example of a partnership that we've got. Similarly with our data center providers, those partnerships give us access to the energy, and we take contractual views, 10-year views on those leases. So we've got long-term, long duration on those assets, and access to that power over the long term. So when you combine things like access to energy with a great procurement and supply chain, and a phenomenal sales team like we have in our partnership with Cisco, it's a really powerful organization. So, Cisco's out there selling for us. They're selling GPU compute. There's 250 salespeople in Australia alone in the Cisco team actively out there selling Sharon AI compute. We've then got deployment partners and data center partners. We bring it all together and we run that with our own inference layer over the top.
We appreciate you answering those questions so quickly, James. We got one more here. A lot of people are asking about, the near future, the next 12 to 18 months. In your opinion, what developments could most improve the investor's understanding of Sharon AI's long-term strategic value in the next, 12 to 18 months?
Yeah, I think from our perspective, the thing that we'll be able to lead investors to is large customer contract wins. And so we're near term looking at some, how we bring to market those customer contract wins, telling customers about our opportunities and what we're selling in market. And as we continue to look at building out the GPU compute base, megawatts are going online, compute is going online, and that'll be very, very important for customers and investors to understand how powerful the growth trajectory of our business is.
Thank you, James. Thank you very much. Again, it's Sharon AI, trading on the NASDAQ under the ticker symbol SHAZ. James, thank you very much for joining us today.
Thank you very much. Have a great day.
Okay, you too.
Bye.
If you'd like more information on Sharon AI, reach us at 1-800-RedChip or email us at shaz@redchip.com. Now that does it for today's RedChip Virtual Investor Conference. Thanks to our many thousands of viewers today, and of course thanks to our many presenters as well. We've been going since 9:30 a.m. U.S. Eastern. It's been a long day and a very, very interesting one for everyone, we hope. And if you'd like more information about any of the companies presented today, just write us at info@redchip.com. And of course, you can look at our website at redchip.com. Thank you very much.